was watching out for in today's trading session is obviously going to be overnight session in the US market. That's going to be the Fed's rate decision. So that will be key to watch out for even for our Indian markets in tomorrow's trading session. So keep an eye out on that one. Nvidia stocks, that also gained, given that, obviously they spoke about AI supercomputers, building of that for the US Energy Department. So that is why those AI related stocks saw a buzz in the US market. Now, Indian markets, look at the FII number that's come in yesterday, 10,000 crores approximately of FII buy, while DII is also net buyers of 1,081 crores. Obviously, that was at expiry day, so maybe, that increase in terms of number coming in from the FI side, but that's something we'll keep an eye out on. IPOs that are opening today. We have Oracle India, that's the owner of MTR Foods, that opens for IPO today. Keep an eye out on that. Cues for today, we'll have PM Modi, who's addressing the Maritime Leaders Conclave. Keep an eye out on that. IIP data that came in yesterday was stable at 4%. NCLT will be hearing Vedanta's demerger case, so that is important. SEBI's proposal is going to be there, which was made to revamp those mutual fund fee rules. That will be important there. And earnings today, BHAL, HPCL, L&T, Mahanagar Gas, NTPC Green, PB Fintech sale, among some of these important earnings. Nifty implied open, 50-point uptick, so keep an eye out on that one. But let's go across to Gaurav, who's here to tell us which are the important stocks to watch out for in today's trading session. Good morning, Gaurav.
Well, good morning. First, let's talk about Mahindra & Mahindra Finance. When we look at profit, it increased almost by 45% on a year-on-year basis for the company, and at the same time, net interest margins, they also expanded more than 20 basis points. Other than that, Sri Cement actually came up with weak set of numbers, because when we look at the margins, they came in at around 19.8% versus estimates of around 22%, and at the same time net profit that also came in at around 277 crores, a bit lower than our own expectation. Jindal Steel, once again weak set of number is what we saw here as well. Margins that came in at around 17.8% versus our poll of 17.6%, but at the same time net profit that came in at around 638 crores. Happiest Mind, when we look at the numbers, net profit declined almost by 5.5% on a year-on-year basis, on a sequential basis, and at the same time, when we look at margins, we saw a bit of an expansion of around 30 basis points. When we look at Premium Energy, now here we saw a good growth of around 72% on a year-on-year basis in terms of net profit, and at the same time, when we look at margins, they also expanded to around 30.5% versus what it was at 25% just a year ago in the same quarter. IIFL Home Finance, it's a subsidiary of IIFL Finance, and why this is in focus is that when we look at results, net profit that declined almost by 39%, net interest income that declined almost by 8% on a year-on-year basis. But remember, Mr. Girish Kosgi, who was leading PNB Housing earlier, he will be joining as MD and CEO on 30th of October, which is tomorrow. So definitely watching out on that. And let's also watch out for Tata Capital and Star Health on the back of the results that they have reported yesterday.
Okay, Gaurav, thank you so much for that. But let's go across to Sudarshan, who's here to tell us what to watch out for in the world of F&O. Good morning, Sudarshan, and a beginning of a new series. What are the important cues today?
Good morning, Vinny. So the last hour recovery that we saw yesterday was led by banks, and that helped Nifty Bank close in the green. And also all the major indices, Nifty, Sensex and Midcap index saw a huge recovery to close near flat line. Now we are starting the November series after big gain that we have seen in October series. In October, Nifty was up more than 4% in the second straight gain that we have seen in the series, and the biggest series gain that we have seen since June of 2024. Now, if you take a look at the last few November series, so if you just exclude November of 2024 and look at 2023 and 2022, in both those months, we have seen a healthy gain. In 23, Nifty was up 7%, and in 22, it was up almost 4%. Even rollover remains healthy, that we are seeing a rollover of 76% versus 3-month average of 81%, and FI long exposure, which was around 6 to 7% at the start of the month. Now we have closed October series with FI long exposure around 20%, and in October it was 6%, September it was 8%, in August 10%. Going forward, what would be in focus? First, US FOMC outcome will come tomorrow, so on Friday we'll react to that. Second, if there is any development related to trade deals, and lastly, Q2 results are underway, so we'll keep tracking and market will also react to that.
Okay, thank you so much for that, Sudarshan. But let's move on and talk about the important upgrade that came in overnight. Now, SEBI has proposed a major overhaul in India's mutual fund fee structure, and this is to simplify charges, boost transparency and reduce investor costs. Sonal is joining in with us to give us details of this proposed changes. What will it mean for AMCs as well? Sonal, good morning and over to you.
Good morning, Winnie. Well, yes, these proposals are investor friendly and they have been brought in to bring more transparency and also reduce costs for mutual fund investors. But taking you through the proposals first up, SEBI has proposed lowering expense ratios which are charged by mutual funds to the investors on different kind of funds. They've proposed reduction of expense ratio by 15 basis points. This is for open-ended schemes. It is around 25 basis points for close-ended schemes. Additionally, expense ratio for equity related or oriented scheme will be reduced to 1% from 1.25%. They also talk about equity expense ratio for other than equity oriented schemes will be reduced to 0.8% from 1% earlier. That is not it. Mutual funds go ahead to the brokers and they buy stocks, so they have to pay brokerages for that. SEBI says even this brokerage will come down for equity schemes or cash market transactions to 2 basis points from 12 basis points earlier, and for derivatives from 5 basis points now to 1 basis point. So this could be negative for institutional brokers as well, like Nuvama or 361. SEBI is trying to say basically that fund houses that are venturing into non-mutual fund businesses, that should be done through a separate business unit. It should have separate employees and these two should not merge, because this is in favor of investors if it is separated. They also add that statutory levies like STT, GST and stamp duty will remain outside the expense ratio limit. This move, as I said earlier, is expected to bring more transparency and reduce hidden costs for MF investors. Additionally, they are also talking about performance-linked expense ratios for mutual funds, and move aims to align fund manager performance with the expenses which are being charged to investors. A detailed performance-linked fee framework will be decided after consultations. The deadline here is 17th of November. But do remember, there was a proposal back in 2023 as well which spoke about getting all the expenses under one roof to basically reduce the confusion, right, of different type of expenses charged. But the industry did not agree. So that did not go through. And the new set of rules have come in. So we'll have to see whether industry agrees with it or not. But if it is implemented, it will be negative for some of these asset management companies. Some of them are listed as well. And some of the brokers, because even the broking fees has been proposed to be reduced.
Okay, Sonal, thank you so much for explaining us that. And this is a proposal right now. Whether this goes through is something we'll watch out for. Like Sonal mentioned, it'll be key to keep an eye out on this one. Thanks so much for that. But now shifting focus to some of these macro data points, right? India's industrial production data that came in for the month of September has moderated slightly to hit a 3-month low at 4% on the back of slowdown in mining and electricity sector growth. Now, according to the data released by the National Statistics Office, the mining sector growth fell to negative 0.4% compared to a 6.6% in the previous month. Now, the electricity slowed down to 3.1% from 4.1%. So that growth also is reduced in the month of August, while manufacturing rose to 4.8% from 3.8% earlier. The consumer non-durable sector also contracted for the second consecutive month by 2.9%, while primary goods growth moderated to 1.4% versus a 5.4% in the previous month. So important macro data point that came in yesterday post-market hours as well. But on that note, we're going to slip into a very short break. After the break, we'll get you what's happening, what are the cues in Wall Street, in the US market. Stay tuned in for that. Welcome back to Power Breakfast on CNBC-TV18. Talking about the US markets now. The stocks on Wall Street actually ended Tuesday's trading session at record high for the second straight day as investors await the Federal Reserve's interest rate decision later today. The Dow gained more than 160 points, while S&P 500 added about 15. And the tech-heavy Nasdaq, that was up 190 points in yesterday. That's last night's closing session for the US markets. The markets also gained mainly led by Nvidia. What we saw coming in is that stock actually climbed 5% and had notched a new high. The AI chipmaker actually made a series of announcements, including a partnership with Nokia. Nvidia will take a $1 billion stake in Nokia, which is said that it will use these proceeds to fund its parts in AI plans as well. So important updates that came in from Nvidia, which led to the up move in the stock as well as other AI stocks. But as we mentioned earlier, the biggest cue that is coming in today is going to be the Fed's interest rate decision. Now, remember, the Fed is making this time's decision amid an ongoing government shutdown in the US. Now, CNBC's Steve Leisman is joining in with us with a survey on Fed's rate cut path. Listen in.
So yeah, respondents to the October CNBC Fed survey see a rate cut on the way from this meeting, the next meeting in December, and possibly one in January, despite continuing worries about inflation, tariffs, and a government shutdown in which, according to one respondent, the Fed is flying blind. Take a look at the numbers here. 92% say the Fed will cut in December. Of course, only 66% think the Fed should cut. There's concern about inflation and the other things I mentioned before. Additional cuts coming, 100 basis points. That includes this meeting, December, maybe January, all the way through 2026, bringing the funds rate down to, drum roll, 3.2%. So just another 100 to go from where we are right now. Richard Bernstein, CEO of Richard Bernstein Advisors, tells us that because of inflation and a surging stock market, quote, in more normal times, there's no way the Fed would be cutting rates here. Inflation is seen remaining above the Fed's 2% target, 3% this year, 2.8 by 2026, 2.6 by 2027. That's around where the Fed's target is because CPI runs a little hotter than the PCE. Tariffs remaining the #1 threat to the expansion, according to the survey. But 63% say that the effect on inflation has been less than they expected. 37% say in line. But why? 48%, unfortunately, say the impact has been muted so far because the full effects of tariffs have not been passed along yet. That speaks to perhaps further increases in prices. 30% say companies are eating those tariffs, maybe more pass along there. 13% say there have been offsets to tariffs by declines in other categories of the CPI. Several Fed officials, along with survey respondents, have concerns about cutting too much with inflation still above target and without the data we need to know if we're doing the right thing.
And moving on, fears of AI taking over jobs are on the rise. However, CEO of AI chip darling Nvidia thinks otherwise. Listen in to his statements from the Nvidia GDC event.
I think this idea that AI is going to take jobs is going to change everyone's job. That's for sure. But I think it's going to make companies more productive. We're more productive today because of AI. We're hiring more people.
Meanwhile, the e-commerce giant Amazon has said that it will lay off around 14,000 corporate employees in a bid to invest more in AI. Shilpa Raniveta joins us now with more on this one. Shilpa, take us through the company's plans. What will this mean going forward as well?
Amazon says that this is part of a larger effort to reduce the bureaucracy, remove layers, and operate more leanly as it, it will also, though, continue to hire in key strategic areas like AI and technology, communications, and the communication to all the impacted employees will go out today. Now, in an internal letter, Beth Kaleti, who's the HR head for Amazon, said that the company's reorganization is a part of the move to move faster, strengthen ownership, and invest in its biggest bet, which is AI. She said that while some roles will be reduced, most of the impacted employees will be given 90 days to look for another job within Amazon, with recruiting teams prioritizing internal candidates. Now, those who don't find a new role or choose not to look for one, they will receive transition support, including severance pay, health insurance, and outplacement services. Now, she said that the world is changing very quickly and that this generation of AI is the most transformative technology since the internet, which means Amazon needs to stay organized with fewer layers and more agility to innovate for its customers. Now, this move, in fact, builds on what CEO Andy Jassy had outlined earlier this year in June that Amazon is investing quite expansively in generative AI, calling it a once in a lifetime technology. Now, Jassy had said that Amazon already had over 1,000 Gen AI applications in progress, and he highlighted AI agents as the next big leap. Systems that can automate routine work, write codes, do research, find insights, and more. And he had also encouraged employees at that time to learn to experiment with AI, saying that those who embrace will be able to play a key role in reinventing the company. Now, Amazon also joins a whole list of other companies, including Meta and Microsoft, that this year announced layoffs tied to AI-related restructuring. Back to you.
Okay, Shilpa, thank you so much for that. But on that note, we're going to slip into a very short break. We'll get you the cues in the world of commodities after the break. Welcome back to Power Breakfast on CNBC-TV18. Now let's go across to Manisha Gupta, who's here to tell us what's happening in the world of commodities. What are we keeping an eye out on today? Good morning, Manisha.
Morning, Vinny. As people have been saying that copper is the next gold, and it really seems to be turning that way because we're trading very close to all-time highs. In case of copper, we've seen 4% of gains in this week itself, and over the month, it's gained up by 7%, unlike the precious metals, which are showing week-on-week and a month-on-month decline now. There is profit-taking coming in for gold and silver, but remember, all of these markets are now eyeing out for the U.S. and China trade talks, and then it is also about the U.S. Fed meeting today in the evening when an announcement of a 25 basis point rate cut could come. So ahead of that, we've seen Asian volumes slightly on the weaker side. Coming back to copper, and the prices have been supportive also because of the supply concerns across various mining and producing countries there, whether it has been about Congo or Chile or Peru, even Australia for that matter. Indonesia also, the Grasberg mine has been shut for some time now. So copper seems to be getting its support from there. Finally, on the crude oil prices, and we have seen 3 days of decline, but today seems to be a steady market right now. Having said that, crude is heading for a third monthly decline in sense of prices, while on one side, investors are weighing the impact of U.S. sanctions on Russia, but on the other side, OPEC is considering another output hike in its upcoming meeting. So that is what is keeping a balance in case of prices.
Okay, Manisha, thank you so much for that. Now I'm going to start seeing what copper is going to be doing, given that if that's going to become the next gold, that'll be important to keep an eye out on in terms of the move there. But let's move on and talk about the latest update coming in from Israel side. Israel actually launched strikes in Gaza after Israel accused the militant group Hamas of violating ceasefire in the Palestinian territory. This attack comes within 3 weeks of the ceasefire deal brokered earlier this month by the US President Donald Trump. At least 8 people were killed in the strikes, including 3 in Gaza City's Sabra neighborhood and 5 in a car targeted in Khan Yunis. Now, according to the local health authorities, the Israel military did not immediately comment on the strikes, but there was a statement by the Prime Minister Benjamin Netanyahu's office saying he had ordered immediate powerful attacks. Now, moving back to some domestic update and back home in India, the cyclonic storm Montha has weakened into a cyclonic storm across, that is after crossing Andhra Pradesh coast, bringing heavy rains and strong winds to several coastal districts late last evening. The severe storm caused damage, including snapped power lines and flooded homes. One casualty has also been reported. So important updates coming in there. But with that, we're absolutely out of time with this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, Jibas Harmonica.
The countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Middle of the week, Wednesday morning. It's basically another record high last night. Yesterday, we got a bit of a pause. And that's the lay of the land as we begin this fresh new trading session. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, good morning. And there's more talk on trade, and Trump has been saying that he could even lower fentanyl-related tariffs on China. But beyond all the trade headlines, there's some very interesting headlines with respect to the mutual fund here in India, proposed regulation and changes there. We'll talk about that as we go ahead.
Well, that's right. We'll address that piece of news. And today we kickstart a new series. That's the November series. October was brilliant. Let's see whether or not we have enough to push even higher. All-time highs should be here in November.
Well, 26,227, right? Which is not very far away, just a couple of percentage points. We'll see. We've got, so let's just take it from the top, right, in terms of what you need to know as we begin this session. U.S. equities, once again, every day you basically trot up to a new high. NASDAQ was up 0.8%, but basically combination of two things. Lots of AI-related deals and solid earnings as well. So I'll start with the AI bit, which I think is sort of easier to list and attribute reasons to. NVIDIA was up 5%. After basically NVIDIA did not just do this deal with Nokia. They basically said that they'll invest $1 billion in Nokia as part of an agreement to collaborate in AI. But that GTC event of NVIDIA was happened last night, and they've announced a bunch of partnerships with companies across the spectrum. And the stock was up 5%. Microsoft ended about 2% higher after a deal with OpenAI that will give it a 27% ownership, which is now worth about $135 billion out there. Now, Apple, not to be left behind, briefly surpassed the $4 trillion market capitalization and then fell back under it. And more tech, right? Lots of earnings. Meta, Microsoft, Google will all report numbers tonight in the U.S. session. So it's tech and tech. Even from the U.S. administration side, President Trump, for example, is in South Korea, and I think he just made a speech, I think maybe actually underway even now, but basically saying, and there were reports that U.S. may sign a deal on AI and quantum computing with, U.S. administration may sign a deal on AI, or quantum computing, etc., with Korean companies and, the Korean government as well. The other bit in terms of Trump, WSJ is reporting that U.S. could cut the fentanyl-related China tariffs from 20% to 10%. This, of course, seems to be, both sides trying to get to a better place by the time that both presidents, President Xi and President Trump, meet tomorrow, and something solid for them on the table. Will we see the outlines of like what's been described like a framework deal without too many details? Most likely, yes. But at least no further, or at least fresh hostilities, I guess, is what the market is excited about here. Gold prices bounced off the 3,900 levels. Oil prices are slightly on the back foot, but macro markets are quiet. That, I guess, is also because the Fed decision is later today, which we will react to tomorrow morning. 25 basis point cut is expected. But more and more attention on what the Fed will do as far as quantitative tightening is concerned, and whether this we'll see the end of it. Now, just to tie in the levels, yesterday was a bit of a consolidation across the board, Nifty, Bank Nifty, and the broader indices as well. But the Nifty managed to hold on to the 40-hourly exponential moving average, and we kind of bounced off it. So on the way down, support is in the range of 25,708 to 25,665, and resistance is the high. The range between 26,104 and, of course, the all-time high, which is another 120 points, which is 26,227. Bank Nifty needs to first cross the high of 58,577, which is less than 0.5% away. But if it manages to cross above it, then you've got extension levels which come into play. 58,961 and 59,895 are the other two resistance levels. And support is the low that we saw 3 days back, which is 57,482. So those are levels for both the Nifty and the Nifty Bank out there. GIFT Nifty will give you a quick sense of how we are set up in terms of the start, and then we'll pick up from there. 74 odd points higher is the indicative open. F&O positioning, Nigel is standing by with that. Nigel, over to you.
Well, the October series was brilliant, and even in the final day yesterday, we did see that the Nifty did fight back from the lows of the day. We're setting ourselves up for the November series, and a few factors that you need to note. The FIs, they're short. Yes, the country remains short, but they're not as aggressively short as what we saw at the start of the October series itself. Well, the big question is, the Nifty is doing well, but portfolios are not feeling like the markets are closer to fresh all-time highs. So can we see this rally broadening out? And finally, November is traditionally a good month for the Indian equity markets, with the Nifty up close to around 1.5% on an average over the last decade. And the Nifty Bank is the one that normally drives away the gains. On an average, it's given returns of more than 3% in the month of November. And I'll tell you what, if we need to scale even higher from here, the Nifty Bank will have to be the one that leads the way. But in yesterday's trading session, it was quite interesting. The FIs, well, the buy number was very, very large. We had one large trade out there, but otherwise it appears it's an expiry day-related factor where the futures got converted into delivery, cash market delivery. So the FIs, it appears some of those stock futures have got converted into cash delivery, and that's why that number looked rather large. The DIs, well, they continued their buying ways. So both the institutions were buying numbers. From today onwards, that trend in the FI buying will continue. The good news is, for the last many trading sessions, they've reduced their selling. Well, moving to the rollover position then. If you look at it, the market-wide rollover position, more or less in line. But the Nifty rolls, well, they were much lower in comparison to the averages that we have seen in the past. And that's perfectly reflected in the open interest as well on the Nifty futures itself. It's much lower in comparison to the previous series. That's telling you that some of those shorts, they got covered out. They didn't roll over into the new series. But will we miss those shorts? That's going to be the question, because otherwise we had that cushion of shorts being into the system. We start the series with the open interest much lower. Moving to the FI positioning, well, the FIs, yes, they are short, but not as short as what we saw in the last series. And I think we'll miss them a little bit because you like a market that was aggressively net short. Clients, they're net long, but not as net long as we saw at the start of the last series itself. So the client data as well on index futures will come up for you on the screen. Moving to the other data points, well, I was looking at the options data. The two levels that you're looking at, this high, this 26,300, this seems to be a bit of a barrier. The fresh breakthrough comes once we get past that mark. For the time being, I think the bulls will try to get to that mark, but there will be resistance at around the 26,300. If we get past that, the fresh leg of the rally takes place. But this market has turned into a buy on dips market. And the 20 DMA, 25,500, if that level holds out, you'll be fancying your chances to see trend on the upside, though the 26,300 seems to be a bit of a resistance mark. But the broadening of the rally is going to be very, very important, because the Nifty is very close to the all-time highs, but the Nifty Next 50 is more than 10% away from the fresh all-time highs. So you'll want that to get closer out there. And the small cap index is, well, 6%. So I think the participation from both these two will be important. That's what will make portfolios actually look very, very good. Though the Nifty is on its way to all-time highs, you want to see broader market participation. Finally, the big cues for this series: GDP data will be out, trends with regard to domestic growth, India-US trade talk, very important to get the animal spirits back and make the mood feel much better. And finally, the US Fed data points, as well as what's the trajectory with regard to that. So the November series promises to be a good one. Trend is on the upside, but I think that 26,300 will be an important resistance mark, and the Nifty Bank will have to lead the way.
Oh, absolutely. So let's see if the bulls can actually take some of those levels up on the upside. This morning, Asian markets little mixed. The Japanese market continues to chug along. It's crossing level after level, and today's level was actually 51,000 on the Nikkei. Still trading above that level. The Taiwan market is up about 1%. Even Shanghai, mainland China, Shanghai markets are tracking some gains at this point in time. Australia was the one that was negative because inflation is bumped up quite a bit in Australia, above expectations, some profit taking there. That is the implied open. It suggests that we'll have another strong start to trade. We'll have to see if the bulls can build on that. Almost 100 points up on the implied open right now for the Nifty. Let's take the conversation forward. Mark Franklin, Deputy Head of Multi-Asset Solutions Asia at Manulife Investments, is with us. Mark, great to have you join in. So first things first, are you expecting a rate cut from the Fed later tonight? And what does that mean for equity sentiment overall?
Yeah, good morning. It does seem to be the case the Fed will proceed with a second rate cut. That's priced in by markets, and so that's probably going to be considered as a non-event. It's really their forward guidance and the Q&A session that will be very important, because there are further rate cuts priced in, not just for the remainder of this year, but also next year. The other thing that market participants will be watching is the extent to which the Fed confirms that they will be concluding their QT program and effectively normalizing balance sheet policy. That's also to some extent expected by the market. And so if the Fed does deliver on those two areas, then it's likely to be an uneventful central bank meeting. But of course, if there's any sense that the Fed is still hedging its bets, still somewhat concerned around its inflation mandate, that could create some volatility for markets across asset classes.
I don't know. It's not, I think, the base case at all for anyone. But given the lack of data, Fed's going blind, right, in the meeting. They only have this inflation print, but hardly any details on the labor market. If they decide to stay paused today, for whatever reason, absolute shocker for the market, how would that reaction play out? Would there be a substantial downside, or will the market look through it just because we're still in shutdown territory?
That's just not the base case that they will fail to move on rates. But of course, if we play that hypothetical game in the conversation, then you'll see some repricing out of rate cuts and potential pressure on the front end of bond markets, the bond curves. And that could potentially create some volatility in the more rate-sensitive parts of equity markets. But then the market will be looking through the rationale for that. If the Fed's saying we simply hadn't had enough data, we'll revisit it when the government shutdown concludes, the markets will, to some extent, try to look through that. But if there is a sense that the Fed is doing it for fundamental reasons, that its perception around the data is stabilization or inflation upside risks prevailing again, then that's more likely to have a persistent impact on market sentiment.
Mark, is the sentiment around precious metals turning a little bit?
We take the view that technically, particularly gold, but also silver, became a bit overstretched, overextended. There was a build-up, a re-acceleration of options trading around precious metals. And so this can be seen as effectively a cooling off and a return back towards trend lines, which still look quite positive on a strategic longer-term basis. So we're actually looking at the price action and having sort of locked in some gains at high levels earlier on to see what kind of levels we think represent a better re-entry point. But the drivers of why gold and other precious metals have performed very well over the last 1 to 2 years are still intact. A geopolitical outlook that's somewhat uncertain, a bit fragmented, both fiscal and monetary policy that are skewing towards easing of financial conditions, no real credible plan by some of the major government debt issuers around fiscal retrenchment, and also some question marks remaining around the inflation outlook and the extent to which central banks are looking to diversify their US dollar denominated reserves away from paper towards gold and other physical commodities.
All right. Hi, Mark. Good morning and good to see you. And as always, what about global equity markets? I recall you telling us that you have a fair bit of exposure to Asia, India included as well. As of now, how are you approaching global markets? If you could tell us between, the emerging market basket, developed markets, and where does India fit in? We have argued in the past about valuation reset. Some part of that has happened. Your view on India?
Yeah, at a global level, we have to recognize that the equity markets have performed very strongly in the last few months. Some signs of the early stage of a bit of a melt up. And in that situation, what we're trying to do is participate in that move, but not apply additional capital freely and broadly across any parts of markets. We're starting to get a bit more selective with capital deployment. In an Asian context, we think that Singapore equity still looks strong. The MAS program to encourage deepening and broadening of local equity markets is a positive catalyst. We also recognize that India has seen some stabilization and some recent relative performance momentum. We remain neutral there, but we like it as a diversifier away from the more cyclical markets, such as Northern Asian markets, which have had a very strong cyclical move in the last few months, but perhaps might be at risk of profit taking, particularly in Korea as an example, where, again, from a technical point of view, the market does look stretched in the short term, even though there are reasons to be constructive and positive on a more medium-term basis as well.
Okay, all right, Mark, we'll leave it there. Thanks very much for joining us. Good speaking with you. Appreciate your time here on CNBC-TV18. Well, let me just quickly run you through what the interactions are, which are lined up here over the next 2.5 hours. 8:35, Ashish Somaya, Vito Capital AMC, Sandeep Bagla of Trust Mutual Fund join in. SEBI's proposed an overhaul of India's mutual fund fee structure. So implications there. 9 o'clock, we'll have Rajesh Ravi of HDFC Securities to discuss the second quarter earnings of Shree Cement. 9:20, Pratik Gupta of Kotak Institutional Equities is our market master of the day. 9:35, Abhishek Dadu of Ketan and Company and Sandeep Parekh of FinSec Law Advisors join in on what happened yesterday, which is a 4-hour delay in trading to start on MCX. Management of Orkla India will be chatting to us. That's the IPO, which is opening, raising about nearly 1,700 crore rupees. Towards the end of the program, it's the economy. Latha in conversation with Jonathan Barrett of ETO Markets and Kishore Narane of Motilal Oswal Commodity Brokers. So commodities in focus there.
Time to slip into a quick break. Got a lot of stock-specific action track for you in our special Top 10 segment. I give you a sneak peek. Tata Capital, Mahindra Financial, Credit Access Grameen, Premier Energies, Blue Dart, all of them will be reacting to positive news flow. Add to the list DCM Shriram and CAMS. On the flip side, the asset management companies, Shree Cement and Jindal Steel could be reacting to negative news flow. Stay with us. We'll get into further detail on all of these names.
Welcome back. So the implied open has been telling us that we'll probably have a positive start to the effect of about almost 80 points because the markets in Asia that are trading, the big ones like Japan, are actually having a pretty good morning, and there's a lot of hope and expectation ahead of the Fed meeting as well. The Fed is expected to deliver that 25 basis points rate cut. So there you go, 80 points higher. Now it's time to talk individual stocks. So as always, let's go across to our team for the CNBC-TV18 list of top stocks to watch. And topping that list will be all the AMCs, the asset managers, because SEBI is proposing quite a critical overhaul of the expenses that these asset managers can charge us, the investor. And there could be a reduction here. Sonal has all the details. Sonal.
Well, yes, there are a slew of reforms that the SEBI has proposed. Let me talk about the most important ones. The first one is the proposal to remove additional expenses to the tune of 5 basis points on entire AUM. Now, remember, this was done back in 2018. SEBI proposes to remove it. And Jeffrey says that if there is a cut of around 5 basis points in this, it could impact AMC profits by as much as 30 to 33% if it is implemented by FY27. So that's a negative. They've also proposed lowering the cap on brokerage fees which is paid by mutual funds to brokers when they buy those stocks in the portfolio, right? So cash market transaction that is proposed to be slashed to 2 basis points versus 12 basis points, for derivatives to 1 basis points versus 5 basis points, on which Jeffrey says if implemented, not only for AMCs, it will be negative for institutional brokers as well. 361, Nuvama, all these stocks also will be on our radar. They have proposed reduction of expense ratio by 15 basis points for open-ended scheme, up to 25 basis points for closed-ended schemes. Additionally, they've also said that statutory levies like STT, there's GST, stamp duty, earlier they were a part of the TER or the total expense ratio. Now they will have to be given separately or shown separately to bring in more transparency. But again, these are just proposals. There are comments invited. The last day is 17 November. But yes, on the back of these, AMC stocks will be in focus today.
Thanks for that, Sonal. In fact, we'll have Ashish Sumaya, White Oak Capital AMC, and Sandeep Bagla, CEO of Trust Mutual Fund, who will be joining in shortly to further analyze the impact of this. So stay tuned for that conversation. Getting back to earnings then, I'm looking at Shree Cement, and the stock could react negatively actually to the results that came out. But if you look at it in the last 1 month or so, the stock actually has underperformed. The Nifty is up close to around 4.5 to 5%, while Shree Cement actually is down close to around 3.5% or thereabouts just in the last 1 month. So the street is anticipating some kind of weakness. Top line was a little better or in line with what the street was working with. The EBITDA was a miss, and that's why margins were a miss as well, and that's why the profitability was a miss. Let's tell you why the top line actually was relatively better. Well, the volume growth was actually quite heartening. Close to around 7% volume growth is what we saw, which is good, 6.8%, which is encouraging. They're growing in line with the market. Remember, in the past, they've been growing, at a pace that's lower than the market. So this time around, that was positive. Even if you look at the premium sales as a percentage of their trade sales mix, that's moved up. That's good as well, which explains why the top line was in line. The problem is in terms of profitability. The cost actually have spiked up more than anticipated, and that's why the EBITDA per ton came in closer to around 1,050 rupees. There was a 30 rupees per ton one-time impact. So even then, it will be close to around 1,100. Which is lower than what the street was working with if you look at it, in comparison to what they did in the previous quarter. Other expenditure went up, and that's what hurt them. So net-net, the stock could open up in the red, but the street was anticipating some kind of weakness in those numbers. And also that 80 million ton target in terms of capacity has been pushed back by a year or so. So expect the stock to react negatively, and then maybe, in fact, we do see some kind of buying at lower levels. Going to Gaurav, though, he's tracking Tata Capital. Gaurav?
Well, as Tata Capital, when we look at the numbers, inline set of numbers is what we call, remember, this is the first quarter where they are actually reporting their numbers post their listing. When we look at the numbers, net interest income that increased almost by 17%, PPOP growth was at around 12%, almost in line. And when it comes to profit, that declined almost by 3% on a year-on-year basis, but it was actually expected by brokerages. In fact, when we look at provisions, they have now declined on a sequential basis. And as a result, when we look at credit cost, that has gone down almost by 30 basis points. ROAs, they have improved almost by 10 basis points, and when it comes to net interest margins, they have also improved almost by 10 basis points. Now going ahead, another key thing which will keep the stock in focus is that they have given guidance for FY26, which is actually optimistic. When it comes to AUM growth, they are saying 18 to 20% growth is what we can expect, and at the same time, credit cost, they are likely to see that credit cost is going to go down almost to 1.2% versus what it is right now at 1.3%. ROA, they are guiding between 2 to 2.1% versus what it is right now at 1.9%. And lastly, when we look at profit growth, they are expecting 35% growth on a year-on-year basis. Remember, they have reported decline of around 3% in this quarter. So definitely an optimistic target is what they have kept for FY26, and this is what will keep the stock in focus today.
All right, thanks a lot for that, Gaurav. Well, I'm looking at Jindal Steel. And in yesterday's trading session, the street seems to be sniffing good numbers. The stock ended virtually at the high point of the day. But the numbers, actually they're a little bit low on adjusted basis. Let me explain. Top line, more or less in line or mildly better. The reported EBITDA number was better than what the street was working with, and so were the margins as well. And the profit number more or less in line. But the adjusted EBITDA number needs to be taken note of. And in that case, it was actually a little bit lower. So the run-up in the stock then, could result in the stock actually seeing some red just to kickstart trade today. Because there was a forex gain of close to around 200 crores, which is much higher on a year-on-year as well as on a sequential basis. And the volume parameter, there was not expected to be any kind of big operating leverage playing out because they had a shutdown and also they're expanding capacity out there. The adjusted EBITDA, well, that as well, did come in lower than what the street was working with. That's a standalone business that we're talking about. And the EBITDA per ton number was lower than the 10,000 rupees odd that we were forecasting. Some part of the additional cost will be because of startup costs since they're expanding capacity out there. So the numbers actually, going by the kind of stock reaction that we saw yesterday, I mean the preemption that we saw, the stock ended higher in trade yesterday. The numbers are not that big a beat, in fact a little bit lower. But what is good to see is the capacity expansion is progressing well. And the net debt actually had come down marginally, though they've incurred a massive capex as they scale up capacity. So going with red on Jindal Steel, but possibly the stock sees some kind of bottom fishing during the trading session. Going back to Gaurav, Mahindra Financial and Credit Access Grameen. Gaurav, take it away.
Well, let's begin with Mahindra & Mahindra Financials. When we look at the numbers, those were actually higher than expected. So let me quickly take you through the numbers. Net interest income that increased almost by 23%, PPOP growth of around 25%, and when it comes to profit, it grew almost by 54% on a year-on-year basis. What remains a key thing to watch out is that net interest margins, they have expanded almost by 23 basis points, and at the same time, when we look at credit costs now, although it has increased almost by 30 basis points, it was actually expected because they had already given some shade on that during the quarterly updates. Another thing to highlight is that during the con call, they are saying that AUM growth is going to remain somewhere in the range of 15% for FY26. Net interest margins, they are going to be in the range of 7%, and credit cost will remain in the range of 1.7%. So definitely, in terms of guidance also, they are being a bit optimistic. Apart from that, when we look at Credit Access Grameen, numbers look great. When we look at net interest income, we saw 4% growth. In fact, PAT, that has declined almost by 34%, but on a sequential basis, we are seeing an uptick. What is a key thing is that when we look at the con call highlights, during the con call, they have said that credit cost guidance that they have given of around 5.5 to 6%. In this year, they see 70 to 100 basis point of upside risk to that. And at the same time, another optimistic guidance that they have given for FY27 is that ROAs are going to be in the range of 4 to 4.5%. Now, this will be aided by 20% growth as per them. Remember, their loan book growth was at around 3% in this quarter. So definitely optimistic guidance for FY27 for Credit Access Grameen as well. And on the back of that, we will be watching out on this stock.
All right, Gaurav, thanks very much for that. Stock's done very, very well. Basically, it's almost doubled from the lows of a few months back, actually. So almost 1,500 rupees now, but 750 or so where the stock had fallen to. Premier Energies is the next one we want to focus on. Vivek is here with the numbers which came through. Vivek, over to you.
Well, good morning. That's right. So Premier Energies, again, a good quarter for the company. Revenues have jumped up over 20% on a year-on-year basis over the 1,830 crore mark, now led by operating leverage benefits and also tight cost controls. EBITDA has jumped up over 47% over the 560 crore mark. Now, EBITDA margins too has expanded almost 500 basis points on a year-on-year basis. On the back of that, profitability higher by 71%. Now, the key positive from this particular Q2 is the fact that there has been significant order book addition from Q1 to Q2. So order book now stands at almost 13,215 crore versus just over 8,600 crore, on a sequential basis. So that is significant order book accretion. Now, when you're talking about the new bookings, almost 6,483 crore, and the order book volume right now is at 9.1 gigawatts. So strong results across all parameters. And also the company has ventured into new segments, which is something that investors will be key to watch out for, how those can scale up.
Okay, so we'll keep Premier on our radar. Vivek, thank you very much for that. Let's head across to Manglam. Blue Dart's numbers came through. Manglam, how do they look?
Well, so second quarter is seasonally the weakest for logistics companies, and this time around there were a few disruptions, etc. as well when it came to rains. But despite that, the company actually did fairly well, a 7% revenue growth. But look at the operational performance, 15.5% growth in the EBITDA, which meant that the margins expanded by over 100 basis points, and the net profit grew nearly 30%. More importantly, where we are at right now, the business end of the year, the third quarter, is fairly strong seasonally for all these logistics companies because of the festive season. And now the fourth quarter as well, start January. Remember, they had announced a price hike, which is their annual price hike of almost 9 to 12%. So that's a positive. So next 2 quarters look positive for Blue Dart as well. And the second quarter, which is seasonally weak, in which they showed operational improvement, I'm going with green for that one.
Okay, all right. Mangalam, thanks a lot for that. Well, let's go across to Sonal. She's here to tell us about DCM Shriram and CAMS. Hey, Sonal.
Well, yes, both of them reported numbers. For DCM Shriram, looked good on a YOY basis, but do remember they had made an acquisition of Hindustan Specialty Chemicals, and that's why the numbers look elevated. Revenues up 20.6%, EBITDA up 71%, margins at 9.4%, and net profit also at 160 crore rupees versus 63 crore rupees. How much was the impact is something we'll understand from the management today. But they've also proposed acquisition of Saltworks for backward integration in one of their segments, and the acquisition cost is around 175 crore rupees. For CAMS, it was an all-time high quarterly revenue of 376 crore rupees, which was up 6.5% on a sequential basis. EBITDA was also up 8.5% on a quarter-on-quarter basis, with margin expansion of 93 basis points. Their profits also went up by 5.5%, so going green with CAMS as well.
Okay, all right, got that. Sonal, thanks very much. Let's quickly recap our list of top stocks to watch, the ones that have positive news flow around them. Tata Capital, M&M Financial, Credit Access Grameen, Premier Energies, Blue Dart, DCM, Shriram and CAMS. Stocks with negative news flow, of course, would be the asset management companies. There is, of course, Shree Cement and Jindal Steel as well potentially on the red side today. Okay, well, with that, let's hop across to Manisha to figure out what's the latest in the commodity markets. We know that precious metals have been cooling off. Manisha, what's the big headline? And before we get to that, I mean, all okay finally with MCX?
Oh, yes. We would know that very, very shortly, 9 a.m. and when it opens. And yesterday, after 1:25 p.m., after the exchange open, it was a smooth trading with volumes coming back to as normal as what we see every day. And 9 a.m. is what we'll know on how that starts. But having said that, if you look at the commodity prices, well, I have to talk about copper and start with that first because copper is the new gold, remember, and we've seen a lot of money come into this one. We are trading near record highs for this. We are just about less than $100 away from an all-time high into this one, a 4% of a jump on a week-on-week and 7% up in this month itself. Well, apart from all the supply concerns and mine concerns that we seem to be getting in from Chile and Peru and Indonesia and Congo for that matter, it also has to do with the strong demand expectations coming in from China. Their plenum meeting clearly says that they're going to be looking at tech and manufacturing. So tech, when you talk about that, copper is going to be a big contribution into that. So that is where copper seems to be getting support from. In the other commodities, it is the crude oil prices you need to keep an eye on. 3 days of constant decline and $60 a barrel has broken on the lower side for the WTI prices now. It's going to be a third monthly decline coming in from prices, especially after OPEC says that they are considering another output hike in its upcoming meeting. Street also will watch out for the US and China trade talks. There have been various statements coming in from that, but majorly it is, of course, going to be about the US Fed meeting announcement today in the evening, and that is where most asset classes would get their cues from.
Manisha, thank you very much for that, and that's the big one, but that's later in the US session. We'll take a quick commercial break here. We're going to come back with Amnish Agarwal of PL Capital for some fundamental stock conversation. We'll also have Ashish Somaya and Sandeep Bagla to talk about SEBI's proposals, draft regulations as far as mutual funds are concerned. Stay tuned.
Welcome back. Well, as promised, let's get to some fundamental analysis then on the stocks that will be reacting to results first up. Then we'll discuss the AMC, part of business. Amnish Agarwal, Director Institutional Research at PL Capital, joins us on the show. Hi, Amnish. Thanks a lot for joining in. Let's address a couple of big numbers, the ones that I track in particular. JSPL, what's the view out there? Yesterday, the street seemed to be sniffing something. And the street has gone into this bullish train on metals. And with metals, you don't look at valuations, look at momentum. However, the numbers appear a little bit subpar. What's your view on it?
You see, the metals, people are actually talking about a structural story whereby the overall capacity addition, even at a global level, has been on the low side. And that is why the analysts are of the view that in the longer term, the metal prices cannot remain where they are. And as the prices go up, then eventually whatever incremental comes will flow into the bottom line. In the near term, whatever the profitability increase we have seen even in 1Q, 2Q, so that is more or less propelled by the higher margins due to the benign input prices. So as of now, I think it is like a mixed bag. The volumes have not been, I would say, that great for the industry, even in the 2Q, maybe due to extended rains and all. Even the pricing has been under pressure. And for JCPL, the prices of, say, your longs, where they are very strong, so that has also been an issue in the recent past. However, the capacity expansion, I think that seems to be, you can say, on track. So I think once the capacity comes on stream and you have got more, you can say, volumes to play around, and you're expected, you can say, prices likely to be, you can say, firm in the medium to long term, that is what is actually driving the steel stocks. In the near term, yes, due to the soft prices or demand, there could be, you can say, variations in the stock. I think on a broad base across, you can say, steel stocks, but the medium term outlook remains positive on the steel companies.
Okay. Amnish, do you track Premier Energies? The numbers look very good. Q2 numbers.
No, we have not been looking at that.
Okay, you don't track that stock. What about this proposed regulatory change for asset management companies? I mean, they don't have that additional 5 basis points they could charge, in case of exit loads. Now they can't charge 12 basis points for brokerage. It has been capped at 2 basis points. So, I mean, first glance, it seems a little negative. What's your read-through?
You see, as far as AMCs are concerned, there have been changes in the regulation in the past also. But if you look at, say, the recent one where, first of all, the exit loads you cannot charge, and then the brokerage has been capped at 2 bits. Now, if you look at, say, your first the exit loads, I think there would be, you can say, some sort of a pass-through which might actually happen, because once anyone exits, there's a cost actually associated with that. So that is one. The second is on your brokerage, which is 2 bips. I think 2 bips actually it is a bigger worry for the broking industry than for the mutual fund industry. But having said that, my sense is that the average brokerage rates now in the domestic industry, that won't be more than 6-7 bips. So there could be, you can say, some impact of that, but that I think 2 bips is something which is something like unsustainable. And how the industry tackles it remains to be seen, both on the broking side as well as on the AMC side.
Well, here, I don't know, Amnish, if they'll find a workaround, because SEBI's rationale is that, look, if you're saying that this is 12 basis points because it's broking cost plus research, then that's not fair, because you're charging for research separately in the expense ratio anyway. So, I mean, I don't know if there's a workaround. But anyway, purely in terms of stocks, do you have any picks in the space from the mutual funds that are listed?
You see, on the mutual fund side, I think we are tracking most of the important names, and here particularly HDFC, AMC. I think that is one stock which looks interesting, followed by Nippon AMC.
That's what I'm saying. Actually, we should look at some of these stocks. You've got HDFC AMC, which is up on your screen. Look at UTI AMC. Just put these stocks up. Nippon, we should pull up as well. And a bunch of others. Actually, even distributors, there's one large distributor which is listed, Prudent, which also we should pull up. The chart we should pull up. And of course, I mean, brokers, but the impact perhaps will be more on brokers. But, in terms of the ones which are listed, I think most are on the retail side. your sort of Motilal Oswal. Motilal, of course, has institutional broking as well. But, in terms of trying to assess the implication for the business overall, because they've got so many other things as well. So pure institutional brokers who are listed, there aren't many. We'll be, by the way, speaking to Kotak Institutional Equities a little later, 9:15 maybe. That they'll be a good sort of a person to ask what the implication on the broking side is really. Nuvama 361, these are the other ones which we should kind of look at as well, because they also have a lot of distribution business. So have companies like Motilal Oswal, etc. Remember, this is, all this was, these proposals did come through a couple of years back. They didn't go anywhere. These draft regulations came, but they didn't really go anywhere. Now they're back on the table. These are draft regulations, but the general implication across the board is going to be of reducing earnings across the value chain. For investors, for you and me, it basically means lower expense ratio, lower TER, so lower costs of buying mutual fund units, but varying degrees of impact across the board with regards to the ecosystem, which is mutual funds, broking, and of course distribution as well.
So just to simplify this for our viewers, essentially two parts to this. What is the regulator essentially saying? The regulator is saying that when you talk about the expense ratio for fund, that expense ratio includes all the costs involved with managing that fund, including the fee that's paid to the fund manager, their expertise, the in-house research, etc. So then if you say that I have to pay 12 basis points as brokerage, because that includes research which the broker is providing, then that in effect is double charging for research, and that the regulator feels perhaps is not that fair. That's one part of it. The other part of it is making sure all the statutory levies, which is GST, which is CTT, which could be stamp duty, all of these levies now have to be X of the expense ratio. So it's very, very transparent.
GST is already X.
GST is already X.
The other statutory expenses are
part of the
They have to be separated.
Now they have to be separated.
The bigger implication for mutual funds is that a 5 basis point, which is that exit load. Let's actually bring in Ashish Somaya, who's with us of Vito Capital. We also have Sandeep Bagla of Trust Mutual Fund. Gentlemen, great to have both of you here. Good morning. Ashish, you're the man with all these numbers on your fingertips in terms of how the costs break up, because you've run the business and you are running the business. So implication across the value chain with what has been proposed now, if this were to go through.
So first up, Prashant, I was listening to you, and I think obviously the key takeaway is that for let's say you and me as investors and our viewers at large, it's really positive on two counts. One is obviously because mutual funds do have transactions and turnover. Buy-sell trades. And obviously, if you assume, of course, the cost incurred was not actually 12 basis points. On an average, it would be lower. But net, if they're saying that the cap is down from 12 to 2, a couple of clarifications. First, of course, it will reduce the cost of transaction, and to that extent, the alpha generated by funds to that extent should actually go up, because the benefit will go to investors. Second thing is that if you think of brokerage or whatever is paid to brokers as 12 bips, it's not entirely paid to brokers, because there are components like exchange fees and stamp duties and STT and so many things out there. So it's not like 12 becoming 2. It will be more like, say, as per the regulatory paper, if it was 10, it might become like 4, 5, 6 or something like that. It will settle at, because everything doesn't go to the broker. What the broker bills, there are further components into it which go to exchange and stamp duty and all those kinds of things. But yes, that will benefit investors. The second thing to keep in mind is that when you look at the, statutory levies within the TER other than this. So like you rightly pointed out, GST on the management fee was outside the TER, but let's also understand that there are various other components of operating expenses that we pay. Depending on the size of the fund, we may be paying anywhere between 8 up to 14, 15 bips as operating expense. And that has, say, the registrar's fees, it has the custodian's fees, a lot of other operating expenses we incur. Everything has a GST component in it. So for a moment, if I say that the OPEX is 12 basis points, you must assume that it is more like 9.5 plus 2.5, something like that. Because that 2 to 2.5 basis point of statutory levies, which is there in all the OPEX, that was also going from TER. So that has to be actually moved out. Then obviously one needs to wait for, further straightening out or, clarification on this. But there are other components in the TER also where there is a GST, which was actually hidden inside the TER. So net, lot of rationalization. And
what about that 5%, Ashish? 5% on
5 bips.
I think that 5 on exit load, which you could charge, right?
Yes.
But that basically, it was not there pre-2012, right? So you're basically going back to that regime. It was introduced, I think, in 2012.
It was brought in when exit loads were removed in 2012.
Yes.
In lieu of that, it was 20 basis points and it was reduced to 5 basis points in 2018. And now it has been abolished. So how big a hit is that, Ashish?
Yes. So yes, that's what I'm saying, that net, I think the TERs will go down. There is no doubt about it, because while the regulator has said that we are trying to remove all these components from the TER, and to that, so if that becomes X TER, then we are trying to reduce the TER and remove these components and make them TER++. But
is it bad for business, Ashish? That's the simple question. Now that you can't charge this additional 5 basis points and all the other statutory charges have to go out of TER, I mean, if you look at the rationale the regulator has put out, it seems very clear, very clear. So I want to know how much is the expense ratio, GST, stamp duty, etc. is all plus.
Yes,
and
I think that.
Yeah.
Sorry. So you're right that at least that 5 basis points plus a bit more. So that will be, I mean, it depends what the AMCs take a hit and how is it shared with the channel going forward. But for the investor, I think the TERs will come down even after making all these adjustments of removing from TER, adding plus, etc. Net TER will go down. So the industry has to, figure out how to absorb that.
This is, gentlemen, I don't know if you agree, Europe has this MiFID regulation, right, which was brought about a few years ago. This is like India's MiFID moment. If this goes through, Ashish, you would agree?
Yeah, I mean, to an extent, it is looking like moving in that direction, especially when you talk about the cost of transacting and, brokerages, etc. But I think, over a number of years, what has happened is, as asset management companies' scale and size has increased, people have invested heavily into research, right? And not just the large AMCs, even, players like us, say we are more like 10 billion in size, but even we have a very large research team. At the same time, I would say that brokers don't just do transactions. I mean, there is definitely a lot of value addition, but I think we have to, arrive at some kind of working equation.
Okay, Mr. Bagla is also with us. Now, Mr. Bagla, you tell us, I'm asking a very simple question. Does this impact profitability? Will profits and margins for asset managers come under stress? That's the big question that shareholders of listed AMCs need answers to.
So, SEBI has proposed that what we charge, the total expense ratio, be reduced by 15 to 20 basis points. And lion's share would probably be reduction in distributor fees also. And some of the expenses like GST, STT, CTT are now allowed to get charged. So the impact will not be as much as the top line suggests. And it depends on how much distributor fees are also compressed by the AMCs. So in the short run, yes, there would be an impact in terms of lower fees when this goes through. But over a small to medium period of time, I think it will adjust. And if, looking at the growth at which the mutual fund industry is growing, I think we will see it as a small blip in the longer term.
Ashish, comment on this point. I mean, it essentially boils down to just this, right? How much can you compensate by lowering the distribution fee and the commissions, and how much can the AMCs absorb? Right now, I know it's very early days. If this goes through, can 50% be absorbed and, the share is 50-50 between distributors and the product manufacturers? How will it play out? The hit.
So listen, I think that 5 basis points plus, that 10 to 15 basis points depending on slab. So let's say that net the regulator has spoken about reducing about, say, 15 to 18 basis points, right? And then let's say we benefit 2-3 basis points because a lot of the stuff which we're absorbing goes outside the TER. So I think, all told, if you really ask me, the industry has to contend with figuring out how to manage this. I think it will be 10-12 basis points, not more, which is what the knock will be. But 10-12 basis points is a significant number. And yes, within that, clearly, we have to arrive at an equation. Now, different players will have different equation with the channel partners, but it will have to be split. Because ultimately, if let us say on an average 60% is going to the channel partner and 40% is going to the AMC in terms of retention, then it's only fair that even the knock is split accordingly. So I think that will be the bare minimum. So ultimately, when you ask about AMCs, it will boil down to low single-digit basis points of impact.
Yeah. And of course, I mean, the larger AMCs will be better off. The smaller ones, upstarts, and a lot of new licenses, etc., coming in as well as they try and build up assets, etc. I mean, the impact will be more naturally. We'll leave it at that, gentlemen. Good perspective on this matter, Ashish and Sandeep. Great speaking with both of you. Thank you very much for joining us. We'll take a quick commercial break here. We're going to come back with a focus on the big movers on the Lal Street yesterday, and of course the volume, price action, etc. Stay tuned. Coming up. Okay, welcome back. 7 minutes to go for the pre-open session. Let's bring in Sud now, who's looked at the big movers from yesterday and, of course, the delivery stats, volumes, etc. So take it away.
So first on the list is Carter Technologies, which has reported Q2 earnings yesterday, and those earnings looked very strong, in which margin was 33% versus 21% in the same quarter last year. And now company is saying that it's targeting margin in the range of 55 to 56% in the near term. And as far as the stock move is concerned, yesterday's gain, single-day gain, was highest in last 2 years that company has seen. And the last 1 year, stock has almost tripled. Now, as far as the total volumes, 57 lakh shares saw change of hands on Tuesday versus 20-day average of just 6 lakh, and of total volumes, 8 lakh shares were marked for delivery versus 20-day average of 1 lakh, and this delivery volume that you have seen of 8 lakh, that was highest in last 2 months for car trade technology. Second, Newgen, again, this also has seen a big move after Q2 earnings, and those earnings were very strong. It's the 5th time in 2025 the stock has seen a gain of more than 10% in a single day. And on volume front, 1 crore shares traded on Tuesday versus 20-day average of just 11 lakh, and 12 lakh shares were marked for delivery versus average of 2 lakhs, and this delivery volume was highest in last 1 year. Another interesting name is IFB Agro. Remember that company is going to report its earnings on October 31st. And ahead of that, in last 3 sessions, company has been seeing a big move and has gained in the range of 7 to 9% on each day in the last 3 months. And in the last 6 months, stock has almost tripled, and it's up more than 200% from 52 low that stock has seen in April of 2025. Yesterday, it saw volume of more than 3 lakh shares versus 20-day average of just 80,000, and 7 lakh shares were marked for delivery versus just average of 20,000. So these are the 3 stocks that had seen big volumes.
Okay, all right, sir. Thanks a lot for that. Well, we're still in conversation with Amnish Agarwal. Amnish, what about some of these companies that came out from the NBFC space, Mahindra & Mahindra Financial Services, Credit Access Grameen? Did you have a look at those numbers, and what do you like from that space?
I think the NBFC space actually should gain incrementally going forward because, first of all, your NIM expansion should happen. That is one. The second thing to look is that in the broader NBFC space, because the consumption demand is expected to improve. Now, whether these are, you can say, the funding of PVs, whether these are durables, whether these are, you can say, some of the other autos. So I think this entire space should see, particularly on the NBFC side, which are catering to all the consumer as well as auto segments, I think they should see some pickup in their credit growth in the coming months. So that should actually result in the better numbers coming from most of the NBFCs in the second half of the year. And I think as the overall momentum in the economy improves, I think even the stress factors from the bottom end, so that should also be solved.
All right.
In NBFC space, Bajaj and Chola are the 2 stocks which we like at the present juncture.
Got it. Okay. All right. Amnish, thanks a lot for joining in. Wishing you a good day ahead. And we chat up, rather soon. For the time being, slip into a short break. Come back. Pre-open rate will be with us. We'll also be joined by Sudarshan as well as Mitesh, who will give us the technical calls.
Okay, well, market pre-open coming up any time now, and let's just look at we will look at the rates in a bit from now as things settle down. Sudarshan Sukhani is with us, so is Mitesh Thakur with what they'd want you to do in terms of trades this morning. 30 points higher, I think is the first indicative rate as it starts to appear. So quiet, and yesterday's close was also not quiet. I mean, there's the final close looks very quiet, but it was anything but quiet. Last 30-40 minutes, both Nifty Bank saw sharp recoveries. Sudarshan, Mitesh, good morning again. What would you do, Sudarshan? What's the advice on indices?
Yeah, good morning. See, the advice is the same. The trend is up. We had a very sharp correction last week. That's behind us. Yesterday's movement should be ignored because it was options expiry weekly as well as monthly. So strange things can happen. That doesn't disturb the larger trend. So with an uptrend in place, we want to be buyers. If you have long positions, stay with them. If you don't, buy on a dip. Buy on small corrections. You know, yesterday was a dip. If you have the courage to buy it, keep a stop at 25,800 and then let the market take over.
Okay, got it. Thanks for that, Sudarshan. Mitesh, coming across to you. What's your view? We're coming after a solid, it was an Oktoberfest actually, a very good. You have 5% return on the index itself. Where are we headed from here? I think that 26,300 mark seems to be like a bit of a resistance. But what's your take? Nifty Bank.
Good morning, Nigel. I think that's the level, which I'm watching. Actually, 26,200, give and take a 30-40 point kind of range because I was working more on the closing charts. But broadly, the direction is positive for me. And therefore, I think, after a good October, if you get a couple of days of consolidation, and within that, if you get pulled back to about 25,600, I think that would be an area where I would want to explore aggressive long positions. And once we get past this 26,200, 250 areas, then I think, we might look at the rally continuing and extending much on the upside.
Okay, let's get to individual stocks then. Mitesh, you go first.
So I have more of buy calls today, 3 longs to a sell. On the buying side is BHEL, which I would recommend buying the stop at 234 for a target of 245. JSW Steel made a fresh swing high, so buy the stop at 1164. Look for targets of 1230. And UPL had a good price volume action yesterday, so buy here at the stop at 683 for a slightly positional target of 740. One sell call, that's NHPC. Keep a stop above 86 and look for target of 81.
Got it. Okay. What about you, Sudarshan?
Well, it's an all-buy list. LIC is a buy with a stop under 885. LIC has a very attractive chart. So if you're looking for a positional trade, some kind of a short-term investment, it qualifies. Titagarh is a buying opportunity with a stop under 880. Chambal Fertilizers, which rarely comes in my list, is a buy with a stop under 480. And finally, SAIL, Steel Authority, is a buy with a stop under 130.
Got it. Okay. All right. Thanks a lot, gentlemen, for that. Well, let's focus on the cement pack. And Shree Cement is a stock that will be reacting to its numbers. Let's pull up, we'll get the pre-open rate in just a bit. The numbers actually were a little bit disappointing. There's no volume actually in pre-open. And if you look at it in the last month or so, the stock has underperformed what the Nifty has done by close to around 8%. Top line, well, that was in line, a little bit better. But EBITDA performance as well as margins were a little bit lower. Now, on the top line, the reason that it was a little bit better is because they grew by close to 7% on volumes. Remember, they have been mentioning value over volumes. But this time around, volumes are good as well, which is industry growth rate a little bit better. So good on that. That means they haven't lost market share. Also, what supported the top line was the premium products as a percentage of the trade mix. Well, that's moved up as well. So that obviously supports realizations as well. The problem was on the EBITDA per ton front. And yes, there was a one-time hit of close to around 30 rupees per ton. But even taking that into account, the EBITDA per ton number was actually a miss in comparison to expectations because other expenditure did spike up. It was because of higher repair as well as maintenance cost that hurt their profitability out there. So the numbers go down as a bit of a miss. The street seems to have anticipated that. Also with regard to their 80 million ton capacity target, it seems from around 2028, now it's been pushed to around 2029. To help us out with a quick analysis and what's the view out there, we have Rajesh Ravi, institutional research analyst, who joins us on the show. Hi Rajesh, good morning, good to see you in. What's your view? Shree Cement, I was just looking at the chart, actually the stock had corrected more than 10% from the 52-week high. These numbers appear a little bit soft. The bigger problem is you have Ultratech Cement that's gradually getting more aggressive in North India. What's your take on Shree Cement first?
Hi, good morning, Nigel. Shree Cement, yes, this quarter, see, they're disappointed on the results. EBITDA is down 10% versus ours and consensus numbers. So, as you mentioned in your opening remarks, they are focusing more on value over volume, and that has reflected. If you look at the 6 quarters volume, that has been more or less flattish, whereas the industry has grown at 4 to 5% CAGR in the past 6 quarters. So, and during the call yesterday, the management did note that their focus on value has yielded them in resulting better realization growth even during H1, which is around 9% vis-a-vis the industry. If you look at even Ultratech and all the other reports, results which have come through so far, their realization growth is sub 5% on an average. So that is what is yielding into this healthy margins compared to the industry. However, at some point in time, because the management did hint that they want to grow faster than the industry, this value over volume strategy need to be moderated at some point in time. This is one. Second, on the expansions front, the management did indicate that they are not in a hurry to target that 80 million ton and even can be pushed into FY29 if that be the case.
Okay, so but what is your view on the stock official rating that you have, Rajesh? And also, for the last many years that we have been talking, I think close to around 10 years, Shree Cement always highest multiple is what they get. Now, some of those, those advantages that they have seem to have skimmed out, whether it's with regard to pet coke usage, whether it's with regard to the lowest cost producer, or whether it's with regard to their dominance in North India, seems to be challenged out there. So what is the multiple you give it and what is your target price?
So you're right. We are valuing it at 17 times, and we have an ad rating currently, with 31,000 odd target price on an average 31,000 target price is what we have. And you're right. The valuation multiple, which Shree Cement has been commanding at the top, the top best multiple in the industry, is now even being, ascribed to companies like Ultratech and even Ambuja. Given that these two players have become aggressive on their volumes and margins front also, they have started to deliver strong margins because they have towed the cost efficiencies line. Shree Cement, incrementally, the cost saving metrics are limited because they're already north of 60% on green power, whereas others are catching up. So over next 1 year, even Ultratech would be reaching close to those numbers. So that is where the delta on cost savings for companies like Ultratech is much higher compared to what Shree Cement would scale from here on. Shree Cement has guided 100 rupees savings from logistics cost, which they will have incrementally coming over 1 to 2 years.
Okay, all right. What about
North Market?
Yeah, North Market.
Yes, North Market, Ultratech in phase 4 expansion, they have announced that they would be adding, out of 23 million ton, large chunk of the expansions will happen in the North and Central market to address the, or peak utilization which the companies are facing in those markets. So that will also have a bearing on everyone, including Shree Cement. Even if you look at Shree Cement performance, while their consolidated utilization would be, for H1, the India utilization would be close to 53-54%. Fair to assume the northern part utilization would be much higher. It is most of the assets in the newer geographies like West and South, their assets are underutilized. And there's a lot of clinker grinding capacities which the company has debottleneck, and that is why the utilizations appear low. So indeed, they will face competition from companies like Ultratech and even Ambuja, which will be scaling up their capacities in these markets.
Okay, very quickly, Rajesh, if you could tell us what is your feedback that you have got on ground. For these cement companies, a little lucky. First quarter is a little soft, then they say second quarter is monsoon, third quarter there's festive season, and that keeps getting kicked down the road. At current reckoning, what is the feedback you've got with regard to demand on ground? What is the demand growth for the industry you're working with? And any price hikes you're working with?
So let me first talk on demand. H1 has been a washout even on a low base. We are looking at 4 to 5% volume growth at best for the H1. October has been a peak festival period, so obviously demand has been subdued. There is hope that the second half should look good in terms of demand, that all the drivers are in place. So, second half, we may grow at 7 to 8%, while the industry is looking at 10% plus. I believe most of them, there could be disappointment on those 10% growth numbers. but 6 to 7% growth should be doable. And we are factoring in on an average volume CAGR for the industry at between 6 to 8%. Coming on the realizations front, October, post GST cut, not only in cement, even in other segments, companies have clearly indicated that government is monitoring the price movement strictly, and obviously cement companies have said that they have passed on the GST benefits fully. We don't see any price increase happening through in next 2 to 3 months.
Yes.
In fact, there has been some softening in prices in the eastern market beyond GST in the month of October, maybe due to the festive dampness and demand. So at best, we should be working at flattish realizations over next, at least in Q3. Q4, there could be some uptick in the later part of the quarter when demand picks up.
Rajesh, always good to hear your thoughts. Thanks a lot for joining in. And as the cement sector results start pouring in, we'll chat up once again in the month of November. Wishing you a good day ahead.
Thank you. Same to you.
Well, let's get in Sudarshan now. He's joining in to give us his 9-10 call. Sudarshan?
Well, it's Chambal Fertilizers buy with a stop under 480.
Mitesh, what about you?
I go to buy on JSW Steel. Look for a target of roughly around 1230.
Okay, got it. JSW Steel, let's stick to the ferrous space. Jindal Steel came out with a set of numbers and the street was sniffing something yesterday. Stock ended high at the high point of the day with a gain of around 3.5%. However, the sniff didn't prove to be right because his numbers actually on the adjusted EBITDA basis, that's X of the Forex gain, actually, as you can see, adjusted EBITDA is a little lower than expectations. The absolute EBITDA or the reported EBITDA actually was a little bit better. So X of that was a bit of a miss. Remember, volumes are expected to be flattish, and that was the case. The adjusted EBITDA, even for the India operation, the standalone business, that came a little bit low at around 1,752 crore rupees, which means the EBITDA per ton came in at sub 9,400 rupees per ton. The street is working with a number of close to around 10,000 rupees. Keep in mind they're expanding capacity, so some part of the startup cost could have impacted them, and that will be one time. As the operation leverage plays out, that actually will gradually get absorbed. So that's why the stock, I think, is opening up with a mild downtick of close to around 1%. The street is looking ahead. Capacity addition is coming on stream. The debt number has come down mildly, keeping in mind that they incurred 2,500 crores of capex, which is heartening. So a mild red tick on this one.
We'll take note of that. Nigel, Jindal Steel in focus. Just a quick recap of some of the stuff that we've addressed since the morning and how they're all settling down in the pre-open session. So these are the AMCs, HDFC, Aditya Birla, Canada, Robeco, etc., down 3-4%. There are others, UTI, Nippon, etc. We should look at brokers as well, and let's just look at Motilal and IIFL and this others like MK, etc., which are also listed.
3.5% lower on Motilal. Nuvama is down 3.5% as well.
Nuvama is a distributor as well. Let's look at Prudent Corporate Advisory. That is Prudent. That is the other one where perhaps there is going to be a bit of a impact, 3% lower on Prudent Corp as well. Okay, now apart from that, Jindal Steel we already mentioned. Shree Cement and Tata Capital are the others which reported numbers, and they'll come up on your screen. So nothing very much going on there.
There's Blue Dart also, Prashant.
Yeah.
In terms of result reactions, the ones that are really showing up, Blue Dart really stands
on
out.
your screen. 6.5% higher at this point in time. M&M Financial Services, Credit Access Grameen, Premier Energies, DCM Shriram, CAMS, all these are set up to open in just a bit from now. First couple of rates in a few seconds from now, 45 points on the Nifty, and we'll see how things are going to go. So 25,980 on the Nifty Bank is at 58,290. The Sensex starts at about 84,700. The small cap index is down 0.2. The mid cap index will also come up on your screen. Absolutely flat, actually, unchanged so far, coming up right now. So 1,300 stocks are higher, about 450 odd stocks are lower. This is basically the advanced decline ratio as things are coming up on your screens. We've got, the Nifty heat map on your screen now, and 40 odd names are higher, and, some 10, 12 names are lower. And it's a positive start overall, all told. Grasim, Max Health, Titan, and one end. And there is a Tata Motors passenger vehicle business, which is, I think the commercial vehicle business shares are in. Should start trading, I guess, in the next week, 2 weeks or so. Bharti, Bajaj Auto, etc. on the other end of the spectrum. So that's the heat map for you. Surabhi.
Okay, this whole MF, TER and charges overhaul, it's causing a lot of heartburn in the market right now. It's proposed changes. Look at Prudent Corp. If I have the right rates on the screen, Prudent is down 16%. The asset managers are, of course, down. That's the one that's taking a big knock, HDFC, AMC. Nippon is down 6%. What else? UTI, AMC is down about 3%. So these are the asset managers, the guys who make the product, the manufacturing, mutual funds. But the whole ecosystem is down. Prudent is probably the largest, I think it is, in terms of volumes, are the largest distributors of MFs in India. And the stock has been down quite a bit. There's IIFL Capital down 8%. There's Novama down 8%. There's Motilal Oswal down 5%. Just recapping the news for you. As of now, the regulator is saying that from the earlier level of 12 basis points is brokerage, now that cap is going to be reduced to just 2 basis points for all the cash market transactions that mutual funds are making. For derivative transactions, the cap is going to be reduced to just 1 basis point that can be charged as brokerage. And that's really, weighing on the entire capital market space, AMCs, brokers, and also some of the distributors. So that's one side of the market which is taking a huge knock. But on the Nifty, on to brighter things. Nifty is still up about 70 points. So let's talk about the winners over here. HDFC Life is 1% up. Grasim 1% higher. Trent and JSW Steel are some of the other names which are up and about. Reliance is having a good morning. 1% on the higher side. There's L&T, which is reporting numbers. 0.6% higher on L&T as well. The entire auto space, by the way, has come in for profit taking this morning. M&M, Bajaj Auto, Eicher Motors, Tata Motors, all in a row, all down between 0.5% to 1%. So auto is profit taking, skidding. The rest of the market's holding up, but mutual funds, their distributors and their brokers, oops. Nigel?
Getting knocked, actually, some of those stocks. By the way, the stock of the morning has to be Mahindra & Mahindra Financial Services. That's the result of the morning. The stock is flying away as we speak, up close to around 6%. I think it's been a while since we said that, this company has reported such strong numbers. So the stock up and about. Sami Hotels, that's the other one that's gaining with a good amount of volumes. JSPL as well as Shree Cement, the numbers are a little bit subdued. Both of them were a little bit lower when the market just started off. But that dip has got bought into. Shree Cement, remember, the street was anticipating weak set of numbers because, it had underperformed. While on JSPL, the street is willing to look ahead. Capacity is coming on stream. Debt is moving down lower. And the street is focusing on basically the ferrous space will see better earnings. So that's why you have, Jindal Steel that's up and about. SAIL, it comes out with a set of numbers. The street is sniffing good set of numbers out here. I've seen in the past when JSPL delivers a weakish set of numbers, SAIL as well as weakish, because both of them have a higher exposure to longs. But this time around, it seems the street is actually sniffing that maybe SAIL could come up with this positive surprise. We'll have to wait by on that front. On the flip side, Cohance, the MD has resigned. That resignation announcement came in post-market hours. Spanked, just take a look at that, 10% lower on that particular name. So big downtick is what we're seeing out there. And IIFL Capital as well. My colleague Yash, in fact, had put out a story yesterday. There could be some fund infusion. We'll have to see the way this fund infusion does take place. But that one, in fact, is down in today's trading session. Another big winner from the broader markets is PPAP Automotive, a very small company. But I don't know that stock is up close to around 10%. We'll have to see volumes not high. So let's avoid that one. But dredging is up close to around 4.5%. So big move out there. And MTAR is another one that's up close to around 4%. So the markets, 50% up. Midcap index more or less flattish, but the number of stocks advancing way more than the number of stocks that are declining.
Okay. I just want to reiterate once again what we've heard from not just experts, but their practitioners themselves, Ashish Sumaya and also Sandeep Bagla of Trust Mutual Fund, both concurring that the hit will, first of all, it will be shared between distributors and product manufacturers. And Ashish has quantified the hit to the extent of just 10 to 12 basis points. Now, that's his calculation. That's one person. But I think Jefferies is saying that it's about 8 to 10% of total earnings. Right, Prashant?
Yeah, 8 to 10% of earnings. And I think they put out something in the morning which was much larger. They've issued a correction in terms of... But I think Ashish was very, very detailed with regards to what's happened. By the way, a friend of mine messaged the equity sell side. Maybe a little dramatic, maybe exaggerating to make a point here. But he said that, well, if these goes through, it's basically... It's a hammer on the equity sell side industry. If say effective sort of rates of brokerage is, say, not 12. 12 goes to 2, but most don't pay 12. They pay, whatever, 6, 8. 8 goes to 2. That's 75% cut to the revenue pool, right?
Yeah.
So time to join investment banking. Let's get in Pratik Gupta, who'll be able to, I guess, weigh in better here because he runs the business, exactly that, CEO and co-head at Kotak Institutional Equities. Pratik, good to have you with us here. Good morning. Thanks very much for joining us. So it's not a market question to begin the day, but just a business question, if you will. And it's not so much about Kotak, but how do you think about what has been proposed with regards to this? It's like that India's MiFID moment. What happened in Europe? So what's your sense, Pratik?
Hi, good morning, Prashant. Yes, you're right. This is somewhat like a MiFID type regulation for the Indian mutual fund industry. And we're still going through the circular, so still trying to better understand the intent behind the circular. Because frankly, the entire mutual fund industry, as well as the broking industry, as well as the distribution industry is fairly competitive. It's not a monopoly or an oligopoly even. So usually regulators should, globally, they tend to don't really interfere in pricing. They focus more on things like regulatory aspects like, processes, insider trading, investor protection, etc. Pricing is left to market forces. So it's a bit surprising that we are seeing pricing caps in India, and that too now being cut very, very sharply. Obviously, the impact would be quite negative for partly the mutual fund industry and also the distributors and brokers who service or who are very heavily dependent on the mutual fund industry. And we've seen this in Europe where, frankly, this has not really worked out as well, and the regulator's been trying to backtrack. But once you've sort of cut the rates and once the end clients get used to not paying for research, not paying for brokerage, very tough to unwind that. Nobody wants to be the first fund in Europe who will start charging for that. It's a very competitive market over there as well. So let's see. I think this, from Kotak's perspective, we're a large firm. We can probably sort of absorb the hit. But I think it'll be very, very negative for some of the smaller brokers and also for some of the smaller mutual funds in particular. And even the larger funds and distributors, they will be impacted to some extent. And I think you will start seeing resources being directed more away from mutual funds towards other categories like PMSs, AIFs, or foreign portfolio investors. So the end retail investor whom I guess SEBI is trying to look after, they may end up perversely getting impacted because they will not get the best quality service or the best quality distribution, etc. So let's see. I mean, I think this similar circular was there 2.5 years ago, somewhat similar, and subsequently it was taken back. So I don't know what will happen this time, but let's wait and watch.
Pratik, hi, morning. So, just to press on this point, then we have, of course, the overall market to address, and we'll get to that in a bit. The regulator's rationale seems to be that, look, why are you charging the end investor twice for research? You're charging him or her once at the expense ratio level, and then you're charging again as part of brokerage. So, I mean, purely thematically, that sounds like a logical argument, but clearly that's not how it's working out. Now, is it the quantum? Say if it was not, the cap was not 12 basis points, if they had, lowered it more gradually, brought it down to 6, 7, would that have been more palatable? And this is still open for discussion, I'm sure. I mean, that's the whole point of having a consultation paper, right? Industry is going to go back to the regulator on this.
Yeah, so I think firstly, let's look at global practices. Other than Europe, most other places it's left to open market forces. And if you go back in the 90s, for example, brokerage rates were as high as 2%, which were bundled rates, including sales, research, execution, everything. And that has gradually come down, even for FPIs, down to 20, 25 bips. And again, it's a function of volume. So it's a free market and brokers charge whatever. Even when we service FIIs, we have different rates for different customers depending on how much servicing they're taking from us, etc. So the best thing in my view is encourage competition, let free market forces prevail, and a gradual. And we have seen even for FPIs, gradually rates coming down. So the end investors, People who invest in the Fidelities and Capitals and Templetons of the world, they have benefited over time from lower brokerage rates. And I'm guessing similarly over there on the distribution side as well. But a gradual, decline would anyway happen. So that would have happened anyway.
Yeah. Got that. Do you have on the research side, now let's get to the market itself. Do you have a view on, capital market theme has been such a big theme, right? And it's created a lot of wealth over the last 4-5 years. Does something like this derail that at all, or you think, the bigger story is financialization of savings. And that corpus perhaps keeps getting bigger and bigger. So that's a compounding story in that sense. Maybe earnings will have to tweak a little lower, but will that get made up by volume? We'll let us see. How would you think about this, Prateek, from a stock perspective?
So firstly, as far as the financialization theme is here to stay, as you said, so therefore the long term on a 5-10 year view perspective, these are great businesses. You will get these regulatory shocks or otherwise other kind of shocks from time to time. But I think the way to think about it, the way at least I would recommend thinking about this is industries or companies which are in somewhat of an oligopolistic or monopolistic position. They're more vulnerable to regulatory intervention when it comes to pricing or, with SEBI or anybody else doing something to control their profitability. So I would obviously, our preference is towards the likes of mutual funds or the wealth businesses where it's an open market, you're competing out there, and if you've got a good business, good product, good people, good service levels, you will hopefully gain market share and continue to benefit from the financialization theme. When it comes to, let's say, exchanges or other kind of market intermediaries which are either monopolistic or oligopolistic in nature, that's where you have to worry a lot more about regulatory intervention. So that's where we would be somewhat careful. The only other point I would make right now is this theme has been talked about quite a lot. These stocks have done very well, and at current valuations, we are finding it a bit difficult to be positive on these from a somewhat of a short-term 1 year kind of a time frame. If you have a slightly longer time frame, then it's fine. But over a 1 year time frame, we think the valuations are now getting a bit expensive.
Okay, valuations are turning a bit expensive. Got that point. Prateek, overall, when we talk about this whole earnings revival, because the entire market is pinned on two things, I guess. One is this trade deal getting finally signed, but more importantly, earnings reviving, right? Now, in which sectors do you see some hint of durable demand pickup and actually some sort of a move towards that elusive double-digit earnings mark? If you could just maybe prioritize and lay out the sectors for us.
So, Surupi, that's actually a challenge. In fact, just this morning, we were discussing in a morning call, TVS Motors has guided that second half auto sales for two-wheeler ICE industry will probably be just 8 or 9% or so. So we're already seeing signs and comments from companies coming around that the GST boost or the festive season boost that we saw in consumer demand, that may be petering out, may not sustain. And the fundamental problem still remains job creation or income growth for a large section of the population. And for that, you need manufacturing. For that, you need exports. You need more formal job creation in the IT services sector, the startup ecosystem, which has slowed down in the last 1 year or so. So therefore, there aren't that many sectors, which is why we're still somewhat cautious on the consumer sector, the entire consumer staples pack, and many of the discretionary names also, we're still somewhat cautious, especially given valuations where these stocks are trading at. Some are still trading at 50 times, 60 times even now. So that's one space we're sort of cautious on. But where we think there might be some hope is the banks. The latest fortnight, you've seen credit growth picking up to about 11.5%. We think with the way the RBI is deregulating or liberalizing a lot of rules and guidelines for the banks, especially the large private banks, we think they're very well positioned. Even some of the mid-sized ones. But the banking sector is one where not only do we expect growth to pick up? Because without credit growth, you will not see the overall economic growth picking up. So that's one. And second, the valuations are also a lot more reasonable compared to, say, 2 years back, and especially compared to the rest of the market. So that's why I think, frankly, banks, insurance, life insurance companies, and maybe hotels, airlines, those kind of companies, telecom, we're expecting ARPU hikes over there. So let me just, pause there for a minute. But those are some of the sectors we like.
Pratik, in interaction with clients, has domestic politics entered the conversation at all? Bihar, etc.? No, not really.
No, not really. Most people are not taking it very seriously. I mean, the general assumption is the incumbent parties will win, which is the BJP-led coalition. So if there is an adverse result, that will be taken as a little bit of a negative, but it's not a major talking point with investors. They are looking more on what is the government likely to do with economic reforms after GST, what are the other reforms they have in mind, and what about government capex and so on. So it's more about those kind of issues. And obviously, there is the global factor about EM funds. When will they start getting money? When will the foreign selling stop? In fact, it seems to have come off, or rather, it's turned around a bit in the last few weeks. So is that sustainable? So that's really more of the talking point, not so much the Bihar elections.
It's just a slightly, it's not more of a, maybe there's a question here, but just wanted to ask you, this LensKart IPO, right, which opens, I think, tomorrow or day after for subscription. I don't know if Kotak is involved or if you can, are you guys there?
Yeah, we are involved. So unfortunately, I won't be able to talk specifically about LensKart.
No, I know, I guess you would have guessed where my question was going, which is, valuations here, and so much feedback from people, right? And you would have noticed that as well, that while the promoters and the founders, etc., they tried to sort of reach for the maximum value out there, but isn't it the lead managers and the bankers, etc., who are perhaps to sort of advise and moderate some of this? But I guess, would you be able to weigh in at all? It's not a question for you on LensKart, but it's just a broader question, Pratik.
So I think this would be probably a question better for my IB colleagues. But in general, typically, as you know, pricing is again determined by market forces, just like what we were talking about in the broking industry or the distribution industry. So likewise, you could have managements which may want, let's say a price of 100. But if investors are there at 60, then there's a big gap. And eventually, somewhere there's a lot of negotiation and discussions happen. And either managements have to come down or investors have to come up. So these are market forces working around, and it depends on various factors, including positioning, sentiment, confidence in the company's growth prospects, flows at that point in time, cash levels at that point in time, overall market sentiment, foreign participation, how that's progressing. So there are so many things which happen. So I don't think beyond a point, frankly, the bankers can't do too much. It's at the end of the day, our guys have to try and make sure the transaction goes through and it performs well in the aftermarket. But again, if you have a group of investors who are willing to pay a very expensive price, then the pricing does move up, and that in turn may negatively impact the performance later on. But usually we do try and make sure that the IPO performs well. But again, like I said, these are market forces, not much we can do beyond a point.
Maybe we'll try and have the people on the investment banking side, as you said, Pratik, and maybe it's a discussion to be had. We'll try and have it. Thanks very much for joining us. Good speaking with you, and appreciate your time here on CNBC-TV18. 50 points on the Nifty is where we are at, 25,990. Well, let's go back to the big story, which is, of course, the SEBI draft regulation rules with regards to mutual fund fees, distribution, commissions, etc. And the entire capital market space taking a bit of a knock this morning. Sonal is here just to recap and put the spotlight on the various businesses, groups within the ecosystem which are likely to get impacted. Sonal, take it away.
Thank you for that. Well, it's a big proposal to reduce fees or basically restructure the fees that mutual funds charge to their investors. Let's talk about the big ones which could impact the markets overall. The first is 5 basis points cut in the equity exit load related charge that can impact AMC profits. They basically have asked to remove that 5 basis points charges that were levied. And Jeffrey says that if there is that 5 basis points that cut that comes by, it could impact AMC profits by 8 to 10% if it is implemented by FY27. Remember, it was implemented back in 2018, and now there's a proposal to squash it completely. There is proposed lowering the cap on brokerage fees paid by mutual funds as well. For cash market transactions to 2 basis points from 12 basis points. For derivatives from 5 basis points to 1 basis points. This is basically the charge that mutual funds pay the brokers when they buy the stocks in their portfolio. And of course, this would be negative for institutional brokers, be it the likes of 361, Nuvama, all of them which are a part of that brokerage ecosystem when it comes to the mutual fund industry as well. Additionally, we have proposals of reduction of expense ratio by 15 basis points for open-ended schemes, up to 25 basis points for closed-ended schemes, and they also indicate that statutory levies like STT, GST, you have stamp duty, that will be shown separately. They want to bring more transparency, they want to make it more investor friendly, and that is why they proposed these changes. However, these are just proposals. Comments are awaited, and the last date for the same is 17th of November.
Okay, all right. Got that. Sonal, thank you very much for getting us the details there. A lot of these stocks are still reeling under pressure. As you can see, some of the broker stocks are still down. I'm just checking IIFL Capital, for instance, down 9% as we speak. CAMS is down 5.5%. And of course, the asset managers themselves are decidedly lower, at least as of now. Well, we have to discuss this issue and the other important piece of news yesterday. India's largest commodity exchange, MCX, suffered a technical glitch in trading, and finally trading resumed 4 hours after that glitch was reported. And this is not the first time that MCX has had to face something like this. It is the second such instance in just the last 3 months alone. To talk about this and the fact that the market regulator is now seeking a very detailed review and a response from MCX, we have with us Abhishek Dadu, partner at Khaitan & Company, and also Sandeep Parekh, managing partner at FinSec Law Advisors. Gentlemen, thanks so much for joining in. Just when we thought we'll discuss what SEBI wants to know on MCX, SEBI wants to know a lot more from mutual funds as well with respect to their charges, right? So let's take it step by step. But first on MCX, Sandeep, your opening thoughts, because this is happening repeatedly. There is obviously a loss of opportunity and real losses as well, because you cannot trade real time. So how do you see this progressing? And do investors or traders who trade on the exchange, do they have a recourse?
So, I think let me start with a little bit of, background to technology. We've seen technology failures across not just the financial industry, but across, last week itself, practically the entire internet was shut down because of Amazon failure at the back end. So, wherever you have technology, failure is bound to happen. I think the point really is how prepared are you? I think the back office, the backup system worked yesterday. So I wouldn't be too worried about it. I think there will always be takeaways from technology failures, how to kind of make it smoother, how quickly you can move to disaster recovery site, etc. But to say that technology glitch will not happen, if it happens to Amazon, it can certainly happen to anybody else as well. So I won't be too skeptical about, these are failures. They've certainly had a kind of a shift in technology over the past 2 years. So, maybe they're a little more vulnerable, but, like I said, I won't be too skeptical about failures which are remedied quickly.
Gentlemen, morning, Sandeep. Absolutely. But, and we face technology failures all the time as well. I mean, sometimes I'd be on air and my computer would not work and I'd call IT support and it'll take time. But this is different, right? You surely agree. This is not, it's no one's case that technology cannot be, would not, there won't be problems, as you pointed out, with AWS, etc. But that disaster recovery, correct me if I'm wrong, isn't it supposed to kind of work like seamless? It's supposed to work seamlessly, right? Something goes down. That's the whole point of a DR site.
Most DR sites do take a few minutes. I don't know how long it took yesterday.
4 hours.
4 hours, 25 minutes.
4 hours, okay. So, like I said, there are always learnings from problems. Again, comparing it to last week itself, for 48 hours, we did not have, 50% of the internet for me at least stopped working completely. So, certainly, can we make that 4 hours into maybe 1 minute or 2 minutes? Certainly, yes. Is it instantaneous? Usually, no. So, there will be learnings. There can certainly be improvements, but I don't see a case for penalties being imposed and kind of a heavy-handed approach being taken in a case like this.
Abhishek, you want to come in? Your first thoughts? How would you think about this?
So again, I agree. I think, look, there is a much higher standard that applies to an exchange, right? There's a lot at stake here. It is a market institution. There is price discovery at stake. And I think more than anything else, the mere confidence of all the investors and the market in general is at play. So it's very important for the backup to come into play quickly. I know that there is a standard operating procedure which has very strict timelines that come into play. We still don't know whether these timelines were met. Of course, there will be a preliminary report followed by a root cause analysis report. These are detailed reports. All the processes are set out in law for MCX to submit to SEBI. Now, it needs to be seen if this has happened twice. Clearly, there is more there and they need to fix the problem more quickly. So I feel a little more strongly about this. I think this is something that needs to be taken a lot more seriously and fixed. Minor glitches come, but they can't come this regularly.
What do regulations say, Abhishek, about something like this? What needs to happen once this happens, once the disruption happens, and what does it say?
Right. So typically, in brief, what it says is within 30 minutes of effectively the trading halting, you need to declare it as a disaster, right? And then within a certain timeline of that, around 45 minutes or so, you then switch over to the disaster recovery.
No, 30 minutes, with 30 minutes, 30 plus 45, or from the point this trading is disrupted, 45.
It's 30 plus 45.
Okay.
That's the standard operating procedures say that, but there are nuances to this. It is when you actually declare it a disaster. Now, those details we don't have handy because those would be something available only internally and with SEBI at a certain point in time. But the idea is that there are strong financial disincentives which are imposed on the exchange if they don't meet these timelines, right? So from an internal perspective, the exchanges are incentivized to make sure that these processes come into place as quickly as possible. And we'll have to wait and see how SEBI and the exchanges deal with this instance, especially since it's the second time around, the last one being as recently as July.
So this was not 30 plus 45. This was clearly longer. And, I just want to make clear, no one is here saying that, well, there should be, SEBI should come down hard and do this or do that. We're just discussing because it affects, and this is the dominant exchange, right? By far the dominant exchange for commodity trading. So it's an important matter in that sense. Abhishek, so you mentioned there are strong financial disincentives. What are they specifically?
So there are two thresholds that are applied. It's the higher of 2 crores or 10% of the average net profits over the last 2 years of the exchange. And
say that again, Abhishek, 2% for our viewers.
So it's the higher of 2 thresholds. The first threshold is 2 crores and the second is 10% of the average net profit of the exchange on a standalone basis over the last 2 financial years.
So the cap, the maximum hit can be 2 crores.
No,
higher.
The higher of. Okay, yeah. The higher of. So it could be as a percentage of profits.
Correct.
Okay, and that's important information that, MCX is a listed entity. So MCX shareholders, it's important for them to understand the way the current rules are worded and what eventually comes out after this, out of this investigation that SEBI
but I think, Surabhi, it's also true that I don't think this has ever been applied, or has it? I don't know if you can ask Abhishek. Have these penalties of this sort been applied, Abhishek, in your memory?
So not to my mind. I know that there have been general sort of raps on the knuckle, but look, the regulator and the exchanges are also mindful that these are mostly genuinely out of control instances, right? We have to also be mindful that MCX has recently moved to a new platform from its earlier one. As Sandeep mentioned, glitches, certain teething issues are expected. It's just about getting better with every such instance and ensuring that they don't happen again. I think as long as sort of good faith and that approach is exhibited, the hope again here is that the regulator is there to sort of support these institutions as opposed to look at it from the perspective of purely trying to penalize them for a technical glitch.
Okay. Well, we hope that good faith is guiding, of course, all of the responses to start the disaster recovery and hopefully making systems better so that we do not have outages like these, and definitely not as long as what we witnessed yesterday. Gentlemen, before we let you go, and since we have you with us, Sandeep, just your thoughts, since we're talking about market infrastructure institutions. I mean, the entire ecosystem, mutual fund, product manufacturers, their brokers, distributors, everyone is in a disarray this morning because of what the regulator is proposing, saying that you can't charge brokerage beyond 2 basis points. And even that additional 5 basis points that they could charge in lieu of the exit loads being banned, even that's going to go. So the whole sphere is in disarray. Just your thoughts on how this could play out.
So, let me first kind of go back to your previous topic, and I'll seg into this topic.
Yeah.
I think you asked, what is the penalty? What is the disincentive? I think capitalism is a big disincentive. If your technology fails, I think you are put at a severe disadvantage. So there is a reason for you to self-correct. And, I'm making this point because it's very relevant to this question which you asked for mutual funds, for brokers, etc. I think so long as the market forces work, I don't think there should be fee caps really. And I say this, despite being part of the mutual fund committee in 2019 when the the fee cut happened. That time I think the MFAC was convinced that the market forces did not effectively work. And that's why the caps had to be reduced. But today, I think it's a pretty competitive market out there, and I don't see why you need to kind of including what you kind of flashing right now. 12 basis point and 2 basis point brokerage. I think that's extremely low. Even 12 is pretty low. Most of us pay significantly higher brokerage for full service brokerages. So unless there's kind of demonstrable evidence that market forces are not working properly, I think there's no reason to kind of impose new price caps. I think the existing caps should be sufficient. And secondly, do remember there is a second order problem with these price caps, which is it does disadvantage new players. It disadvantages smaller players because it will make them, either less viable or make them viable over a longer period of time with longer gestation period.
Usually the way the TER structures have been, created, usually it is people with the lower, sizes of funds. They do get higher TER. So precisely that objective that you're saying. Very quickly, last 30 seconds for brokers, Sandeep. I mean, right now we look at stock prices. It seems like the end of the world is coming. The model of equity broking, as we've known, and largely, I mean, their FIs have been absent from the market, so it's domestic flows, and within that, mutual funds are a huge part of where the business comes from. And if that is capped at 2% broking fee, then what are we talking about in terms of just the immediate future for domestic brokers?
Not 2%, 2 basis points.
2 basis points, beg your pardon, 2 basis points, yeah.
So, no, I'm laughing because, I think 2 basis points is really low. I think, like I said, unless there's evidence that there's either cartelization, that the market doesn't work, and there has to be price cap, I think we should trust capitalism to work. Trust competitive markets to work, and as far as I know, they do work, and I would not kind of support these new price caps. Again, I can be subject to correction if there is evidence to the contrary.
Okay, so let market forces work, let the forces of capitalism, demand, supply, fair markets and competition take over. That seems to be the message from Sandeep on this one. And thank you very much, Abhishek, for joining in as well. Both very important subjects, the huge outage that we saw at the biggest commodity stock exchange, as well as what SEBI is now proposing for mutual funds in the entire MF ecosystem. Well, with that, we do have to take a quick break. And as we take that break, here's a quick note for our viewers. As you can see on the screen, there is a money control stock score just above the MCX line graph. This is a score assigned to each stock based on Money Control's multi-factor algorithm. It is calculated by analyzing over 40 parameters, including both current and historical financial statements, price charts, and technical indicators for each stock. Each of the individual parameter is considered for calculation of the 4 factors are assigned a score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and T factor score. Remember, this is not a buy or sell recommendation. Any investor or viewer is advised to carry out necessary diligence on their own or through a certified registered financial advisor for investment decisions. Well, on that note, let's take a quick break. On the other side, we talk about the primary market action. The management of Orkla India will be chatting with us as the company is all set to hit the capital markets with an issue which totals to just under 1,700 crore rupees. Back with that in just a bit.
Welcome back. This is Corporate Trader, and as promised, we have the management of Orkla India who are in our studio with us. They are looking to raise close to 1,660 crore rupees. The issue opens up for subscription today. To understand what's the company about and what's the way ahead, we're joined by Mr. Sanjay Sharma, the Managing Director and CEO, and Ms. Sunaina Kalapa, the Chief Financial Officer of the company. Hi, ladies and gentlemen. Thanks a lot for coming down to our studio. Well, obviously, you'll be able to give us limited details since the issue just opens up. But tell us, how do you see business, shape up from here on? Now, just looking at your revenue mix, how do you see, say, for example, spices as well as prepared dishes? That makes shape up in the time to come. And also, the export proportion has been moving up. So what's the ideal mix out there?
Yeah, thank you. Thank you for having us in your program today. I think from a future revenue mix point of view, I think the drivers are quite clearly laid out. I think as the per capita income in India continues to develop and the GDP continues to develop, we will see a shift from the unorganized market to the organized market. I think that's something that has happened across multiple categories. You've seen curd go through, you've seen oils go through it. You've seen atta go through that shift as well. So you will see a shift continuing to happen. The second driver in our minds for growth is going to be the convenience food category. I think over the last 3 years, I think the indicators are falling in place very well. We see the new generation of consumers becoming the dominant consumer base, which is the millennials and the Gen Zs. We also see that these people, there's a higher proportion of women working, lesser time at home, lesser knowledge of cooking. But these guys are all internet savvy, digital savvy people. So they access their knowledge from the internet. So if I'm cooking something and I don't know how to cook, go to YouTube, quickly push through a recipe out there or on Instagram and pick up a recipe from there.
Indeed.
Order the ingredients from a quick commerce, comes to you in 10 minutes. I think, and they're not scared of digital payments or not checking the quality of products and other things. So I think these are factors that are driving the overall growth of both the categories.
Let me come in on that, sir. If you could tell us, you started off by saying there's a shift, right, from the unorganized to organized. So tell us a little bit more about that. What was it? What is it? And how is it? Where is it headed?
Yeah. So if you look at let's take spices market. Today still 60% of the market is unorganized, right? Your grandmother and my grandmother used to go to the market, buy the masalas, buy the spices, roast it in your house, grind it, and make your own spices. They would mix them up and make their own masalas. My wife doesn't do that. My wife probably has many better things to do in her life, so she will go and buy a branded spice for that. So I think that is driving the shift. And today, as I said, 60% of the market is unorganized. So as people have more income, I think the shift is more towards lack of adulterated food. People want to give their children the very best food because food is life in India.
Absolutely.
Food is good health in India. So, and spices has got a lot of connection to health as well. I mean, jeera is good for your stomach and so on and so forth. So I think that shift is going to happen.
So as that shift happens, now I just want to, I know you can't talk too many numbers right now because of, the issue. But generally speaking, when we talk about top line growth, and investors need to understand this because you've been doing a bunch of acquisitions as well, right? 2021 was, I think, Eastern Condiments. Going forward, what is the revenue growth trajectory for you like? I mean, what is the aspirational run rate? Will it be organic? Will you continue looking at inorganic opportunities? Are you looking to grow the spices portfolio more or the ready-to-eat foods portfolio more, depending on where profitability and margins are more lucrative?
Yeah, so I think before I do that, let me just step back and reiterate one fact that we don't play national, right? We play South. We are 70% of our revenues come from South, and the reason why we play South is because food is local. Gujarati food is different from Maharashtrian food, which is different from the Kannadika and the Tamil. Even the Tamil and the Kerala Malayali food is very different.
But I can tell you, your gunpowder chutney makes it to this North Indians' home on a weekly basis. So, therefore, it's pan-India.
You consume it weekly, but our consumers consume it daily.
That's true.
And I'm looking for depth of consumption out here. So, our entire strategy is to drive depth. Now, let me give you a very interesting example. Today, over the years, we built our per capita sale in Karnataka from 16 rupees to 110 rupees. What is 110 rupees? I mean, our largest selling pack of sambar is 76 rupees, right, for 100 grams, which means I'm selling 120 grams of sambar to every person in Karnataka annually, right? When that is so, when you make one time sambar, it takes about 10 to 15 grams of sambar, which means I'm covering 12 consumption occasions in a year. You have 260 consumption occasions because sambar is made 5 times in a day, right? And so there is huge headroom for growth, even in our local spaces.
But organic or inorganic? I mean, coming back to the question.
Organic. This is what we've been doing for the last 18 years.
Correct.
We've been pushing, we work on 4 factors. We work on driving penetration, driving frequency of consumption. We have a range of 200 products each on both the brands. So it's about
But you're not looking to snap up more inorganic brands because it is a largely unorganized market. I was just trying to understand that. Whether the focus is going to be on more acquisitions or just pure organic growth?
I think acquisitions is an important factor for growth. But I think today, we have always delivered double-digit growth in the long term. And we will continue to do so in the future. And if we have to do so, and when I'm talking about that, I'm really talking about driving it through organic growth. Acquisitions, are far and few in between to come. We will continue to pursue that agenda.
Let's just step back a little bit. So for the viewers who are, so there is the MTR business, which is the brand which consumers are aware of. What is that as a share of your overall business? MTR?
Yeah. So MTR is about roughly 53% of our total.
And what are margins in this business?
I can only say that the margins are extremely healthy because MTR has a very healthy portfolio of convenience foods as well as spices. And the focus again in spices is more on blended spices, which delivers higher gross margins. Similarly, convenience foods also delivers higher margins. So the margin
53% with healthy margins in MTR. Now, Eastern, what is the share?
So Eastern is about 47% of total revenues. And in the case of Eastern too, over the last 4 years since the acquisition, there has been a tremendous improvement in the gross margins as well as the EBITDA margins. We've put in place a lot of initiatives to grow the margins. However, because of the portfolio, it is slightly behind MTR in terms
international business is about 20%. Exports are about 20%.
21%, yeah.
Okay. And locally in India, 70% is South, as you said.
Yes.
Some of the key
70%
numbers.
is domestic, and then 70% of that is South.
When you came on, you started by saying that young people, they look up recipes and then they order ingredients. But they also, through these quick commerce platforms, order the food directly. So since QSR became so big, has there been any correlation? Have your sales per unit say? I mean, is there any way to tell? Has it dropped with QSR? I mean,
so let's talk about it like this. Anything. If you stop cooking at home,
not QSR. Sorry, beg your pardon. Food delivery.
Food delivery.
Food delivery.
Every time you don't cook a meal at home, it affects our business, right? But I think India is a large enough market to accommodate all kinds of models. So, of course, ordering out is new and fancy in this country.
But has that been a point where there's been no impact?
I think it's as I said, India is a large enough market. I don't think we have reached a stage where these markets have started to interact, right? I should also tell you one thing that it's nice. We are talking about largely the India consumers, large city kind of spices penetrate right down to rural. It's an everyday consumption for everybody. Okay, so there is a huge market which is still not affected by all this. People still. Again, it's the India consumer who has the money to order frequently outside. Large amount of population in India does not.
My question only was whether there's been impact on ready to eat.
It's very
spices,
small.
Of course, is. Would you be able
I think both the markets are very small. The ready-to-eat market is very small at this point of time, and so
would you be able to split out the revenue contribution of spices specifically? Because there is spices in Eastern and MTR as well.
I think you want to take that.
So spices roughly contributes to about 67% of our total revenues, and 1/3 of the revenues comes from convenience foods for us.
Okay, with obviously convenience foods having a higher margin profile.
No, that's not right, Surbi. Blended masalas give us very high margins as well, yes.
Okay, all right, ladies and gentlemen, thanks a lot for coming down to our studio. We wish you all the best. And on listing, we'll re-invite you all on the show. And then, in fact, maybe we could push you all for a little bit more numbers and quantitative data.
Certainly.
Thank you. Thank you very much.
Good luck.
Thank you.
All right, let's get back to our markets then. The Nifty continues to hold with gains of close to around 60 points. And after a very, very good showing in October, November starting off on the front foot. Vinay Rajani, the senior technical and derivative analyst, joins us on the show. Hi, Vinay. Good to see you, Vin. What do you think? All-time high sooner rather than later? What are the levels you're looking at, though?
Yeah, good morning. So yes, it looks like that we should soon hit an all-time high. Data from the derivative side, the rollover data has been encouraging. The Nifty has risen more than 5% in the October series, which is highest since June 2024 in the derivative side. So it is quite encouraging, though we have not seen the broader market participation that much. But large cap stocks are performing very well. Right now, we are oscillating between 26,100 to 25,700. So consolidation is going on. But anytime soon, we may see a breakout about 26,100. That is a swing high resistance that we are right now tracking for the short term. And long positions, we are advising to hold on with a stop loss of 25,700. So overall scenario is good. Result season is going on. So stock specific moves will be there. Some sectors are still performing very well, like metals and PSU banks, which are performing and hitting new highs. So stock specific, sector specific bullishness is continuing. Right now we are into consolidation, waiting for 26,100 to be taken out, and then we can expect a good momentum buying coming back to the Nifty, which can push it towards the 26,600, which we are targeting positionally in the Nifty.
Okay, got it. What about individual stocks?
Yeah, so metal stocks we continue to like, and it is looking quite strong. So Jindal Steel and Power, which has given a fresh breakout on the chart. So Jindal Steel and Power, I would recommend to go long for the trading around 1084. 1065 should be the trading stop loss. 1115 should be the next target in next couple of sessions. The second pick I would take from the power segment, that is Tata Power, which has also given a fresh breakout. This is a sector which has not participated that much, and it seems that this power sector can come and participate in this bullish rally. So Tata Power is looking good around 406. 398 should be the trading stop loss. On the upside, I'm expecting a target of 416.
Okay, all right. Thanks a lot, Vinay, for joining in and giving us all of those details. For the time being, slip into a short break. And since Vinay mentioned about metals, we'll take that break, come back. Manisha is waiting for us. She'll tell us what's going on in the commodities market. Don't go anywhere.
Okay, welcome back. Let's shift focus to what's happening in the commodity space. Manisha is standing by now with what's top of mind. Manisha, morning.
Morning, and thank you for that, Prashant. Well, copper is the new gold is what we seem to be hearing right now. And yes, there is some money that's coming back in case of copper right now. If you look at the prices on LME, they are very close to all-time highs. 11,000 plus is where we are trading right now. An all-time high in case of copper was hit in May 2024. At that point in time, we did see copper prices going all the way to 11,104. So as I said, not even $100 away from hitting an all-time high when it comes to LME copper. As far as COMEX copper goes, well, we did see an all all-time high onto that one in this year at 5.93. We are trading at $5.13 a pound. So it has been a very a market of disparity, and it continues to be like that, whether it's about LME and the New York copper prices therein. Well, there is renewed optimism over markets therein on impending conversations or US and China deal. That seems to be supporting various risk-friendly asset classes, and copper is one of them. If you look at the dollar index, we've seen a 7% decline on that in this year. That has been supportive for many dollar-denominated commodities. It also is about copper and its uses, really, which is getting more essential now for renewable energy systems, EVs and power grids, in addition to electricity and electronics as well. The kind of AI demand that seems to be coming in from copper also has been quite supportive. And then it also has been about major producers talking about concerns when it comes to mine supplies and smelting as well. That is supportive. For example, you have Codelco's El Teniente mine in Chile, which is looking at lower production this time around. Then you also have Dominican Republic and major sites therein which are facing problems as far as mining is concerned. Congo, Republic of Congo, that is also getting some issues there. And then that Grasberg mine in Indonesia, the Freeports mine, has been looking at lower production. An expectation that you could be looking at this mine completely recovering only by mid-2027 tells you that we have that much time for copper prices to continue to be on the bullish side there. And then you have had some alerts and warnings as well. Anglo American, for one, says that the production from its Chile's Collahuasi mine will be looking at lower production in 2026 and would see recovery and back to normal only by 2027. So that is 3 mines telling you that the production would be back to normal by 2027. And then you have BHP's statement from the CEO coming, saying that global demand for copper could surge by 70% by 2050. So are we looking at higher highs in copper? Well, that is something exactly what the global banks and brokerages believe. When you look at the prices itself, we've seen 4% of a gain in the previous week itself, and we are up by 30% in copper in this year until now. More importantly is what banks now seem to be putting out in sense of numbers for copper for 2026 and 27. There's a report from Bank of America which came in very, very recently. They believe that copper prices could see 11,300, a new all-time high in 2026. And by 2027, before the prices peak out, you could be looking at $13,500 a ton onto that one. A report from Citi believes that 12,000 is inevident by 2026. That's an average price that they're putting out. And then there is Goldman Sachs. They have come out with a report for 2026 and 27, believing that $10,000 to $11,000 a ton of an average price is what copper prices could be trading with. JP Morgan also has come out with various scenarios, ifs and buts, and for 26 and 27, they believe that copper could trade between $9,500 to $12,000 a ton on the higher side. So as you can see, the bullish picture for copper just about continues, not just in this year, but the next couple of years as well.
All right, Manisha, thank you very much for that. So that is commodities in focus. We take a break. On the other side, it's the economy. Lata in conversation with Jonathan Barrett of ETO Markets and Kishore Narni of Motilal Oswal Financial Services. And we'll put the spotlight on if metal prices are on the verge of a major rally from here. Copper and other commodities in focus.
On It's the Economy, we continue from where Manisha left off. The month of October has seen metal stocks like Hindalco, Nalco, Vedanta, Tata Steel, JSW, all of them surge between 5 and 12%. Actually, if you add today's rally, all of them have rallied between 6 and 12%. The reason has been the strong rise in base metal prices, so much so that many brokerages have turned bullish on metal commodities and metal companies. This week, copper prices on the LME have risen already as of today by 4%. Aluminium rose 4.5%. Zinc is up 3%. And over the month as well, they've risen nearly 7 to 8%. What are the reasons for the rally? Will it sustain? More importantly, for these questions, I'm joined by two experts, Jonathan Barrett of ETO Markets and Kishore Narne of Motilal Oswal Financial Services. Gentlemen, thank you very much indeed for your time. Jonathan, let me start with you. Do you think that this is the start of a rally, or are we in the belly of the rally for commodities?
Look, I think that is an interesting question. Obviously, metal prices have already rallied, so I think it's more of a continuation of trend. And it's also a continuation of the inputs that actually make that trend. Obviously, we've got interest rate decisions coming out of the US, trade deals with China and the US. So there's plenty of other things that can really accelerate this current trend, particularly in copper. So if anything, I'd say it's right. We're right in the middle of it, and there's a good chance it'll continue.
You only said copper. You're not that bullish on aluminum?
Similar, but when I think you look at the machinations of aluminium over copper, it's slightly different. Aluminium, we do have supply. The market is trading in a relatively strong contango, which is good. But when you look at copper, it's in about a $300 backwardation, which basically means that the front months, there is more demand for copper today than 3-4 years down the track. That tells me that there's that supply issue that we know that is still contained. It will continue. You add just a little bit more fire to this, by the way of rate cuts or anything, and copper will surpass the record highs and even trade a lot higher from here.
Okay, well, we will eventually carry even the LME stocks and the Shanghai exchange stocks. That data will be shown as you speak. Kishore, you know, actually, I got some very bullish reports from some of the brokerages. There is one from Elara. I mean, I did read your very bullish report as well from Motilal, and we are carrying that as you speak. But Elara points out that physical commodities have started seeing a lot of fund flow from the start of this year globally, and usually commodity equity funds follow commodity funds by a few months. So their expectation is that perhaps you're in the start of a rally for commodity stocks as well. Your overall thoughts on commodities and commodity stocks?
Yeah, I think I strongly believe that the time for physical assets has started a couple of years ago, and the tariffs and realignment of supply chains actually has tightened it further, because the movement of goods is not easier right now. Everybody wants to hold on to their strategic inventories at the same time. And also the consumption and the underinvestment, or maybe the production stagnation in many of these metals actually has caused some of the depletion of inventories. As Manisha was carrying the story earlier, you were also mentioning that I think if you look at LME inventories, aluminum is almost 50% down from its peak, maybe early into mid 2024, and zinc is down around 30-32% from the, and even copper inventories are significantly tighter. That's not the only story. The story is that the global surplus on the primary production level has been shrinking in metals like copper. They are still in slight surplus, but the surplus has come down significantly. In zinc also, it has toned down significantly. So we are having lower and lower surplus metal available, and on the other side, inventories are shrinking. So if you're looking at next 2 to 3 year perspective, we will be in a similar situation like silver, where you actually has depleted the inventories and you don't have any spare capacity or the surplus available, and every single ton, the additional demand of every single ton will be at a significant higher cost. So that actually will drive this super cycle. And so we strongly believe that we are in the beginning of a larger trend, any 5-6 years kind of a trend. Of course, we will be having ups and downs in this. But I think the structural super cycle could be starting. Maybe already we are in that for the next 3-4 years at least, and we have already started it maybe a year to 2 years ago.
Oh, okay. No, that's the point I wanted to make. Is this a start of a long cycle? Because commodity cycles do tend to run for a goodish bit. Jonathan, can you explain the China factor? Earlier this year, we equity guys, who look at equities, we were told that actually China would be a disinflationary factor in the world because they are locked out of the US. They can't export to the US, so they'll dump in every country. And Asia will face disinflation because of China. But then there was a plenary meet of the Communist Party. And then there is this anti-involution news that's coming out of China. So is China an inflationary force or a deflationary force?
It's still deflationary when you look at the numbers. It's not doing that well, although there is a little bit of green shoots of recovery starting to come along. I think the main key thing about China is its demand for copper for the green environment, and that's where we're seeing a lot of it go to. Now, China is at the forefront of what she's doing in cleaning up her act in terms of green energy, and as a result of that, there's a big demand for copper. So if anything there, you can see there's a big push in one area, which just happens to flow through to demand in the copper market. So I think China, and the other thing about China too, we're going to get some positive spin out of what's happening with trade negotiations with the US. So that's one thing. But also China has this capacity to continue to support the economy. They're not in a situation like the States. Their economy is stable, although not growing, but they have this capacity to be able to inject stimulus. And I think to me, that is the one key difference between the US and Japan. Japan can hold its economy. It might not grow as much, but there aren't any major problems as we have with the US when we look at government shutdowns and so forth. So I think that the picture in China looks quite positive, given all the other machinations start to happen. So I would probably suggest that demand out of China will continue. The overall economy might soften, but the demand for primary inputs and commodities such as copper will remain relatively robust.
Okay. Jonathan, what are the kind of year-end gains you are seeing? Year-end is only about 2 months away. For 25. So give me a 26 number as well. Percentage gains for copper and aluminium. Copper, aluminium and zinc, actually.
Okay, no, that's all right. I think across the board you can see gains. There's no doubt about it. I think when I do look at copper, I can see that you've got from here an attempt to the new record high. Let's say it's 11,000. It can trade a lot higher. It can trade up to 12 and 13,000. Oh, given the right resources, given the right numbers, a cut in interest rates in the States, more stimulus out of Japan. I think that will continue. That will feed back into aluminium, and I think that aluminium's still got another 10 to 15% on the top side, as with zinc. I will have one qualification in here. Yeah. Okay. The prices look all positive, but if there is a showdown in the States concerning Trump's policies, which turn the economy around, then things will change very, very quickly. Okay. I mean, remember, there are some big issues still in the US. Yeah. If that turns sour for Trump, that'll turn sour for the commodity complex.
Yeah, I know we all were worrying about the big R word, but what is the last GDP number we have out of the US? 3.8%. I mean, it's hardly looking like a country which is anywhere near the R word, but we don't.
Just look at the one before that where it was -%. So there's a big swing.
I agree. There was a minus 0.06. I take your point on that. Kishore, what are your expectations? I mean, how much more is there to run in these commodities?
Yeah, I agree, especially in copper, we are looking at 13,000 and beyond on the dollar terms. So that gives you roughly around 30% from here, and that can extend to $15,000. That's around 50%. So anywhere between 30 to 50% is what we're looking at next 18 months or so. So copper is very, what you call, in a firm footing for that rally. Zinc, we're looking at around 25 to 30%. So that's what upside looks like in zinc. Aluminum is, at this point of time, it has a bit more consolidation, what we see, but probably around 15% to 10% is what aluminum looks on the broader perspective.
Okay, well, actually, for Indian stock markets, it will be aluminum that they would be most watching. You expect that to be a bit ranged. I'm going to ask you on an unfair question before I finish, and that's on steel. I know there is no LME or raw metal on it, but a lot of the stock markets are interested. Jonathan, you go first. Any view whether steel prices will continue to rally?
I think steel prices will, as long as we get the policies that are in place and the macros that make sure that the economies will continue. I do get a sense, particularly out of the demand from general economies. Obviously, China's a big one there, and the US and also the EU. I think steel prices can continue to rally as long as the macros support it. So, it's a good story, just like the other non-ferrous metals.
Yeah, if growth continues, at the moment it does look like the US is in a fine spot. We don't know about global growth considering the tariff uncertainties. Kishore, your guess. I know steel is not your daily commodity chase, but what's your view?
See, basically, we are looking at around 8 to 9% growth in the demand for steel. So both on the major economies at the same time, even India also. But the raw material costs, especially the coal, is what is going to be the factor which we need to look at, because as the global environment policies are now a bit relaxed under the Trump regime, and he is pushing for coal. So I think the coal prices are going to be slightly under. In that scenario, the positivity of steel could be little under pressure. But at the same time, the overall price support, I am seeing probably around 4 to 6% upside is there, specifically for India, despite all these things, strong demand growth and all those things. But prices are having limited upside, probably another 4 or 5% in 2025, but not that much large for this year.
Okay. Well, that's useful information and analysis. Thank you very much, Kishore and Jonathan, for making sense of the commodities rally. The non-ferrous commodities are going to see a lot more run-up, especially copper, where India is largely a user. Other than Hindustan Copper, we are largely users. But in aluminium, there is a more ranged rally. And in steel, perhaps we won't be the best beneficiaries of the rally, if there is one. Thank you very much for joining us. We'll wrap up on Bazaar on that note. Chartbusters coming up.
Shares of asset and wealth management companies decline as market regulator SEBI proposes reducing expense ratios charged by mutual funds and making fee structures more transparent. White Oak Capital's Ashish Somaya tells CNBC-TV18 that the changes could result in a low single-digit impact on AMC earnings.
Cohance Sciences trades with cuts after Managing Director V. Prasada Raju tenders his resignation.
Shares of Blue Dart trade higher after posting a good operational performance in its September quarter. Profits rise 29% while margins expand. The street optimistic of the next 2 quarters.
And shares of SAIL, JSW Steel, Hindustan Copper, among other metal stocks, rise as prices of copper and aluminium hit multi-year highs. Optimism over a US-China trade deal and hopes of a stimulus in China also pushes stocks higher.
Good morning. You're watching us here on Chartbusters on CNBC-TV18. We come to you live from the CNBC-TV18 Motilal Oswal studio, and it's been a good start to the November series so far. I'm Mangalam Malu, with me Vinny Motiwala. 120 points higher on the Nifty. The Nifty over the last few trading sessions, just as we move towards the end of October series, was struggling to stay above 26,000, now closer to 26,061. And today as well, you know, it's been led by the IT stocks as well as Reliance. So we'll keep an eye out on that one. But more importantly, can the market sustain higher? It all depends on what's at the bottom of your screen right now. Donald Trump at the summit has said that they have great respect. He has great respect for the Indian PM, and he is going to do a trade deal with India. So that's in Donald Trump's words. It's come out. You know, the big trigger for the November series would be any of these trade announcements that would come by. Globally, the street is hoping for some peace between US and China when it comes to a trade deal. They are in talks, and now Donald Trump saying this also should assuage some concerns, and that adds to the optimism. The only thing that can do better today is the Nifty Bank, which is absolutely flat. But with the kind of October series that it has had, you know, no one's complaining.
No one's complaining there, Mangalam. Good morning. And absolutely key commentary that's coming right now from Donald Trump is going to keep the markets on their toes as well. Whether we see this deal coming through is what everyone's keeping an eye out on. Broader end of the market, you know, especially the small cap, that's also something that's not doing too well amongst the market overall when you look at it, right? Look at the Nifty small cap. It's down 0.1%. Midcap managing to hold on to some bit of a gain. Advance decline ratio today is a bit more in terms of the advances versus the declines that you're seeing coming in. And a lot of movers on the broader end of the market that we're seeing, especially the metal pack. That's the one that we're watching out for as well. And Blue Dart in terms of numbers also is something that's buzzing in trade. But let's shift focus and talk about Nugent Software, right? We've seen the stock run up quite a bit in the last 1 month specifically. Now, they reported their Q2 FY26 numbers. Strong performance that came in from the company. Sequentially, obviously, the revenue growth has seen an improvement, but Q1 is a seasonally weak quarter for the company. Year-on-year basis also, the company has managed to see good growth. Margins have seen an improvement. We have Virender Jeet, who is the CEO at Nugent Software, joining us now on the show to break down the quarter gone by as well as what we should be expecting going forward as well. Mr. Jeet, good morning. Thank you so much for joining us on the show. Let's start by talking about the revenues that have come in for the company. Sequentially, obviously, we've seen a very good performance given that Q1 is a weaker quarter for the company. But even on a year-on-year basis, Q2 managed to see that double-digit growth this time. Margins, they have come in at good 25.5% versus last year at 23%. What is it in terms of the growth outlook that we could watch out for from the company for the full year FY26? And in terms of margins, if you could give us any guidance here.
Good morning and thank you for having me on the show. You're absolutely right. I think Q1 is a weak quarter. We are a seasonal business with Q3 and Q4 tend to be much larger quarters for us. Having said that, I think broadly we have done well this quarter. We have got a lot of business in mature markets, especially markets like Europe, Australia, which are new markets, have started firing. US has done well for us. And India and EMEA still are, compared to our historical rates, are weak. But I think we hope that next 2 quarters we are going to improve in those markets as well. See, the year gone by, I think in Q3, Q4 are much larger quarters at a base revenue for us. And we do expect that the momentum which we have done in Q2, we should be able to continue.
So momentum year on year, it's been about 11%. You believe that the second half of this year, an 11%, double-digit growth year on year, that is sustainable?
Yeah, I think, we are aiming for much larger, but I think as the environment is slightly more in flux, and I think in some of the territories, we are still finding certain challenges in some segments. So I think we should be still able to aim at these numbers or try to do better than these numbers.
All right. So what does that do to your full year numbers? If you could give us a target on that one, what is it that your aim is? And even on the margins, second half, what we've noticed is a lot better for margins than the first half. You've seen some momentum in the second quarter at around 25%. How much higher can they go in the second half? And what does your annual number look like here?
See, I think the margins it's a function of business because our costs are very fixed. So they don't change as the Q3 and Q4 numbers end up larger, they end up to be larger quarters. I think also, I think some amount of costs in terms of expansion of manpower and other things will start triggering in Q3 and Q4. So we should be able to, the long-term guidance is we should be able to do a net 20% and around 23 to 24% of EBITDA margins. The business automatically, as it grows, keeps on expanding margins, but our aim is to aggressively invest in more R&D, more sales and marketing to expand the growth rate.
And the revenue?
I would say that, our revenue growth is where our focus is. Margin is an outcome of business. It's typically a software license business. We are a software product company, so as we grow, the margins do keep on expanding.
Mr. Jeet, you did highlight a couple of points, right? India and EMEA, that's still not picked up in terms of performance that one was expecting to see. And obviously, deal conversions. Last time you said there were some large deals which were still not converting too much in these regions. So are we expecting to see better performance here overall in Q3, Q4? And what is the licensing sale also over here? Because that's a segment which is not done well in Q2.
So these are exactly linked. As this is exactly what I was trying to say. Both India and Middle East contribute for larger license deals for us, whereas other market deals are typically more on subscription, so their revenues are more staggered and back-ended. But India and Middle East are the larger contributors of license deals. Last 2-3 years, India and Middle East have substantially grown at roughly around 28 to 40% for us. I think the basis of these regions have become very large. The license basis for quarterly run rates are very large. So the challenges we are still facing in this market is that typically the larger deal momentum for us slowed down, in Q1. It was even weak in Q2. But I think, we are very hopeful and we're working on various areas of expanding, increasing the deal velocity. And I think Q3, Q4, I do expect to see improvements in that.
Okay. And just want to understand, how is the margins for licensing side of the business? Is that much better or higher than whether you look at a SaaS business or an AMC side? How does that work?
See, generally, roughly around 60% of our revenue has got nothing connected to in terms of a resource cost. So typically, whether it's license, ATS, AMC, or subscription, these are all high gross margins. Generally, they don't have any direct costs. They are based out of our R&D investments, which we've done over the last 5, 10, or 15 years. Those are the returns coming from that. So you're absolutely right. Licenses are typically at 90% or 100%, depending on what kind of, the way you want to measure it. They don't have direct costs. So as the license sales or subscription or AMC, these are 3 factors. When they expand, they don't have direct costs. So the margins do expand organically for that.
All right. A fourth of your revenues does come in from the US. This quarter, it showed good growth at around 21.5%. Do you think that sustains with the kind of uncertainty that the street is facing around H1Bs and all those, things that are happening? Currently, the last comment that we have from Donald Trump, just 2 minutes before we came to you, was that he's looking at a trade deal with India. But you don't know when that changes, right? But amidst all of this uncertainty, how do you see demand in the US in particular? And how do you desensitize yourself to all these volatilities?
Yeah, so I think, so one thing is, fortunately, unfortunately, the whole IT industry is measured from the service mindset. We are a product company, so we have no impact of H1Bs. We are locally employing people. We don't have manpower-based businesses. We have product license-based businesses. So we don't get impacted by such things. Having said that, I think as the US market, the banking has started getting revived. The insurance segment is showing transfer. As the market starts showing improvement and certainty, we should be able to sell more in those markets. We don't see the challenges of the current uncertainty around policies or H1B visas affecting our business. In fact, we're completely disconnected from that. We are not a people-based business. We are a software and a IPR-based business. So in the long term, I think, any kind of effect which has a better growth of US economy in terms of banking, financial services should give us improvement and traction.
Okay, and sir, just a quick one. You had mentioned that AI-led productivity is something that is leading to a lower employee cost, right? So, do you see that increasing a bit more in the second half of the year? Headcounts also this time have seen a reduction of around 100 on a year-on-year basis. So, will we see such a reduction furthermore?
See, I think we don't need too many people in our business as such. I think if you see historically for doing around 20% growth, we just needed around 6 to 7% of the people. That was the net addition. This year, I think we had pre-hired a lot of people last year. We also rely a lot on campuses, and we always, take all the campus. So we have again taken people in January. We'll be again taking people in January. The the wage increase, which is typically the annual increments, will also have started also kicking in from this quarter. There's going to be small increment of wage costs at that, but I don't see in long term we will have ever have too many of people requirement. Organically, we will add around 6 to 7% people every year, and that I think that with that we should be able to sustain a growth momentum of 20% or more.
All right, 20% growth momentum and 6 to 7% increase in people, which means that you have a long-term guidance of 23 to 24% in the EBITDA margins, 20% in the net profit margins as well. Wish you good luck for the second half of this year. But we had mentioned about the US President Donald Trump saying he's going to do a trade deal with India. Now we have the visual of that as well. Let's hear that out.
So I'm doing a trade deal with India, and I have great respect and love. As you know, for Prime Minister Modi, we have a great relationship. Likewise.
Okay, that's the latest update coming in there in terms of a deal, and that was from Donald Trump. Now it's time to highlight our Super Pro chart of the day, powered by Money Control Super Pro, a segment where we turn data into direction. Each day, we pick one chart that sums up the story driving the markets and help you understand the why behind the what. Here's today's chart and what it means for your next move. Hindustan Zinc is the stock on your screen, showing a bull sash plus golden cross support and a bullish reversal. As you can see, a bull sash candlestick appearing in the vicinity of a golden cross, that is a 50-day moving average, crossing over the 200-day DMA. Now forms a highly potent signal for a convincing bullish trend. And if you did like to access more expert-driven insights and actionable chart patterns like this one, simply scan the QR code on your screen and subscribe. The Money Control Super Pro Plus festive season, there's more reason to celebrate. 10 lucky subscribers every day win 1 gram of gold. So don't wait, scan, subscribe, and make your portfolio shine brighter with Super Pro. Welcome back to Chartbusters on CNBC TV18. As of now, 26,000 is what the Nifty is managing to hold on to. But let's bring on Chandan Taparia from Motilal Oswal Financial Services for a check in terms of the market on the technical front. Chandan, good morning. Thank you so much for joining us. Beginning of a new series. Today we've started near the 26,000 mark. As of now, managing to hold on to that. What are the levels we should be keeping an eye out on?
Yeah, good morning, Vinny. Thanks for having me. So first to start with the rollover data. Nifty has seen a rollover of around 76%, which is lower than last 2 months and last 3 months average of 82%. At the same time, the open interest declined by around 16% with surge in price by more than 5%, which clearly indicates that and the market, which consolidated in the last couple of months, has now started to witness the next leg of rally. And I believe the short covering majorly happened from the FIs and that have a positive trigger. So I believe till Nifty holds above 25,800, buy on decline could continue, and index has potential to rally towards its all-time high of 26,277 or even a new momentum towards 26,500 marks. Now talking about other data setup, India VIX is below 12 marks. FI's long short ratio has recovered well. In fact, FI's started to buy. Put call ratio is holding well. So all these data setup are indicating higher base in the market, and that's why we are expecting Nifty to commence the next leg of rally and head towards the new lifetime high. Talking about Bank Nifty index, here we have seen a rollover around 80%, which is in line to the last month as well as last 3 months average. But here also the open interest declined by 8%, with series on series basis price movement by more than 6%. So it outperformed, and we believe this outperformance could continue until it holds above 57,750. We are expecting Bank Nifty to head towards 58,577 or a rally towards 59,000 marks. So positive stance in both the indices and looking for small buy on decline stance for the next leg of rally in the market.
All right. Where do you believe that the next rally could take, the Nifty and the Nifty Bank? If you could give targets on that one. And some of the stocks, Chandan, what do you have on your list?
Yeah, so like in Nifty, we are looking for 26,277, 26,500. In Bank Nifty, we are looking for 58,577, 59,000. And now talking about trading idea, first that is buy on Tata Power. Selective power stock started to witness buying interest, and Tata Power has given a consolidation breakout of last almost 13 weeks. It has given a decisive hold beyond 400 marks. In fact, the 400 put writing and call unwinding started to witness the activity, which indicate positive stance in the counter. So recommending to buy with support of 402, and Tata Power can head towards 430 kind of level. Second trading idea, that is buy on Hoodco. Here we are observing a price pattern that is similar to a symmetrical triangle, which indicate the bullish stance in the counter. In fact, the stock is holding well above its 50-day exponential moving average, surpasses falling supply trend line. Longs are being built. In fact, the rollovers are positive in the counter. So Hoodco can head towards 243. One can buy with support of 226. One more trading area, that is buy on SBI. We have positive stance on most of the PSU name, and SBI or State Bank of India is our preferred pick. In fact, the counter has been making higher top, higher bottom from last 14 trading session. This is our preferred pick in a Diwali technical idea as well, but expecting momentum to continue. The stock has a positional target of 1,000, but on immediate basis with support of 924.
Right.
We are looking for an upside target towards 980 levels.
Sure. Thanks so much for that, Chandan, and thank you so much for joining us on the show as always. But on that note, we're going to step into a very short break. We'll get you a snippet of Neelkanth Mishra's view on India's Russian crude imports on the other side. Stay tuned in.
Welcome back to Chartbusters. Now, what could be the impact of Indian refiners scaling back Russian crude oil imports because of the sanctions? What could the impact be on the economy and refiners? We spoke with Neelkant Mishra this morning, and this is what he had to say.
Exact advantage or the relative advantage that India had from buying Russian oil had actually shrunk to almost nothing over the past 1 year. So the gap between Brent and Urals was $30 a barrel in 2022 when the first sanctions were imposed. It had actually shrunk to $4 or $5 a barrel over the past 12 months. And once you adjust for the higher cost of insurance and freight, the landed price advantage was like $2 or something. So it's not that, India was benefiting greatly. Now we are at a stage where oil markets are significantly oversupplied. This is part of the reason why you're saying that Brent is back to 64. I mean, it was 60, 61 when the sanctions on Lukoil and Rosneft were announced. So there is enough oil in the world. India, you're absolutely right, imports 85% plus of its oil needs, more than half of its dense energy needs, and these are things that India needs to work on. But at this stage, from a cost perspective, remember last year, the average Indian mix, which is closer to Brent, the prices were $10 a barrel higher. So as of now, it's not a drag on the economy. I think diversification, and remember, Indian refineries are some of the most complex in the world. Their ability to handle all kinds of crude is proven. And therefore, I don't see any India-specific reasons to worry about the sanctions affecting the Indian economy.
All right, important comments coming in. But as we look at, the top of your heads, the Nifty is still holding at that 26,000 mark, mildly off the highs led lower by the banking index. With that, we'll call time on this edition of Chartbusters from our team. Thank you for watching. Stay tuned, though. The team of Trading Art takes the market action forward.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Reema Tendulkar. Hey, Reema, it's a fresh news series, and we are seeing that recovery that has coming from the lows as well. So we did fall below that 26,000 mark, but now back above that. In fact, the Nifty is now seeing gains of 109 points. Bank Nifty also briefly got into the green. Again, it's basically a green and red tick that we continue to see on the Bank Nifty as we speak. But a lot of these names have recovered from the lows of the day as well. So you have something like Tata Motors, which is at the day's high. We have Adani Ports, Infosys, ITC, Sun Pharma. All these names are contributing to the recovery that we're seeing from the lows. But of course, that remains to be seen which way things go. For now, Nifty Energy Index, that's one of the top gainers that we are talking about. Nifty Metals continues to be an outperformer. Oil and gas space in focus, pharma, infra, IT, all of them are doing well in trade. And we do have a lot of earnings to talk about. And not just earnings, it's been a very, very busy week otherwise as well. So much happening, be it the SEBI norms, be it Trump's commentary now and then on the trade deal, and Russian oil imports as well.
Indeed, I think the big reaction that we're seeing in the markets, the positive reaction, is Donald Trump's latest statement where he underlined that he will do a deal with India, a comment that has sparked optimism. So far, it's been a steady morning of trade. The Nifty is holding above 26,000, a gain of 100 points. The Sensex is up 300 points, just about 100 points shy of that 85,000 level. The Nifty Bang is flat for now. It's about 350 points away from its all-time high levels. In terms of stocks, big moves seen in the likes of a Blue Dart, a SAIL. You've got an Adani Green, which is up close to about 7.5%, Godavari Power and Ispat. And on the way down, profit booking visible in names like a Car Trade Tech, which was the big mover of yesterday. But in fact, let's talk about Blue Dart. That's rallying on the back of a strong performance. Mangalam joins in with the numbers.
Well, it's a good performance that is coming from Blue Dart this time, but the street is more excited about what lies ahead as well, because the second quarter typically is seasonally the weakest for all these logistics companies, especially the parcel ones. And more importantly, this quarter was also impacted by, extremely high rains and flooding in many parts of the country. So all of that, despite that, the company did fairly well. There was a dynamic situation, and we saw 7% revenue growth, which is obviously not double-digit or something that we've been used to seeing from Blue Dart. But despite all of this, the operational performance was fairly strong. They had about 15.5% jump in the EBITDA. Margins did well, and as a result of which there was a near 29-30% jump in the net profit as well. The important part, though, and why the street is celebrating, is because there are important triggers in the next couple of quarters. The quarter that we're currently in is seasonally the strongest for Blue Dart, so things are only likely to be a lot better from the second quarter to the third quarter. And the fourth quarter, come Jan 2026, remember, every year Blue Dart takes an annual price revision, and this is something they informed the exchanges about a month ago as well. So from Jan 2026, which is the fourth quarter, there will be a price revision of 9 to 12%. So that also will kick in. So second half likely to be a lot better. And the second quarter, which is seasonally weak, in which the company did fairly well on the operational front as well. And add to all of this, the stock over the last 1 year, despite the up move that we're seeing today, is down by almost 20%. So the stock hasn't seen a big rally either. All of that leading to the up move that we're seeing in Blue Dart right now.
12.5% higher on that one, Blue Dart. That's the stock on our radar.
There's one interesting company which will be a peer to Blue Dart, that's Shadowfax. And they're expected to come up with the IPO in the next couple of months now. And that's a company, because I was just reading the DRHP for interest, it's more like last mile. So if you order from a Myntra, you order from a Nykaa, they will deliver it. But where they're different from the others is they are entrenched in quick commerce. Quick commerce. So while quick commerce has their own in-house delivery center, some part of it where they can't fulfill it themselves is outsourced to Shadowfax, and that's a company which has been growing very well.
Okay, all right. Let's talk about earnings now. IT firm Happiest Minds Technology reported its Q2 numbers. The company reported constant currency revenue growth of 2.3% sequentially, while EBITDA margin dipped 120 basis points. Reema caught up with the management of the company and began by asking about the outlook for the second half of the year and the guidance for double-digit revenue growth for the full year. Listen in.
We had guided that we would do double-digit growth for the current year, and I would say that we are on track to meet that goal. Our pipeline at the end of Q2 was much higher than what it was at the beginning of the year, which should contribute to growth in Q3. Now, some of the initiatives that we undertook, transformations that we undertook last year, have started paying dividends. If you look at our NN initiative, where we broke up the NN sales team, the sales team into NN BDMs and EEN BDMs, that's beginning to pay off in terms of the new logos that we closed. We had 30 new logos in the first half of the year that we expect will contribute to growth in the second half, as well as contribute $50 million over the next 3 to 4 years. GBS was other transformation that we had started, and we have, it's come along really well. We've done $4 million for the first half of the year. We should do our goal of $8 million for the current year. They had broken even last quarter, and they've started showing profitability, so contributing to the bottom line as well. And 22 of the use cases that we have implemented, we realized are replicable sales, which we are taking to other customers as well. And we expect to get another $50 to $60 million from these use cases over the next 3 to 4 years. So not only will they contribute to the growth in the second half of the year and to this year, but we also look at them driving growth for the next 3 to 4 years, based on which we are confidently saying, earlier we had said that we will do double-digit growth for next 3 years. We're increasing that to 4 years now.
Venkat, can you explain the margins? I believe there was a wage hike impact which hurt margins this time. What was the overall contribution and how were you able to offset it? The INR depreciation and other factors.
So to start with, yes, we were one of the very few companies who had given the pay increase effective July of this year. So that has had an impact. We could set off part of that through improved efficiency. Our utilization is at an all-time high, or I should say high over the last 3 years of 80.7%. Our attrition is trailing down to 17.4%. Both of them have had a good role to play in margin management. Interestingly, our gross margin for that quarter has gone up to 37.2%, aided of course by help with the way the rupee has moved to the mood versus the dollar. So it has been a quarter where we had some benefits, most of which has been plowed back into the business in terms of investments in GBS, business services, and the new sales engine that we have put in place. The new sales engine is beginning to fire. We have signed 30 new logos with the potential of anywhere between $50 to $60 million in the next couple of years. GBS has not only broken even, they did that last quarter. They're beginning to perform on that same basis, and we are looking to get back to the profitability numbers that the other BUs are showing, or in fact better from that standpoint. So hopefully we should be able to manage the cost increases that we've taken in through efficiency and cost management, and also improvement in profitability of GBS and the new sales engine starting to fire. Obviously, I would not complain if we get some benefits from the exchange rate environment, but that's something which we don't have much control about going forward. But all told, on a margin front, we are hopeful of maintaining the 20% plus EBITDA guidance. Operating margin at 17% plus. We have done 17% this quarter, and YTD 17.2%, which is in the striking range of what we have been planning for, targeting for the year.
Generative AI, you said $8 million in terms of revenues for FY26. And again, just walk us through how the operating profit from here on will improve. You spoke about how it broke even in Q1, but the trajectory to get back to company averages, how long will that take?
Yeah, so that we had said about 18 months. 18 months is what I had said to come back to the same levels of profitability that we had planned for. We are down to 12 months right now after the BU started fully firing, and I would say by the end of the year they should be at the levels that we have planned for them. But largely then looking at them as an individual BU and the profitability, the ability for that business unit to pull through revenues into our other two units and how they work so closely with the other two business units is what is really that needs a call out. They are really helping, up efficiency, the rates that we are deriving from our customers, the work that we do for the customers on the other two BUs, which is really, I would say, Gen AI-led services. So, if you consider that, I think the payoff is bound to happen by end of the year. The rates that we get for Gen AI services, Gen AI-led services are, significantly higher than the averages that we get for, higher-end services like analytics and even product engineering. So that also will contribute to the way we manage our profitability going forward.
Joseph, you want to elaborate on the point that you are able to command higher rates for generative AI business? Can you put a number to it? How much higher than the overall company average? And even this, pipeline of $50 million in terms of revenues over the next 3 years. How have you arrived at it?
What we're seeing, while there's a range, on an average, right, if you take average rates, we're seeing something like 20 to 25% higher rates than the rest of the company for Gen AI related projects. So that, as Venkat pointed out, that contributes to higher margins as well. So, what we did during Q2 is to look at all the use cases that we had implemented for customers and looked at, how applicable it is within that vertical or across verticals, and then assume that, if we got X more customers over the next 3 to 4 years, given the revenues that we've got for each of those implementations, what would that turn out to be? Aggregated that, and that's how we came at around $50 to $60 million for these 22 replicable use cases.
Well, that is happiest minds for you, and the stock is moving up post this interaction. Basically, the company is saying that double-digit revenue growth for 4 years versus earlier they were confident of achieving it for 3 years. Now they're saying 4 years. And there are two key reasons. One, the generative AI business unit. That, based on what they have right now, they believe can generate revenues of about 50 to 60 million over the next 3 to 4 years. And secondly, they did a lot of reorganization, but they basically got a sales team, dedicated sales team. So the net new logo addition has been very strong. Okay. So that's about 30 in the first half. And that also, when they extrapolate the performance, they're saying that will again, add about 50 to 60 million in the next 3 to 4 years. So which is what makes the company confident on happiest minds. All right. We will slip into a break on that note. On the other side, we'll focus on the crypto market. Dilip Chinoy from Bharat Web3 Association will join in on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back, and joining us now to talk about cryptos is Dilip Shenoy. He's Chairman, Bharat Web3 Association. Mr. Shenoy, hi, thank you so much for joining in. You know, first of all, since the time I've started doing cryptos, October has been called as the Uptober, but we haven't seen that turnaround this time, would you say?
Yeah, you know, actually, Manisha, the difference this year versus the last few years and the last so-called bull run was that this year the things started pretty early, right? And there was a continuous kind of increase in prices, but very interestingly, reaching close to 120, say Bitcoin. It did have a kind of a dip, which was linked to various other factors other than the crypto, and it is very interesting. And there was a dip, and now, of course, it's around 113 thereabout. And you were seeing over the last few days huge liquidation going in. But also, what is happening is that there are new products coming out in this space. We've recently seen that, the exchange-traded funds are even being extended to Solana and to other such virtual digital assets. So you are seeing this happening. You're seeing a little bit because of the price movement of both Bitcoin and ETH. You are seeing some different, challenges there in the exchange-traded funds and in the spot kind of sector there. But I think the October got preponed to September, but let's see. There is a lot of currently a lot of guarded optimism going forward. But of course, what is interesting, and very recently there was a kind of analysis done that some of the largest or some of the more critical virtual digital assets are getting correlated as close to 0.87 with the S&P 500 and with the Nasdaq. So that's how it is actually moving currently. But yes, the last 2 days have been very significant in terms of a kind of
declines coming in. Well, yes. Mr. Shenoy, also comment on the kind of moves that we've seen in the global markets. I mean, there have been big names really on how, big companies are tying up with crypto companies and trying to put in more products and facilitating crypto trading, even collateral management for that sense. How are we looking at all of this progress on one side and India still waiting and watching?
Manisha, it's very interesting. If you just see the last 2 days, right? Let's not go back. Let's not talk. There is a significant change in how virtual digital assets are being looked as an asset class. Okay. The first very interesting, statistic which will be of interest. If you take Bitcoin, right? There are 21 million Bitcoins in circulation, out of which 100 companies, right, including companies such as Time and other companies. Of course, MicroStrategy is the leader in this space. They have treasuries, and these 100 company treasuries account for 2.1 million of the Bitcoins. I mean, 10% of the Bitcoins are kind of in corporate treasuries. Okay, you are then seeing, country after country in the US, state after state, including nationally, looking at setting up strategic Bitcoin reserves. Okay. That is slightly different in the sense that these are the Bitcoins which have been seized or which have been have been taken from, by the law enforcement agencies and with the state, and they're creating Bitcoin reserves. But what you're actually also happening is you're seeing many new products coming out in the marketplace. For example, there's a X402 protocol, right? It's kind of like the HTTP is known as the web, right? It's a HTTP native payment protocol designed by a company which has kind of revived the old HTTP 402 payment kind of required. It allows websites, APIs, and even AI agents to request real-time payments directly through standard web payment systems, right? No subscriptions, no middlemen, And if this becomes mainstreamed, right, then you'll see, payment costs as 0.001 or 0.001, rupee, right? That's like less than, 0.1 paisa for a transaction. And this is a very interesting development. In the other side, you're actually seeing something interesting happen, right? You're seeing, traditional finance companies and blockchain converging faster, even as major institutions kind of, go in for tokenization of real-world assets, setting the stage really for a massive transformation in digital asset space. Now, there was a very interesting study which actually came out it was done by Aptos Lab and BCG, looking at the Hong Kong market, which came out yesterday, which are saying that the Hong Kong people are looking at transiting to tokenized assets because they enable real-time settlements, lower transaction fees, etc. And if you're even seeing that there are blockchain technology continues to accelerate as a major financial, institutional kind of a capability. You're seeing products developed by HSBC, by JP Morgan, by others. The Bank of New York just very recently, has introduced, as its core service, banking as a service infrastructure, providing for a digital asset platform. So banks also are getting into this. So there are multiple things happening here. You're seeing a lot of collaboration happening. And of course, the stable coins business is a totally different thing where every major financial institution is coming into it.
Oh, yes, Mr. Shenoy, there's no dearth of the newer things that are happening. But, well, as you said, most of them are still happening outside India. And October is not really October, but September did see a lot of gains coming into the market. But your point is well taken. As you say, 10% of Bitcoin being held by corporate treasuries. And then you have banks, countries actually working towards whether it's payments or tokenizations or real-world asset management that we are seeing happen in case of cryptos right now. But with that, it's time for a short break. More market talk on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. DCM Shriram is trading in the green. This is after the company reported a 71% surge in their Q2 EBITDA. But the company also announced the acquisition of 4 industrial salt companies to enhance their capacity. Amit Agarwal, Executive Director, Group CFO of the company, is now joining in. Thank you very much, Amit, for joining in. Let's start with the rationale for the acquisition. What does it bring on the table? What does it do to your existing supply chain, backward integration? And once it comes on board, what will it do to your overall financials?
Sure. So, our capacity, the caustic soda capacity, is about 1 million ton, and which means we require almost 1.5 million tons of salt. And salt forms about 20% of my cost of production. Now, in terms of the total capacity in the country, the production in the country is about 34 million tons of salt, expected to go up to about 43 million tons by 2030. And the availability of new salt mines are far and few. That is point number one. So which means that we need to assure our supplies. Second point is the salt prices. If we see last 9-year trends, they have grown at a CAGR of almost 12%. So that's the other reason. So the idea is secure our salt supplies and also get more assurance on the price of salt. Given that the demand is going up and the availability of salt is going to get a little limited, is what we feel. So this is more a strategic acquisition to ensure our raw material.
So it will not have any positive impact on margins then?
So it will, because see, today I'm buying salt at a price, and salt, there are very good margins on salt for salt producers. So we will get salt at the cost. So it will add to the profitability.
Okay. This time around, profits were also higher because of Hindustan Specialty Chemicals that you had acquired, right? Can you give us a sense of how much was the impact? Because the EBITDA has surged quite a bit, margins are higher. Strip off that, what was the organic growth?
Yeah. So let me talk about organic growth first. So the entire growth is driven by 3 factors in the chemicals business. One, it is driven by the volumes, and primarily by the volumes, I would say. And the volumes are coming from caustic soda. It is coming from hydrogen peroxide that we had commissioned last year, from glycerin sales, purified glycerin sales that we are doing. So largely these are the factors which are driving the volumes. In terms of margins, they are being driven by better product prices. Again, primarily in caustic soda, the ECUs are better. And also our cost structure, which I had mentioned the last time as well, that our cost structures over the last 1.5 years have come down by about 15 to 20%. So that is the reason why our profitability has inched up, volumes and margins. Coming to your point of Hindustan Specialty, see, the plant was acquired, or the business was acquired by August end. On 26th August is when the closure happened. So it's been just 1 month. And the business has been making losses in the past. When we, FY25 also was a loss-making year by the earlier management. So it'll take time for us to turn it around.
What's the overall revenue guidance? You've done about 10.5% in Q2. You last time told us about 11 to 14% for the full year.
So I would, say it will be more towards, in the range of 12 to 15% is what I feel for the year. Our revenue should be higher.
And can you give a color on the individual segments in terms of the H2 outlook?
See, H2 outlook, given some of our businesses are very seasonal, like sugar and farm solutions. So these will see a lot of profitability coming in, along with the chemicals that will continue to have higher profitability.
Okay. Amit, that has always been a question because you have so many segments within the business itself. Do you think someday for more value unlocking, there could be demerger on the cards, if not of all the segments, one of the segments, which is sugar, which because of government policies, because of macros, is under pressure?
So, see, but let's look at how the company is looking at growing the overall business. I'll come to your specific question as well. See, one, the company is looking at growing, and you would have seen a paradigm shift in the way DCM Shriram has been working in last 3 to 4 years. It has been making significant investments across the businesses. It is also, this year has been, I would say, year of acquisitions. We have grown organically, but we have done a lot of acquisitions, and there are a few acquisitions in the pipeline. Now, that is what the growth mantra is. That is point number one. Second, coming to your point, if you remember, in March this year, we had already announced that company is exploring options of demerging its consumer-facing businesses. So we are in the process of exploring those options, where we would like to demerge our consumer-facing businesses, which are Fenesta, our agri-inputs business, which is Farm Solutions, and our bioseed business. So these three businesses are in the offing. To your question on sugar, we will look at it as the board, feels the right time.
Amit, great chatting with you. Thank you very much for joining in. Here is a quick note for all our viewers. If you would like to access expert-driven insights and actionable chart pattern, simply scan the QR code on your screen and subscribe to Money Control Super Pro and get daily expert calls, actionable charts, insights to power your investing decisions. Plus, this festive season, there is more reason to celebrate. 10 lucky subscribers every day will win 1 gram of gold. So don't wait, scan, subscribe, and make your portfolio shine brighter with Super Pro.
Welcome back. Well, SEBI has proposed a major overhaul of India's mutual fund fee structure to simplify charges, boost transparency and reduce investor costs. SEBI, in a consultation paper, has proposed to lower the expense ratio charged by mutual funds, and Jefferies believes that a 5 basis points cut in equity exit load related charge can impact AMC profits by 8 to 10% if implemented in FY27. To understand the impact of the proposed norms, we are now joined by Akhil Chaturvedi, who is the Chief Business Officer and ED at Motilal Oswal AMC, and Shweta Rajni, who is the Associate Director and Head of Mutual Funds, Anand Rathi Wealth. Shweta and Akhil, good morning. Thank you so much for joining in. Shweta, let me start with you first up. How significant is this move if the proposal actually goes through? We are talking about a cut in that 5 basis points fee that is charged, but at the same time, the base level charges, they have been raised. So will it be neutral for AMCs and investors, or is it largely in favor of investors?
Good morning, Sonal. So firstly, I have to say, the overall circular, if I look at it from a client standpoint, it's very good. And, over the years, we've seen SEBI has been focusing towards investor protection, investors' benefit, bringing in transparency in mutual funds, having more disclosures. And this is one welcome step, towards that again. Specifically talking about the 5 bips exit load, see earlier on, also, if you see this till 2018, this used to be 20 bips of exit load oriented fees charged, which was brought down to 5 bips. And this was any which way is supposed to be transitionary in nature. This 5 bips actually goes back into the scheme. It doesn't go into the AMC profits any which way. So from an AMC profitability standpoint, I don't think it's going to have any implication. From a expense ratio standpoint to the investor, this is again a good thing because it will reduce the expense to that impact. Because earlier on, what would happen is if the base TER was, let's say, around 1.8 and then you had this additional 5 bips. Now, while there has been a reduction on the total base TER as well, this 5 bips is now included as a part of that TER. So it brings down the expense for the scheme for the investor. So for an investor, this is good because it will mean marginal improvement in the NAVs and the return that you would see. As far as an AMC is concerned, this used to anyways get passed on to the scheme, not to the AMC profitability, so it should not have an implication there.
Oh, okay, all right. So it should not be that big an impact on the AMC because it was passed on to the scheme. Akhil, what's your take and how do you view these proposed changes?
So I agree with Shweta that largely the regulator is keen to ensure that as the industry scales up and reaches newer milestones, there are economies to scale, and and such economies of scale, probably should be passed back to the investors. So cost coming down in any way is always positive for the investors because the leakage of return actually drops down. Now, broadly what we see is there are 2 large changes from investors' perspective. The larger change, what we see is obviously the cost of trades where we were paying up to 12 basis point as brokerage. This comes down to 2 basis points. So that's a straight shot 10 basis point benefit back to the investors. So that's a significant, I think, development, point number 1. From the AMC perspective, like Shweta mentioned, 5 basis point, which was being charged in lieu of the exit loads, now goes away, right? And they're saying that they've included that in the first 2 slabs. But having said so, the base TERs have come down by 15 basis points. The only flip is that the statutory charges like GST, STT, all of these charges will be now loaded on the total TER and will be then eventually passed on to the investors, right? So, net, I feel that there is a marginal impact on asset management companies and distribution, but a big benefit coming to investors by way of operating costs coming down via reduction of cost on the trades.
Okay. Will this new framework meaningfully reduce the cost gap that we see between active and passive funds? Shweta, let me start with you first on this.
Yes. So, let me talk about a passive fund today. If you're investing in an index fund, most of them have, while they're allowed, I think, 1%, they generally would charge somewhere around 50, 60 odd paisa as the base TER and little add-on to that. So even in the passive fund space, there's been a 15 paisa reduction now to that 1%. It's come down to 0.85. So to that extent, it's a 15 bips reduction. But your brokerage and all those costs included, if I look at even the active space now, clearly between the 2 fund structures, active and passive, in the active side, if you put everything together, the reduction in the TER, the exit loads going away, the brokerage costs coming down could mean somewhere around a 20 bips of reduction across the slabs on the expenses. So would it bridge the gap between the returns that you see? Definitely. The cost reduction would mean that your active fund is seeing little more reduction in your expenses. To that extent, the return differential between a passive and the active fund would go up. The costs would come down between the two. The cost gap would come down, I would say maybe around 10 paisa. And to that extent, the performance of the active funds would further go up.
Okay, and that continues to be the debate always, active versus passive. How do they perform in a market like this? So you are saying the cost would go down and active funds would perform better in that case because of the cost differential that would come by. That's an important clarification. Akhil, the other part of this notice has been that this performance-linked TER framework, which the AMCs can or cannot adopt. The other one is separated execution from research cost. Both of these, will that be a challenge for AMCs, or do you think this is a welcome move?
Oh, so on the first part, obviously, I think it's a welcome move. Since we also run a large alternate book, and we see that a lot of the high net worth family offices, they prefer to have lower fixed expenses, and a lot of the performance fees needs to be paid once the manager performs. And that kind of a structure, if it can be implemented on the mutual fund structure, so definitely from HNI's perspective, I think it's a welcome move. Now, how and in what format it will happen, obviously it needs to be seen, and we'll wait for a lot more clarity. But if there can be a separate, like in alternates, we have separate share class. Here, if we can have a separate performance plan, and what kind of flexibility is given in terms of hurdle rates, the carry share, etc. But clearly there is an audience in the market who's looking at rewarding the fund managers basis their performance, and will have one more option to choose from between a fixed fees or a variable fees basis the performance. So I think definitely it's a welcome move.
Okay. Okay, all right. We have a lot more questions, but we are lacking time. So I think we'll take this forward on another show. But thank you so much for joining us today, Shweta and Akhil, and making sense of these moves. Of course, these are just proposals as yet. There's no finality. The last date for comments is 17th of November. So we'll get more updates on that by then. But it's time for a short break now. We'll get you more on the markets on the other side of this very short break. Stay tuned.
Welcome back. First day of the new series. Mangalam now joins in to bring us the latest trends from the futures and options space.
But it's been a good start to the November series after what was a good October. So the November series, you have the Nifty, which is doing well. You have the Midcap index, which is doing well as well. The only thing which is conspicuous by its absence right now in terms of gains is the Nifty Bank, which is a mild underperformer. But if you look at the top contributors, despite the Nifty Bank underperforming after having done extremely well in the October series, we have the Nifty IT index, which is pulling back. We have Reliance, which is holding up ever since its second quarter numbers. And today, metals have also begun to shine ahead of the US FOMC meet. So that's a big positive as well. But we're talking about good October series. Remember, the FIs first started the September series with just 8% short positions, and that went lower to 6% at the start of October. And in just the last two series, the Nifty has added nearly 1,400 points. So that's a big positive. How much further does it go from here depends on whether it is able to cross that 26,104, 26,150 sort of mark as well. What it's also done is that now that we're comfortably above 26,000, the 26,000 put writers have taken some heart. So they are adding some positions. So maybe the support for the market has moved higher, though on the way up, we still have resistance around 26,150 to 26,250. That's what the call writers at 26,100 are playing for. Let's see where that goes, because we do have a bunch of triggers for the November series. We have the US FOMC outcome, so a rate cut would be a positive for a lot of these sensitive sectors in the US and related sectors in India as well. Developments around trade deals. We're getting comments coming in from Donald Trump, but it's not just US-India, China will also have a bearing on the business and the remainder of the second quarter results. So I'll watch out for that. One pack which has caught my attention today is the Adani Group stocks. All of them fairly well traded and at the same time well bid as well. So day one of November series, the Adani Group stocks are seeing a lot of long positions being added.
All right. Thank you so much for joining us with all those details, Mangalam. With that, we'll slip in a short break. On the other side, we put the spotlight on Suraj Estate developers in our special segment Under the Lens.
Welcome back. Shifting focus now to Under the Lens. Sonal is here to tell us why she's watching Suraj Estate Developer. Sonal.
Thank you so much for that. Well, Suraj Estate Developers, the Mumbai-based real estate company with a strong focus on redevelopment, is on our radar today. Now, remember, the stock saw its rise of nearly 9% yesterday, but it is still down 55.5% in the past 1 year. In fact, the stock listed last year at 340 rupees a share and even now trades below its issue price. Now, let's take a look at the Q2 numbers, and that's why the stock was on our radar as well. Sales value came at 153 crore rupees, which is above the 107 crore mark last year. If we talk about sales volumes, that also improved on a YOY basis to 34,875 square feet, but collections were down sharply. They came at 71 crore rupees. Even average realizations have declined on a YOY basis, as you can see on your screen. The company says realizations were lower because of a higher contribution from the value luxury segment, while cash collections were impacted by new projects still in early stages. Let's talk about the balance sheet side. Borrowings have jumped to 480 crore rupees, which compares with 356 crore rupees, while both cash and bank balance that has declined on a YOY basis. The company says they have 17 upcoming projects and 12 ongoing ones, with plans to launch around 2,000 crore worth of new projects this fiscal itself. But here's the concern. There's been no major launch in the past year, and operational cash flow for FY25 stood at a negative 306 crore rupees. Working capitals also stretched to around 776 days versus 532 days a year ago. In terms of shareholding, promoters hold nearly 70%, around 69.6% that is. AIFs have 0.93% and FPIs hold 1.7% stake. And also otherwise, to put things in context, let's do a peer review, right? Suraj's Q2 pre-sales came in at 153 crore rupees. This compares with the peers in this way. Sunteck Realty at 702 crores, Kalpataru at 1,329 crore rupees, Sobha, the Bengaluru-based player, at 1,900 crore rupees. Prestige, of course, is a sector leader as well. In Q2 saw 6,000 crores of sales. Signature Global, the NCR player, is around 2,000 crore rupees. So while Suraj Estate is scaling up its redevelopment footprint, cash flow pressures there. We are talking about rising debt and lagging sales momentum. They are the key overhang. So watching out for what these new launches do for the company and whether or not they are able to scale their peers or at least grow at par with the industry levels or not.
Interesting. Thank you very much for that. Varun Beverages numbers are up for you on your screen. Top line growth has come in at just about 2%. We will wrap up on Trading Hour from the entire team. Thank you for watching. Don't go anywhere. On the other side is Halftime Report.
Nifty hovers around the 26,000 mark with small gains since the last session and positive market breadth. Metals and energy gain, while financials and auto drag.
SEBI issues a consultation paper on mutual fund rules that seek to enhance transparency on expenses, but also trims outgo to brokers. The tightening move spooks stocks and of AMCs and other market participants.
Copper nears its all-time high. Aluminum scales to a 3-year high, and zinc trades close to its 10-month high as optimism over a US-China trade deal coupled with supply concerns give bulls reasons to cheer. Indian metal stocks too rally.
US President Donald Trump says he's going to do a trade deal with India, adding that he has great respect for Prime Minister Modi. The remark sparks hope of a deal soon, even as positive indications in the past haven't translated into anything material yet.
And all eyes will be on Federal Reserve's rate outcome, which is expected later tonight. A CNBC survey of respondents expects a rate cut in this meeting, with majority of respondents expecting rate cut also in December.
Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra, and with me is Vinny Motiwala as well as Mangalam Malu. Well, it's turning out to be a session where we have seen some amount of recovery. So the Nifty is above 26,000 or just about at those levels at this point in time, up around 0.3% currently for the Nifty. Well, we do have a lot of news globally to reckon with. We do have metal prices which are going from strength to strength, and separately we do have the Fed meet outcome to reckon with, which we will be reacting to come tomorrow's trading session. As of now, a lot of stocks in focus, so the likes of Blue Dart, Gohans Life, SAIL, GAIL, all of these stocks which are buzzing around in trade today. Hi guys.
Hi Ekta, as we speak about individual stocks, I'm just wanting to bring our viewers' attention to Varun Beverages. The company reported its numbers. The net profit was up 20%, the revenues were up 2%, and then that's not particularly bad, because the second quarter, or in their case the third quarter, actually was severely impacted by unseasonal rains in India, and a large part of their business now perhaps would have come in from some of their international operations in the quarter that went by. But more importantly, apart from these numbers, the company has changed one thing in their object clause of the Memorandum of Association. What it says is that the company will now carry on the business of manufacturing, producing, processing, brewing, alcohol, which includes the like of beer, wine, liquor, spirit, brandy, whiskey, gin, rum, vodka, be that as it may. So beyond just a beverages company, a carbonated soft drink company, the company will now get into alcohol as well. And perhaps there is an acquisition that they've made in South Africa to get into that business. Remember, globally as well, they have a ready-to-drink cocktail pack, PepsiCo, and as does Coke. Whether that comes into India or not is not the big story. The big story is them getting into that, and perhaps as a result of which going with another big total addressable market.
Yes, absolutely. But a natural progression if you talk about the logistics and the basic business that the company is in.
A natural progression, yes, basis the business that they're in, but absolutely non-natural when it comes to regulation. Because, that for a carbonated soft drink versus alcohol in India, Alcobev, regulations are extremely different, which is why perhaps they would have started out
the business of drinks.
Globally, yes.
Yeah.
Not
Now
so
they're
much in
catering
India.
to you as well as us, Mangalam.
Yes.
For all of us now. But yes, it's an interesting update that comes in there for Varun Beverages as well. And that is what we'll be keeping an eye out on. But today, apart from that, the Midcap IT, that's picked up a bit of Midcap. Nifty has also picked up a bit of space. 0.3% of gain is what we're seeing for the Midcap, as well as in terms of IT managing to hold on to good gains as well. But let's shift focus and put the spotlight as Indian refiners are now scaling back from Russian oil purchases on the back of the international sanctions that have come in. What could be the impact of this on the Indian economy and in terms of the refiners? We spoke to Axis Capital's NLensKart Mishra on this as well. Listen in to what he had to say.
Exact advantage or the relative advantage that India had from buying Russian oil had actually shrunk to almost nothing over the past 1 year. So the gap between Brent and Urals was $30 a barrel in 2022 when the first sanctions were imposed. It had actually shrunk to $4 or $5 a barrel over the past 12 months. And once you adjust for the higher cost of insurance and freight, the landed price advantage was like $2 or something. So it's not that, India was benefiting greatly. Now we are at a stage where oil markets are significantly oversupplied. This is part of the reason why you're saying that Brent is back to 64. I mean, it was 60, 61 when the sanctions on Lukoil and Rosneft were announced. So there is enough oil in the world. India, you're absolutely right, imports 85% plus of its oil needs, more than half of its dense energy needs, and these are things that India needs to work on. But at this stage, from a cost perspective, remember last year, the average Indian mix, which is closer to Brent, the prices were $10 a barrel higher. So as of now, it's not a drag on the economy. I think diversification, and remember, Indian refineries are some of the most complex in the world. Their ability to handle all kinds of crude is proven. And therefore, I don't see any India-specific reasons to worry about the sanctions affecting the Indian economy.
All right, that's about, in the impact that could be on account of reducing the imports coming in from crude from Russia. Let's welcome Mr. M.K. Surana, who's the former CMD at HPCL, who joins in now to take this conversation further. Mr. Surana, back when we were importing a lot, the difference between crude oil imports from Russia versus other parts of the world were a lot more. Right now, at current levels of crude, what do you think is the delta? And do you think it would make a big difference? How does sourcing change?
No, what you say is correct, that once upon a time, the discount was substantial. It was double digits. And currently, it has got tapered down substantially in last few months. And it is, let's say, in the range of around $2 per barrel. So whether we continue to take Russian oil or we do not take, it is not going to make that significant difference now. Anyway, once upon a time, we were not taking Russian crude. And it is only when the discounts were beneficial and it was offsetting the transportation cost, that's where it started becoming lucrative.
Okay, so Mr. Surana, there's limited amount of benefit now because the discount has come down to $2. One can assume that.
Yes, it is not a substantial impact as far as the crude barrels are shifted from, let's say, Russian barrels to somebody else.
Okay.
The impact may come if complete stoppage of Russian barrels in the global supply chain. In that case, there may be some impact, but because of fast rollback of the production cuts by OPEC, a part of that is also mitigated.
Okay. Just wanted to understand that what exactly will be India's sourcing strategy now that it is going to possibly be cutting back on Russian crude imports?
The Russian buys by all the companies is based on a techno-economic analysis. So it is not just the price, but also the quality of the crude, which reflects into the gross product worth of a crude, and which is decided by the assay of the crude. So all the companies evaluate all the crude which is there in their basket, depending on the structure of their refinery and the technical capabilities to handle it. And based on that, which is the most beneficial crude, that is decided. So there is already the African crudes are there, Middle East crudes are there, Far East crudes are there, Latin American crudes are there, US and Russian crudes are there in Indian refineries baskets. And refineries have got a wide basket of the crudes which they can process. So depending on the techno-economic analysis, they will continue to decide which crude is beneficial, and depending on the product slate and the refinery configuration.
Right, Mr. Surana, but is it easy actually to increase sourcing maybe to a different country in terms of, the benefit that they would get? Or how does it work actually on ground? Because on quarter basis, do they get to make that change that quickly?
Oh, the refineries have got a mix of term crude and the spot crudes. And basically the type of crudes, if you see, you can decide into low sulfur crude, high sulfur crude, high TAN crude. There are different specifications of the crude, but all the crudes can be put in some large baskets. So for example, the Middle East crudes are normally medium to high sulfur crudes, while the African crudes may be low sulfur crudes. And depending on your refinery configuration, the product slate, the specification of the products which you are making, and the downstream units which you have to remove sulfurs or the impurities from the product, You take a basket of the crude, which will give you the best objective function. That is basically the margin in the refinery. Now, so it is a combination of all these which decides which crude you will take and in which mix you will process. And one important parameter is the API of the crude, which decide whether the crude is heavy, light, or something like that. So while there is a design crude by which the refineries will give the best optimum result, but there is quite a wide range and flexibility available because no refinery decides to put all his eggs in one basket or design the refinery only from one particular crude in mind. There is a design crude, there are check crudes, and there is a flexibility available around which the refineries can always operate. And there will be some some plus and minuses in doing different points, different type of things. And there is some operational flexibilities also available to run different type of crude, which is built in at the time of design of the refineries.
All right, net, as per you, how much could the near-term impact be? And overall, do you think there is the possibility of us going back to Russian crude as things, again start to turn into India's favor when it comes to prices?
So if the pricing economics benefits, why not? So basically, just let's say 3 years back, we were not buying at all. Yeah. When it started becoming advantageous, we started buying. Now there is a geopolitics around it. So there is a larger context which this issue of Russian crude has come in, which is not purely the refiners or the design issues. If suppose those issues are not there, then it will again pure techno-economic analysis, and if it is beneficial, why not? It should be done.
And as per you, at what crude prices do you think it gets a little more beneficial?
It is not only the function of only the crude price. As I mentioned to you, it is function of the crude price, the product, gross product worth, what we call is, that is the quality of the crude, that not all the crude give the same product slate.
Yeah. Okay.
The third is the transportation, insurance, and also what are the product cracks available. So you have to make up for the refinery operation expenses out of that. So it is not just the crude price which decide the refinery profitability.
Okay. All right, Mr. Surana, we're going to leave it on that note, but definitely a discussion that we will be revisiting up till the 21st of November as well. But thank you very much for joining in and speaking with CNBC TV18. Well, we need to take a short break on that note, but Cohan's shares have fallen nearly 10% in trade after the MD has resigned. The management will be joining us for further clarifications after a short break. Stay tuned. Welcome back. Well, 26,058 is currently where the Nifty is at, up around 0.5%. We have the Midcap index, which is up around 0.4% as well. Well, let's talk about one particular company, Cohance Life Sciences, which is down around 10% or was around 10% lower in, early trade. The stock should come up for you. Now, the reason why the stock has been in focus since last evening is because the MD of the company, Mr. V. Prasad Raju, has resigned for personal reasons, and there was a conference call which was held by the management at around 8 p.m. last night to talk more about the development. But we do have with us Mr. Vivek Sharma, who's the executive chairman of the company, to discuss a little more about this. Mr. Sharma, thank you very much for joining in. I'm sure it's a very busy day where you're fielding a lot of calls with regards to this particular piece of news. So just take us through it. The MD has resigned, and this is not the first resignation we've seen in the company in the past few months. You had your CEO resign in the month of July as well. Just tell us, what's the reason?
Yeah, hi, Ekta. Thanks for having me. So Dr. Prasada decided to resign for his personal reasons, and then the board has accepted his resignation, and he will be with us to serve his notice period and slightly longer than that to continue to make sure that, we are transitioning everything the right way. However, as you know, the company is evolving and moving to a tech-driven CDMO. And as part of that, we have been upgrading talent, and we have restructured the company into 3 verticals: CDMO, API Plus, and Specialty Chem. And all these 3 verticals, we've hired new CEOs in the last 6 to 9 months or so. So as a new organization, as we are a platform company, combination of 6 different unique companies that have come together to create this unique platform with a commitment to be $1 billion revenue company by 2030. We've been adding a lot of talent. We've been restructuring the company. We are excited, I think, about the potential that it holds, and we are committed to really work on making sure that our customers and investors are taken care of through the efforts that we are putting together.
Okay, so you're not going to be hiring a new MD then?
That's right. So we are restructuring the company as we announced to the analysts yesterday. With the changes, we have hired 3 new CEOs over the last 9 months or so. These verticals, these 3 CEOs will report directly to me along with functions of HR and finance. We are creating a new position of COO who will help us at platform levels with operations, including supply chain, EHS, and other functions that are important for the business, while the CEOs will be independently responsible for end-to-end P&L for their businesses. So yes, we are not hiring a new MD or CEO to replace Mr. Prasada.
Right. What kind of improvement in metrics do you expect due to this change in management structure? Because now there will be CEOs for each departments that you're talking about. What, according to you, could be the benefits on revenue and efficiency?
So I think there are 2 or 3 things, in terms of benefits. One is that complete end-to-end ownership, including front-end facing and commercial teams. So, we cater to while we support pharma companies and, companies, but the buying segment is slightly different. So expectation is that our pipeline should increase. If you're really asking for a specific metrics, our brand name should get out more, and then we should see more visibility and more integration with customer. Our pipeline on product should increase from an API and formulation perspective, and the same thing with the AgChem. The people that we have hired are industry experts. All 3 of them have 20 plus years of experience in the industry. So, and they have built their commercial teams as well, right? So we are excited about the potential from a customer perspective that all 3 of them bring, in addition to the operational background that they have.
Sure. Sir, what is it in terms of any impact that you've seen coming in on the business, or maybe discussions with clients, given that, these changes have come in the recent times in the last year, 2025, maybe a couple of changes. So, because of that, any impact over there? And what was the strategy, to actually why? Breaking up into 3 segments, CDMO, API, as well as specialty chemicals.
That's right. So I think few things, if you look at the journey, Cohance as a company did not exist 5.5 years ago, right? This is a new platform that has been built, started with APIs, got into CDMO, and then from CDMOs also into tech-driven CDMOs. And as we are evolving, as we are moving upscale, as we are moving, we need talent at different levels to help us accomplish the vision that we have set out for the investors and customers, right? And the new hires, they come with very unique experience into the segments that we aspire to really grow. So we really need to bring in industry experts that can help us achieve that. And that's why we have focused on different segments. And while we have these individuals, we have also segregated operations in a way that there is complete ownership and accountability of these individuals so that they can go with full speed, full direction to really go and create value for shareholders as well as for our customers, right? And because the nature of business is slightly different from a customer, one is a product business, one is a service business, right? You need a different mindset and different people. And that's why the differentiation, so that we bring in more focus and energy to accomplish our goals.
Sure, that point is taken, Mr. Sharma. But, you know, I'm sure your clients must be having a couple of questions as well because of maybe the little bit of instability that they've probably faced because of all of these changes. Has it impacted business on the ground at all? Have you communicated about these changes to all of your clients? Has the communication been widened? And if you could just give us a sense in terms of what your client apprehensions could be right now.
Sure. So I think, you know, listen, two things. The pieces of the companies has been existent for 2-3 decades, actually. And there are customers in our setup that have been with us for 30 or so years, while most of the employees have not been here that long, but the customer has been committed because they have seen continuity, they have seen quality, they have seen, the delivery from the organization. As we are talking right now, we have a very large event going on in Europe, CPHI, where our CDMO business and the API teams are all there, and they're meeting customers face to face and discussing with the customers. With the change in structure, with the 3 CEOs, we had already moved the customer relationships and the customer connects to these individuals in the last 6 to 9 months. So from a direct contact perspective, there is minimal impact on customer connect because the relationship was being handled by these 3 CEOs. And as part of a strategy, as part of our monthly, weekly, quarterly calls with customer, we keep them updated on the direction we are taking. So it should not come as a surprise because they were dealing with the people that they are dealing. They are there and they're meeting face to face in this event, CPHI in Frankfurt right now.
Okay, all right, Mr. Sharma. Well, we are definitely going to extend this conversation when you do come out with your numbers later on in the month of November. But thank you very much for joining in and wish you luck with all of the managerial changes which you have taken place, which has taken place at Cohance Life. That's stock down around 8% at this point in time. We'll take a short break, but a quick note for our viewers. If you'd like to access expert-driven insights and actionable chart patterns, simply scan the QR code on your screen and subscribe to Money Control Super Pro and get daily expert calls, actionable charts and insights to power all your investing decisions. Plus, this festive season, there's more reason to celebrate 10 lucky subscribers. Every day win 1 gram of gold. So don't wait, scan, subscribe and make your portfolio shine brighter with Super Pro.
Welcome back to Halftime Report on CNBC TV18. As of now, Nifty managing to hold on to 26,000 levels. Nifty Bank at 58,300 as well. But what are we watching out for in the world of F&O? We have Mangalam at the F&O desk to give us all those details. Mangalam.
Well, we're at the high point of trade, and it is a good start to the November series. After a near 1,300-point rally that we saw in the October series, November series has done well. The good part is that it's holding above that 26,000 mark. Remember, thrice in the last 1 week or so, every time it went past that 26,000 mark, there was selling and it closed below 26,000. So closing above 26,000 will be extremely crucial today. The mid-caps are doing well. The only one conspicuous by its absence in terms of gains is Nifty Bank, which is further off the lows of today's trading session, but not as well bid as, say, something like the IT space, Reliance, or even if you look at, the metals index. All of these are actually the ones which are powering the Nifty ahead. But the Nifty Bank had a strong October series, so not a problem when it has 1 weekday in the start of November series itself. The important part, however, is that after a near 1,400-point rally in the last two series, September and October, where do we go in November? And that we have a lot of triggers to track. The most important one, of course, is that after today's move, the support for the market has moved higher. So the 26,000 put comes up for you. That's seen a fair amount of writing for a premium of 83 rupees. Again, telling you that the street believes that 25,900 to 25,950 would be an important support, which is 100 points higher than what we saw in the last few trading sessions. But on the way up, crossing past 26,200 and 26,300, closer to that all-time high will be very, very crucial, which is what, the 26,100 call writers believe would end to see some sort of profit booking if that were to happen. Watching out for a couple of triggers for the November series. We obviously have the outcome of the US FOMC meet where a cut is expected, then developments around, the trade deals, China, India, US, all of that, and the remainder of the second quarter results. And so far, the results are actually not been worse than what the street was fearing. And finally, just watch out for a bunch of stocks which are doing well in today's session. The Adani Group, actually fairly well bid. A lot of long positions added on Adani Green, Adani Energy, or even something like an Adani End.
Okay, Mangalam, thank you so much for that. But on that note, we're going to slip into a very short break. On the other side, Manisha Gupta will join us, who will be in conversation with Thomas Matthew. So stay tuned in for that conversation.
Welcome back. Well, Joy Lucas has clocked record sales this Dhanteras and they remain bullish on gold. Our colleague Manisha Gupta caught up with Thomas Matthew, who's the executive director of the company. She began by asking the festive season sales. Listen in.
This Diwali and Dhanteras period has been tremendously successful across the industry. We as a company saw a turnover of around 440 CR just the Dhanteras day alone, and that particular week of Dhanteras we did 1,163 CR. So it has been the best ever sale that we have recorded across all the Dhanteras that we had so far within the company. And the industry has responded fairly great. We saw a huge uptick in the average customer size percentage when it comes to them buying gold, diamond, as well as all the studded category jewelry. All right, that's amazing numbers, by the way. So when you compare it to last year, how does it stand? Is it higher in value and volume both? Yeah, both in terms as to the amount, the quantity of gold, as well as the value, it was higher. If I take the one-day sale, it was up by 94%. And if I take the whole week of Dhanteras, it was up by 80% in value. All right. Big numbers coming in there. Mr. Matthew, what is the sense that you get going forward from here? What are Joy Lucas' plans now? Because we're getting into a wedding season from here on. So while, of course, Diwali Dhanteras is important, but wedding season equally important. And the next 2 quarters perhaps would be all about that, would you say? So there is some fluctuation in the price of gold, but overall we stand very bullish. We feel gold is going to go substantially higher. So we are very bullish, and then we are stacking up inventory as we speak. We ended the year, the period fantastically so, and we are making sure that we have all the right inventory as we go forward. One of the things that we are doing is we are doubling down on our studded segment. That is basically your uncut, your white diamonds, as well as your precious category, because there has been a lot of focus on the studded space as the price of gold has gone up. But overall, we feel very happy with how the situation has turned out. And the customers who have been putting aside the major purchases for their wedding purchase, or let's say the daily wear category, has flocked in during this Diwali period and has utilized the offers that we had kept. And as a company, we have around 176 showrooms across 12 countries. Australia was the last country that we added just this month. We opened a new showroom in Sydney as well as Melbourne. Going forward, by the end of this financial year, we are planning to take that number to 200 stores across the 12 countries that I just mentioned. Mr. Matthew, that was going to be exactly my next question. So total stores, you say, is 176 in 12 countries. How many of this is in India, and what is the number that you have abroad now? And while you say that I missed that number, how much are you looking at by the end of FY26 now? So right now we have 176 stores. Out of that, 110 stores are from India, and the remaining are in overseas countries. We have 11 locations outside of India. So that number, we are planning to take it to 200 or 200 plus, depending on how when the work gets completed for these locations. And for next year, on top of this 200, we have another 37 lease agreements already signed and in place. So those showrooms will also be opened next year. Mr. Matthew also talked to us about the kind of competition that the space seems to be looking at right now, because the regional players, the national players seem to be expanding in sense of stores and size as well. And then you have corporates entering this sector as well, knowing that the place perhaps could explode with the kind of wealth creation that we've seen and the kind of spend that jewelry suddenly seems to be taking in. Yeah, so gold has always been a safe haven investment from all aspects, right? You can see that central banks across the world are buying up gold. Because there has been a lot of economic unrest or instability in certain regions. In all these times, gold has favored fairly well, because of which countries are now piling up their gold reserves. India as a whole has tremendous potential, because we already have a huge reserve here in the country as we speak. And that trend seems to be going up.
even though people were a bit reluctant in the beginning when they saw that the prices has been rising. But now that sentiment has changed. A lot of people feel it's going to keep rising up, and the proof of the pudding was this Dantara sale that we saw, where we saw not just lightweight jewelries being sold, but there was a lot of focus on heavyweight jewelry. I don't know if similar trend was seen across the industry, but we certainly saw a lot of heavyweight pieces being moved. So we have also stacked up our own inventory accordingly. And speaking of the competition, there has been a lot of shift from the unorganized to organized sectors. We are expecting that Indian market will be 60% organized by the next year and a half. That number is surely climbing and double-digit growth. So we're really looking forward to all the changes that is coming. From a supplier standpoint, there's a lot of suppliers entering the industry because there's a lot of room for growth in this. A lot of players are coming up with innovative ways on manufacturing gold. A lot of lightweight innovations are being done, not just from a manufacturing standpoint, but also from a design standpoint.
A final question then, Mr. Matthew, and this is about the IPO listing, and we've been hearing about that for some years now. Is more concrete work being done in that direction?
So at this point in time, we are pushing our IPO plan by a year, so that because there is no need for external funding as far as the company is concerned. The company has been growing exponentially well the last few years, and we are relying on internal accruals for the next year as we grow. But maybe in another year, 2 years time, we might reconsider the fact of going for public. So that is still being discussed internally at this point.
Welcome back to Halftime Report on CNBC TV18. As of now, Nifty is trading almost near the day's highs, 26,071, up 0.5%. But let's put the spotlight on APEC Prefab Technologies. Now, the company's posted its Q2 FY26 numbers, strong set of numbers that came in from the company. Revenue seen an increase of around 61% on a year-on-year basis. EBITDA saw a jump of 80% as well. We have Nikhil Bothra, the executive director of the company, joining us now to talk to us about the outlook. What should we watch out for going forward? Ordering trends, how is that shaping up as well? Thank you so much for joining us, Nikhil. Let's just start by talking about overall the order book in Q2. How are you seeing that shaping up? What is it standing at? Any depletion in Q2 that you're seeing coming in? What is the outlook there as well?
Right. Thank you for having me on board. So, like the H1 has been very, very strong for us. We have seen strong growth in revenue as well as EBITDA and net profits. If we talk about the order book, that is also very strong. So at the end of September, last month, we were sitting at order book of 920 crores. And further, in October, we have added further around 250 odd crores of order book. So currently, we are sitting at around 1150 to 1200 crores of order book, which is looking very good for the next 8 to 9 months. So I think, the tailwinds are strong. The industry is supporting. We have been delivering the numbers that we have been committing. So overall, it's looking positive in the coming quarters as well.
So 1100 to 1200 crores of order book right now. What are the kind of orders that you expect over the next couple of quarters? And if you could give us a sense of the execution as well, what is your revenue likely to be by the end of this year?
Yes, so generally, we have seen the trend that our order book to revenue ratio is 1.5 times. So at the start of this financial year, we were sitting at around 915 odd crores of order book. So that should translate into 1.5 times of revenue for this year. Currently, with this financial year, we are targeting to end at around 1200 crores of order book so that, we have a good growth in the next financial year as well. So overall, the growth has been around in tune of 35 to 45% in the last 3 to 4 years. And we are being in that range and targeting the same range for the next financial year as well.
Okay, so you're expecting 35 to 40% growth in terms of your top line for FY26 and ending your year with around 1200 crores in terms of an order book.
Yeah.
All right. Nikhil, just about the margins, because, we are talking to you on a day where metal prices are at record highs, copper, aluminium. So give us a sense, because of these kind of prices that we're seeing, is there any impact in terms of your margins, or do you think that it would be a pass on?
Yeah, so generally, there's not much impact of steel price volatility in our, margins, because we have, around 1 month of stock. Then we have given LOIs to the suppliers of steel, which is around delivery of around, 6 to 8 weeks. So generally, we're booking orders every month, every week. So generally, overall in the financial year, it nullifies. So there's no much, difference in terms of, impact on profits for the steel price volatility. Overall, yes, our margin has been growing because of the benefits that we are getting of economies of scale, and that is seen in the EBITDA margins. Also, in terms of debt, we are much lower. We are net positive, so that is also being seen in the PAT margins.
So what can you end the year with in terms of margins? You've done 11.5% for this quarter. What would your exit rate be?
So generally, our strategy has been penetration strategy. So, we want to expand and have a bigger market share. So we are targeting 10.5 to 11.5% of EBITDA margins this financial year as well. So that, we give a good, strong order book and give a good, strong revenue growth, maintaining the margins the same levels.
All right, so you intend to maintain your margins at the same levels, and 1.5 times order book to revenue implies that this year you will have around 1200 crores of revenue, and the next year you are targeting closer to 1800 crores. That would be fair, right?
Yeah, so this year, H1 we have done around 730 crores of turnover, and we are sitting at a good order book of around 920 crores, plus we have added another 250 odd crores in this last month. So, looking at that, yes, we'll be easily exceeding that commitment that we have given.
And do you have the capacity for the same?
Yes, currently we have the capacity. We are at good utilization capacity right now. We are using overall capacity utilization around 60-65%, and our peak capacity of built-up sections is around 80-85%. But like we have raised fund from IPO, which we'll be investing. So we've already started the work in both the greenfield and brownfield project at Rajasthan as well as Mambatu. So we will be adding further capacities of steel structure fabrication in Mambatu by next quarter, and we'll be generating revenue from the last quarter of this financial year from that investment.
What would be that additional revenue in Q4 then?
Yeah, so it'll ramp up slowly, but overall, if we see we are doing an investment of around 60 crores in that, and the overall asset turn is around 5 times. So we can see around around 250 to 300 crores. But it'll ramp up slowly in few quarters. Also, we have started work in our capex for Rajasthan plant in Gehlot, where we are investing 102 crores and putting up continuous line sandwich panels, which we will see revenue coming in from the second quarter of next year.
Okay. All right, Nikhil, we're going to let you go on that note. Thanks very much for joining in. So that's APEC, that stock up around 6% Take a short break, but we'll focus on Varun Beverages on the back of its Q3 performance on the other side. Stay tuned.
Welcome back. The stock of the last hour or so has been Varun Beverages. What a big move it's seen. 8% higher on the back of not just results, but more than results. It has been, the performance that the company is, announced when it comes to the Alcobev business. So the second quarter financially, or the third quarter calendar year, it's a seasonally weak quarter. The India business was further impacted by heavy monsoons. But it's the South Africa and, alcohol foray, which is key development to track. Year on year, the revenue grew by about just 2%. EBITDA was absolutely flat. The net profit surged on account of lower finance costs. But the company has made two important announcements. One, they've changed the object clause of their Memorandum of Association to include sales, manufacturing, licensing and distribution of alcohol beverages. And they've signed an exclusive distribution agreement with Carlsberg for certain African subsidiaries of the company, which will test market beer in those territories. And it's a good strategy because outside of India, regulations for carbonated soft drinks and alcobev are not as divergent as they are in the country. So this is where they would test that. And let's see whether, they get some manufacturing for Pepsi's ready-to-drink cocktails as well. So that's something we'll watch out for. The other internals, the India volumes were flat. The street was expecting a decline out there, so that's a positive. International volumes grew by 9%, led by South Africa. That was as per the company's own plan. And the mix of low sugar or no added sugar products are now 56% of their consolidated volumes and 45% of their consolidated volumes in India. So those are the internals of Varun Beverages. Decent performance in a seasonally weak quarter, but more importantly, the alcohol foray could be an important pivot for them. With that, we take your leave on this edition of Halftime Report. Stay with us. Business Lunch comes up next.
Nifty hovers around the 26,000 mark with small gains since the last session and positive market breadth. Metals and energy gain while financials and auto drag. SEBI issues a consultation paper on mutual fund rules that seeks to enhance transparency on expenses but also trims outgo to brokers. The tightening move spooks stocks of AMCs and other market participants. Copper nears its all-time high, aluminium scales to a 3-year high and zinc trades close to its 10-month high as optimism over a US-China trade deal coupled with supply concerns give bulls reason for cheer. Indian metal stocks to rally. US President Donald Trump says he's going to do a trade deal with India, adding that he has great respect for PM Modi. The remark sparks hope of a deal soon, even as positive indications in the past haven't translated into anything material yet. All eyes will be on the Federal Reserve's rate outcome, which is expected later tonight. A CNBC survey of respondents expect a rate cut in this meeting, with majority of respondents expecting rate cut also in December. Hello and welcome to Business Lunch, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra and we are tracking market moves on fresh day of the expiry. Right now, we are comfortably above that 26,000 mark. The Nifty is seeing gains of around 140 points as we speak. It has come off slightly, but there's of course nothing to complain about. Swiftly seeing that recovery from the lows of the day. Across the board, we are seeing major moves which are coming by. The Midcap index is up 0.4% as we speak. The banks are underperforming today, but we do have the energy space which is doing really well. We have the metal index, which is one of the top gainers, 1.7% higher there. Oil and gas names, CPSE names, all of them are on our radar because they're buzzing on the upside. What's not doing so well, we have some short covering, some long unwinding that we are seeing in the PSU banking names. Small cap index too in the red today, but the advance decline ratio, that is in favor of the advances as we speak. But that's about the market moves. There's a lot happening underneath as well. And one of them is the SEBI paper, a consultation paper, which is coming on expenses charged by AMCs to mutual fund investors. And that's the big story that we are tracking for you. Basically, it is done to ensure there's more transparency, which would come by for all the expenses which are charged by AMCs. They have restructured the expense ratio. The reduction is on the screen for you. For open-ended scheme, it is proposed to reduce it by 15 basis points. For closed-ended scheme, it is around 25 basis points. For equity-oriented, expense ratio reduction by 1% to 1%, and other schemes, it is 2.8%. Now, do remember, they've also added that they will remove additional expense of 0.5% or 5 basis points on the entire AUM, which was 20 basis points earlier. From 2018, it became 5 basis points. In terms of the brokerage fee cap, basically the brokerage that mutual funds pay to brokers for buying those stocks, for the cash transactions, it's proposed to reduce from 12 basis points to 2 basis points. For derivatives, it's been proposed to reduce it from 5 basis points to 1 basis points. Additionally, they add fund houses that venture into non-mutual fund management activities. That has to be a separate business altogether. The employees have to be different. There should not be any overlap in these two activities. They say that STT, GST, stamp duty, all of them will remain outside the purview of total expense ratio. There will be a different column for this. This is done to improve transparency and also reduce hidden costs. Additionally, the proposal is performance-linked expense ratio for mutual funds, which will basically align fund managers' performance to what they are charging the investors. So better performance, higher charges, not so good performance, lower charges to be borne by the investors. Detailed performance, of course, because of this performance-linked incentive, will be taken up later. This proposal also marks a departure from 2023 proposal that SEBI had put out, where all of these expenses were to come under one head, but the industry did not agree with it so much. So this as well is a proposal right now. We have not received any final agreement on this. 17 November is the last date, so we'll have to see which way things go. But on the back of this, because it would mean lower income for some of these AMCs and brokerage houses, all these stocks are lower in trade today. So these stocks are on our radar. That's the big story that we are tracking for now. But earlier today, we spoke to Ashish Somaiya, CEO at White Oak Capital AMC, and Sandeep Bagla, who is the CEO of Trust Mutual Fund, about the proposal. Listen into what they had to say.
If you think of brokerage or whatever is paid to brokers as 12 bips, it's not entirely paid to brokers because there are components like, exchange fees and stamp duties and STT and so many things out there. So it's not like 12 becoming 2. It will be more like, say, if it, say as per the regulatory paper, if it was 10, it might become like 4, 5, 6 or something like that. It will settle at because everything doesn't go to the broker. What the broker bills, there are further components into it which go to exchange and stamp duty and all those kinds of things. But yes, that will benefit investors. For the investor, I think the TERs will come down even after making all these adjustments of removing from TER, adding plus, etc. Net TER will go down. So the industry has to figure out how to absorb that. I think, all told, if you really ask me, the industry has to contend with figuring out how to manage this. I think it will be 10-12 basis points, not more, which is what the knock will be. But 10-12 basis points is a significant number. And yes, within that, clearly, we have to arrive at an equation. Now, different players will have different equation with the channel partners, but it will have to be split. Because ultimately, if let us say on an average 60% is going to the channel partner and 40% is going to the AMC in terms of retention, then it's only fair that even the knock is split accordingly. So I think that will be the bare minimum. So ultimately, when you ask about AMCs, it will boil down to low single-digit basis points of impact.
The impact will not be as much as the top line suggests. And it depends on how much distributor fees are also compressed by the AMCs. So in the short run, yes, there would be an impact in terms of lower fees when this goes through. But over a small to medium period of time, I think it will adjust. And if, looking at the growth at which the mutual fund industry is growing, I think we will see it as a small blip in the longer term.
Okay, we also spoke to Prateek Gupta, CEO and co-head at Kotak Securities on the SEBI's draft proposal. Let's listen into what he had to say.
Obviously, the impact would be quite negative for partly the mutual fund industry and also the distributors and brokers who service or who are very heavily dependent on the mutual fund industry. But I think it will be very, very negative for some of the smaller brokers and also for some of the smaller mutual funds in particular. And even the larger funds and distributors, they will be impacted to some extent. And I think you will start seeing resources being directed more towards away from mutual funds towards other categories like PMSs, AIFs, or foreign portfolio investors. It's a free market, and brokers charge whatever. Even when we service FIIs, we have different rates for different customers depending on how much servicing they're taking from us, etc. So the best thing in my view is encourage competition, let free market forces prevail.
All right, that's the big story that we are tracking today. The other big story is Indian refiners scaling back from Russian oil purchases on the back of international sanctions. But what could the impact be for Indian economy and refiners? Axis Capital's Neelkant Mishra spoke to CNBC's Manisha Tank on the issue. Listen in to what he had to say.
Exact advantage or the relative advantage that India had from buying Russian oil had actually shrunk to almost nothing over the past 1 year. So the gap between Brent and Urals was $30 a barrel in 2022 when the first sanctions were imposed. It had actually shrunk to $4 or $5 a barrel over the past 12 months. And once you adjust for the higher cost of insurance and freight, the landed price advantage was like $2 or something. So it's not that India was benefiting greatly. Now we are at a stage where oil markets are significantly oversupplied. This is part of the reason why you're seeing that Brent is back to 64. I mean, it was 60, 61 when the sanctions on Lukoil and Rosneft were announced. So there is enough oil in the world. India, you're absolutely right, imports 85% plus of its oil needs, more than half of its dense energy needs, and these are things that India needs to work on. But at this stage, from a cost perspective, remember last year, the average Indian mix, which is closer to Brent, the prices were $10 a barrel higher. So as of now, it's not a drag on the economy. I think diversification, and remember, Indian refineries are some of the most complex in the world. Their ability to handle all kinds of crude is proven. And therefore, I don't see any India-specific reasons to worry about the sanctions affecting the Indian economy.
All right, that's the opinion coming in from Neelkhand Mishra on Russian imports and the impact it could have on the Indian economy. Take a short break now. On the other side, we'll get you highlights from CNBC's Fed survey as the Fed's interest monetary policy decision is due later today. Welcome back. You're still tuned into Business Lunch. The big story, US President Donald Trump is in South Korea for the final leg of his Asia tour. At the APEC CEO Summit, he spoke about potential trade deals with India and China. CNBC's Cherry Kang gets us the latest highlights.
U.S. President Donald Trump has hyped the prospect of a U.S.-China trade deal as it kicks off the last leg of his Asia tour. Speaking at the APEC CEO Summit on Wednesday in Gyeongju, South Korea, he said he expects a great deal with China. He, in fact, gave more details on his way here, floating the possibility of lowering fentanyl-related tariffs on China and also discussing Blackwell chips with his Chinese counterpart Xi Jinping. The bilateral between the U.S. and China is expected to happen tomorrow on Thursday, which is going to be the centerpiece for this pivotal week for global markets. It wasn't just China, by the way. He said he expects a great trade deal with India and that U.S. is close to finalizing one with South Korea. He definitely continued to drive this idea of an American manufacturing boom, really touting relationship with countries like South Korea, which is, of course, a shipmaking and shipbuilding powerhouse in the region.
So I'm doing a trade deal with India, and I have great respect and love. As you know, for Prime Minister Modi, we have a great relationship. Likewise, President Xi of China is coming tomorrow here, and we're going to be, I hope, making a deal. I think we're going to have a deal. I think it'll be a good deal for both. And that's really a great result. You know, that's better than fighting and going through all sorts of problems and, you know, no reason for it. I think it's going to be a great deal for both.
Okay, the big cue for investors today would be the Federal Reserve's interest rate decision. Remember, the Fed is making this time's decision amid an ongoing government shutdown in the U.S. CNBC's Steve Leisman is here with a survey on the Fed's rate cut path.
Respondents to the October CNBC Fed survey see a rate cut on the way from this meeting, the next meeting in December, and possibly one in January, despite continuing worries about inflation, tariffs, and the government shutdown, in which, according to one respondent, the Fed is flying blind. Take a look at the numbers here. 92% say the Fed will cut in December. Of course, only 66% think the Fed should cut. There's concern about inflation and the other things I mentioned before. Additional cuts coming, 100 basis points. That includes this meeting, December, maybe January, all the way through 2026, bringing the funds rate down to, drum roll, 3.2%. So just another 100 to go from where we are right now. Richard Bernstein, CEO of Richard Bernstein Advisors, tells us that because of inflation and a surging stock market, quote, in more normal times, there's no way the Fed would be cutting rates here. Inflation is seen remaining above the Fed's 2% target, 3% this year, 2.8 by 2026, 2.6 by 2027. That's around where the Fed's target is because CPI runs a little hotter than the PCE. Tariffs remaining the #1 threat to the expansion, according to the survey. But 63% say that the effect on inflation has been less than they expected. 37% say in line. But why? 48%, unfortunately, say the impact has been muted so far because the full effects of tariffs have not been passed along yet. That speaks to perhaps further increases in prices. 30% say companies are eating those tariffs, maybe more pass along there. 13% say there have been offsets to tariffs by declines in other categories of the CPI. Several Fed officials, along with survey respondents, have concerns about cutting too much with inflation still above target and without the data we need to know if we're doing the right thing.
And of course, you can tune into CNBC TV18 for all the updates when it comes to Fed outcome on the rate cuts. Moving on, fears of AI are taking over jobs and it is on the rise. However, Jensen Huang, who is the CEO of the AI chip darling NVIDIA, thinks otherwise. Listen into his statements from the NVIDIA GTC event.
I think this idea that AI is going to take jobs is going to change everyone's job. That's for sure. But I think it's going to make companies more productive. We're more productive today because of AI. We're hiring more people.
Okay, with that, we'll do one thing. We'll slip into a short break. As we do that, here's a quick note for our viewers. If you would like to access expert-driven insights and actionable chart patterns, simply scan the QR code on your screen and subscribe to Money Control Super Pro and get daily expert calls, actionable charts, and insights to power your investing decisions. Plus, this festive season, there's more reason to celebrate. 10 lucky subscribers every day win 1 gram of gold. So do not wait. Scan, subscribe, and make your portfolio shine brighter with Super Pro. Welcome back. You're still tuned into Business Lunch. A lot of earnings which are due today. Let's talk about the big one. L&T is the one to watch out for. Vivek is joining us with what this street is expecting this time around. Vivek?
Well, that's right. So capital goods and infra major L&T will declare its Q2 results. It's been a very eventful quarter for the company. A lot of order wins, a lot of enrolled positions, especially as far as West Asia is concerned. And more importantly, the divestment of the Hyderabad asset was something that the company announced. Now, looking at the numbers themselves, consolidated revenues, including the services business, is seen higher by close to 13.5%. EBITDA is seen higher by close to 10%. The EBITDA margin is expected to soften on a year-on-year basis, close to 40 basis points, and profitability seen closer to the 4,000 crore mark. Now, as per JM Financial, they estimate that the core revenue, which excludes the X-services as well as the X-development, that is the realty business, they expect that particular business to grow close to 20%. Core EBITDA margin, the number that analysts will be watching very closely, is expected at 7.9%. First half order inflows expected to be very, very strong. Close to 2 lakh crore. Now, one important thing to keep an eye out for L&T, remember the order inflow guidance for FY26 is at 10% growth, but company is set to surpass that quite comfortably. So all eyes will be on whether the company goes ahead and upgrades its order inflow guidance for FY26. Consolidated order book, remember, end of last quarter crossed the 6 lakh crore mark. So all eyes will be on the side of order inflows that the company has received, especially from West Asia.
Yes, this is the big stock to keep on your radar. Thank you so much, Vivek, for joining us. Let's move on. President Draupadi Murmu flew a sortie in an Indian Air Force Rafale jet at the Air Force Station in Haryana's Ambala. She was given a guard of honor prior to her Rafale sortie. This is President Murmu's second flight in a combat aircraft following her 2023 sortie in a Sukhoi 30 MKI at Tezpur Air Force Station in Assam. She is also the third president and the second woman president to undertake such a sortie after former presidents APJ Abdul Kalam and Pratibha Patil. And the Japan Mobility Show is underway in Tokyo, and car maker Honda has unveiled futuristic SUV models which could soon find their way to the Indian market. Take a look.
Now, what you see in front of me is the Honda Zero SUV. You've seen this earlier at the CES. This is a very high-end, top-spec EV a Honda SUV might look like from the future. As you can see, the design is very modern, minimalistic, boxy. It has that kind of shape that you want from a big, luxurious SUV. Now, let me quickly show you what the side is. It's got a flat, very practical shape. The ground clearance, as you'll notice, is not very much like most modern EVs. It's more designed for streamlining and for better range. I'll quickly show you the behind, where there is quite an interesting feature. You notice this flat, very station wagon-like paneling. It gives you a lot of space. I especially like how this is done, and the lighting element is really quite smartly done. Now, this is what it looks like on the inside. As you will see, it's got that very modern, minimalistic, very striking look. It has that yoke kind of steering setup, the very, very minimal kind of instrument cluster. And I really like how the screen has been done up. You have that fully flat kind of screen. It merges into each other. I'm sure it's got a lot of screen real estate. And as you notice, you don't have wing mirrors. You have cameras even for the rear view mirror. And right there is the center console.
Okay, all right. With that, we'll do one thing. We'll take your leave on this edition of Business Lunch with the news that the Nifty is up 140 points and the Midcap index up to 60. We'll take your leave. Midcap Radar comes up next with all the market action. Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. Good start to the November series. We're already in November. Nifty is above that 26,000 mark. Midcaps are contributing. Banks are underperforming a little bit, but the PSU is doing really well in trade today.
That's right. Good afternoon, Sonal. Still getting used to the Wednesday expiry as far as the monthlies are concerned. So it's a Thursday, but it's the start of a new series, and all of the indices doing quite well. We have a lot lined up on the show, an important corporate conversation as well. So let's start off with the top headlines. Market builds on to gains to trade near day's high. Nifty about 26,000. Metals and energy gain while autos drag. Midcap index also up 0.5%.
SEBI issues a consultation paper on mutual fund rules that seeks to enhance transparency on expenses, but also trims outgo to brokers. The tightening moves spook stocks of AMCs and other market participants.
Shares of Blue Dart trade higher after posting a good operational performance in its September quarter. Profit rises 29% while margins too expand.
Cohance Life Sciences down over 8% after Managing Director V. Prasad Raju tenders his resignation. Executive Chairman tells CNBC-TV18 that they are hiring new talent and restructuring company, and they are also moving towards tech-driven CDMO.
Varun Beverages surges in trade after the company announces its foray into the alcohol beverage sector. Company also reported its Q3 CY25 earnings, profit after tax and revenue grows on a year-on-year basis.
Okay, all right. Those are the top headlines. Of course, we'll discuss some of those stocks in greater detail as well. For now, AMCs continue to be on our radar. For the Nifty, we are sitting with gains of 150 points. Midcaps are up 0.5%. Energy index, that's the one which is high by 1.5%. Metal index is also contributing to the gains that we are seeing currently. A lot of stocks reacting to their earnings as well. Blue Dart, for instance, is higher in trade. We had that resignation come by from Cohance's MD, so that is on our radar as well. In the broader markets, we have Varun Beverages that we'll discuss in greater details. 9.5% higher on that stock on the back of numbers and some diversification that they have spoken about as well. But midcaps, they continue to be on our radar. This is our special segment, Midcap Movers. Vivek is here to take us through the midcaps that are moving around in trade. Vivek.
Well, thank you so much for that. Well, broader end of the markets, advance decline ratio actually quite strongly in favor of the advances, despite the kind of news flow that you're working with. First on the list, have a look at the entire metal pack. All of these stocks doing very well. SAIL higher by over 6.5%. Some positive read-through being seen from JSPL results, JSW Steel, and even some of the other non-ferrous names too doing quite well in the session. Vedanta too up over 2.5%. OMCs, the entire basket doing quite well in the session. Have a look at HPCL, IOCL, BPCL. Clarity regarding LPG subsidy, something that the street likes. IOC higher by over 5.5%. Blue Dart, we just spoke about it. Margin expansion is quite strong. Along with that, there's a price hike on the annual, so that's something that the street likes, higher by over 14%. M&M Financial, positive commentary from the management as far as H2 is concerned. TCM Sriram and Varun Beverages, the tie-up with Carlsberg is something that the street clearly likes. On the other hand, quite a few stocks, seeing some negative news flow and very strong negative reactions. The entire AMC pack, so all of the mutual fund stocks seeing significant selling pressure. HDFC, AMC down over 4.5%. And the entire pack, have a look at Nippon, that stock too, down over 5%. Along with that, some of the other capital market players, brokers, RTAs, all of the agents seeing selling pressure emerge over there. So KFIN, CAMS, DAM Capital, all of these stocks under pressure today. On the other hand, Cohance, a surprise resignation coming in as far as the CEO is concerned. That stock down over 7.5%. Star Health, muted Q2 down. And Bosch, a profit warning coming in terms of disruption is something that that the street has taken note of. Stock down over 3% as far as Bosch is concerned.
All right, so those are some midcaps on our radar. Thank you, Vivek, for that. In fact, we now have with us Money Control Super Pro expert and independent research analyst Brajesh Bhatia, a SEBI registered market professional who tracks market movements and identifies trade-worthy trends for Super Pro subscribers every day. Good afternoon, Brajesh. Thank you so much for joining in. First day of the new series, what are the important levels to watch out for? What are you tracking here?
Hi, good afternoon. I think Nifty has seen a strong comeback right from around the base of 25,800, which we saw yesterday, being held very, very strongly. And even if you look at the momentum from there, with 25,800 puts were holding, it seems that the fresh momentum has built up, and I expect this momentum to prolong towards 26,350, 26,400 by next week.
Okay, and Brijesh, what are the individual stocks that you're liking at this point of time?
As you said, metals and energies are buzzing. So I think probably one should look at NMDC, which has been strongly holding on for around 75, 76 levels. So keeping a stop loss of slightly below 74, look at 80, 82 levels on the upside. And second is one from the finance space, though finance has been on the downside. But one stock which has been trading at 52-week highs, Sriram Finance. And we saw a huge breakout coming at around 680 levels. So it continued to rally higher at around 720, 725. Can look at 800, 820 on the upside, keeping a stop loss slightly below 688.
Okay, Brijesh, thank you so much for joining in today. But Brijesh, any idea on either of these AMCs? The stocks are lower because of a fundamental news. But technically, how are these charts looking?
I think one can look at Motilal Oswal, though it has taken a breakout of 52-week high and we saw a pullback onto the downside. But I'll wait for a couple of days onto the momentum. Even HDFC AMC has been slightly waiting for a momentum to a retracement. Once this momentum start onto the positive side, one can definitely look out.
Well, thank you so much, Brijesh.
Yeah.
Right. Well, thank you so much for joining us. That was quite an insightful session. For our viewers who want to access these kinds of actionable insights daily, check out Money Control Super Pro while market expertise meets technology. Subscribe now and get an ad-free, data-rich and globally connected experience. And here's a festive bonus. 10 lucky subscribers every day stand a chance to win gold coins. Just scan the QR code on your screen or download the Money Control app to know more. Welcome back to Midcap Radar. Well, as promised, a corporate conversation coming up. Aeroflex Industries is the management that we're speaking to today. Remember, the company posted a good revenue growth both on a year-on-year as well as on a sequential basis in Q2. Asad Daud, who's the MD at Aeroflex Industries, joins us now to discuss about the quarter gone by and the way forward. Well, good afternoon, Asad. Thank you so much for joining us. Q1 was muted, but you had guided for almost an 18% revenue growth as far as FY26 is concerned. Do you stick to that particular guidance? You mentioned a few deferments as far as export market are concerned. Will that impact operations?
So yes, like you mentioned, Q1 was muted, but we have seen strong recovery coming in Q2, and we also expect the same to continue in Q3 and Q4. So we expect on an annual basis the growth to be in the mid-teens.
Mid-teens, you had earlier said 18%. So is it going to be lower than that?
So we are still awaiting, some clarity on the tariff situation. Over the past couple of days, there has been positive developments on the tariff issues. So we're just waiting for updates on that. I think once the tariffs are reduced, I think we'll see the growth coming up to closer to 20%.
Okay, growth, if there is a clarity on tariffs, you could see growth coming into 20% as well. But if there's no clarity, it could be lower than the 18% that you had guided for as well. And what about margins? This time around, margins came in at 23.3%. You had guided for 21 to 22%. First, what led to this margin expansion in Q2? And is this a number that you will see in FY26 as well?
So in Q2, our margins were higher on account of two. One is obvious, our material margins were much higher as compared to Q1. Also, our sales of higher value-added products increased, and also favorable currency movements, which helped, because we are an export unit. Hence, the favorable currency also helped in that. But if I talk about on an annualized basis, I think we expect the margins for FY26 to be in the range of 21 to 22%.
So you've maintained the margin guidance to stay around 21 to 22%, aided by favorable forex movements. Is that accurate?
Yeah, favorable for forex movements, and also our venture into higher value-added products, which helps in better margins.
Okay. Now, going forward, how do you see the top-line mix or the order book mix? H1 FY26, exports have formed more than 70% of the order book. But when you look at the performance, that's actually seen a sequential decline. So going forward, you've spoken about deferment of orders. You've spoken about a clouded outlook. So exports, do you see that coming down as part of the total order book?
So actually, exports as a percentage of revenue has gone down, but in terms of value, that has increased in Q2. If you see, as compared to last year or the year before, where exports was almost 85% of our total revenue, now exports has come down to about 73 to 74% of our total revenue. But in value terms, it has not fallen. It has remained relatively flat despite all the tariffs that is being, that has happened in this financial year. Our domestic business has actually grown significantly, both in Aeroflex and also in our subsidiary, which is the fitting business, High Air Engineering.
Okay, take that point. But exports are a bigger chunk, so we'll have to watch out for the tariff impacts as we keep getting commentary on it, but there's no finality as of now on what happens to that. What about liquid cooling for data centers? Because that continues to be a big focus point, and this is something that a lot of other companies are looking at as well. How big is that segment for you? Have you started getting more orders here? And what is the expected revenue?
So we have actually received one more order for the liquid cooling systems, which we received in the last month. The supply of the first order would start in Q3, and for the second order would happen in Q4. We are also in discussions to ramp up the capacity for the liquid cooling segment, which we will announce as and when it is finalized and approved by the board. But that is a sector where we are going very aggressive because we feel that this is a multi-decade opportunity for us, and we have the first mover advantage in India to provide this liquid cooling solutions.
You briefly mentioned about, the acquired entity Hyder. So, and that's actually seen quite a bit of a turnaround both on the bottom line as well. Going forward, what is the kind of order inflows that you anticipate from that particular space, given the fact that the prospect pipeline is quite large?
So in terms of the contribution, I think over the next 2 to 3 years, Hyder would contribute almost 20% to the overall sales of the company. So I think, and we are doing planning to do expansion also in Hyder further. So I think we are extremely bullish on this segment, and I think it will see significant uptake in the next few quarters as well.
Take that point. Thank you so much for joining us today, Asad, and letting us know the outlook on the business going forward. That's all about Aeroflix Industries. Coal India has reported numbers. The revenues have come in slightly higher than the poll of 29,187 crore rupees. So that is a number which is better. EBITDA was expected to come in at 7,827 crore rupees. Margins expected to decline as well. So far, the revenue numbers suggest that it is higher than what the poll was suggesting. Net profit has come in at 4,262 crore rupees, which is much lower than the poll, and that explains the stock move. The stock has come off from the highs of the day. There's a sharp fall that we are seeing right now. It is because the net profit is much lower than CNBC-TV18 poll of 5544 crore rupees. The EBITDA is lower as well, 6,700 crore rupees, which compares with a poll of 7,827 crore rupees. So that definitely explains the reason why the stock is lower, 1.1% lower there. Sales volumes are expected to decline by 14% on a sequential basis, but we'll get those details if you have any more details on this.
Well, the key to watch out for will be the e-auction premium realization trends. And, Nigel had pointed out that it is expected to be muted, and it was expected to be just around 50%. Versus close to 69% on a year-on-year basis. And also, negative operating leverage on the back of the fact that sales volume, which the company had highlighted earlier, had actually fallen 14% on a sequential basis. So, given the fact that even though, you're actually seeing top-line meet, there has been volume which has fallen, and on the back of that, negative operating leverage has significantly led to a miss as far as margins are concerned, and on the back of that, profitability too has seen a significant miss to both the CNBC-TV18 poll as well as to consensus estimates. On the back of that, that particular stock down close to 2%. But moving on, we'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Midcap Radar. Well, this is our special segment, Midcap Spotlight. Mangalam joins in and he'll focus on Varun Beverages. Investors are clearly saying cheers, Mangalam, to Varun.
Cheers to beers, that's what they're saying. And in case you're wondering why Varun Beverages and beers, because they came out with the numbers, and numbers were nothing really to write home about. This is a seasonally weak quarter. There were, unseasonal, or rather more than expected rains in the Indian business, so their volumes were flat as well. But beyond the bottom line numbers, or beyond the bottom line notes that came in, the company had actually changed the object clause of their memorandum of association, and they said that this will now include sales, manufacturing, licensing and distribution of Alcobev as well. And as a result of which, this new pivot is something that the street is definitely liking. In fact, the company has gone ahead and said that certain African subsidiaries of the company will also do some test marketing in their territories, which is in Africa, so South Africa, etc., where they will sign an exclusive distribution agreement with Carlsberg. So those are a couple of positives that the street really is liking. The higher addressable total market in Africa and overseas, not so much in India, largely because the regulations for Alcobev and carbonated beverages are far more divergent in India than it would be in some of these other geographies. So it's a good pivot to track. And strategically as well, Coca-Cola as well as Pepsi internationally have been starting to sell their premix cocktails, which have alcohol along with these carbonated beverages mixed. So this could also make sense for them to go ahead and do this. But be that as it may, apart from this, the numbers also that came, while they were nothing really to write home about, they were also not as bad as that the street feared. So overall revenue grew by about 2%. EBITDA was flat because of improvement in their financial conditions in terms of them having repaid their debt. The finance costs came down and the net profit saw a jump of around 18.5%. And importantly, the India volumes, while they were flat, a large part of the street were expecting a decline in India volumes in the third quarter. That did not happen. International volumes actually grew by 9%, and this is something that the company had planned for already by virtue of buying the South African business to deseasonalize their overall operations. And the mix of no sugar or low sugar products have now been more than 55% of their overall consolidated volumes and 45% of India. Improved gross margins on account of higher proportion of water and no sugar beverages is something that's a positive for them, not only for the drinkers' health, but even for the company, because sugars are obviously a lot more expensive and voluminous than what some of these no or low sugar products would be for them. So all in all, good numbers coming in, not as bad as the street was fearing, but more importantly, this pivot is something that the street likes, and the stock has the moves to show for it.
Well, thank you so much, Mangalam, for joining us. Almost 10% higher as far as Varun Beverages is concerned. Well, one particular stock that did very well yesterday was Car Trade Tech. That particular stock yesterday was amongst the top movers with significant volume action as well. But today, that particular stock has cooled off quite significantly, so there has not been any post-result buying. That stock down almost 8%, and volumes too are quite high. On the other hand, having a look at the markets, you can see on the bottom of your screen the numbers of NMDC. NMDC numbers, look higher than what the CNBC-TV18 poll was anticipating. That particular stock has moved to the high point of the day. And Coal India, on the other hand, which was a miss to the poll, has now moved to the low point of the day. Even Maruti, for that matter, has actually cooled off. That stock too has now at the lowest point of the day. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You're tuned into CNBC-TV18. You're watching Your Stocks coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. Looking at the markets today, we are seeing green on the screen, right? No complaining there. The Nifty is managing to hold on to gains of almost 0.5% now. It's up almost 120 points as of now. 26,000 comfortably. So the starting of the new series has come on a positive footing. Let's talk about the Nifty IT. That's managing to hold on to gains. Support coming in there. Nifty Bank managing to hold on to gains as well. And what's shining bright today is the metal pack. So Nifty Metal also is among the top sectoral gainers that we've seen coming. So keep an eye out on the Nifty Metal. Broader end of the market, let's look at that. We have Nifty Midcap. That's also managing to hold on to good gains right now. Almost the other day's high point is what the Nifty Midcap is trading at. Small cap similarly is also holding on to a bit of a gain right now in the trading session. So keep an eye out on that. A good recovery coming for the Nifty small cap as well. At one point of time down 0.1%. Now it's up 0.3%. So that's something that we'll be keeping an eye out on. You have important updates that are coming in also at the bottom of your screen for you all. Telecom Ministry is talking, and this is to CNBC TV18, in terms of the update for Vodafone Idea. The Supreme Court order, they said, held that AGR resolution is a policy issue, will be left open to the government. And furthermore, they're saying that the Supreme Court, it's an alert for you all. Supreme Court order on AGR is yet to be published. So we'll wait out for those details over there. The Telecom Ministry is saying that we are yet to receive the order from the Supreme Court with regards to this AGR case. So keep an eye out on Vodafone Idea. That's the one we'll watch out for as well, and along with that in the stars as well. But this is a show where we solve all your stock-related queries. So let's get right to it. And for that, we have our experts for today, Saumil Mehta of Mirae Asset Share Khan, as well as Astha Jain, research analyst, Hem Securities, joining us to answer all the stock-related queries. Saumil as well as Astha, good afternoon, and thank you so much, as always, for joining us on the show. Saumil, a quick check in terms of the market before we jump to the queries. 26,000, today the new series has started on that note. What are we watching out for?
Good afternoon to everyone. Absolutely positive, great momentum in the market. Some sectors like metals and banking, they both are doing really good. Next level to watch out for in Nifty is 26,200, 26,250, which is very close to the all-time highs. That would be my short-term target. In the very short term, the support would be around 25,800. I'm not expecting markets to go below 25,800 at this point of time in the very short term, and the momentum should continue. Buy on decline should be the strategy.
Okay, buy on decline should be the strategy. But let's get started with those queries then. We have Rudra Swami, who's writing to us from Chennai. He's holding 200 shares of Nasdaq. This is at a price of 2,200 rupees per share, making a little bit of loss in this one. Now, he's a mid-term and medium-term investor, wants to know the future prospects of the stock. Nasdaq, Astha, what's your view for this one?
Hi, good afternoon to everyone. Talking about Nasdaq, the quarter two of FY26 was a quarter of a steady performance, in which we have seen margin expansion as well. Now, what we are seeing is the growth across their AI-led, verticals, and this growth momentum, I believe, will going to continue for coming few quarters as well. And looking after the geographic expansion also, I think this counter is well placed to move till the level of 2,400 to 2,500. So recommending a hold on this counter with a price target of 2,400 to 2,500.
2,400 to 2,500 is the price target that you're seeing. Continue to hold. Now, Saumil, what's your view coming in for this one? YTD, the performance hasn't been great, right, for Nasdaq. Being an IT company, is this one of those bets that you would look at, or maybe it's another company that you would suggest? And what would you tell the viewer to do right now?
I think in the very short term, yes, there could be a bounce here till the 200 daily moving average, which is around 2,400 levels. But I'm not expecting anything in the medium term outlook. So medium term outlook still remains negative because we've had lower top, lower bottom formation on the weekly charts and still trading below 40 daily moving average. So negative in the medium term, but I'm expecting a bounce to continue till 200 daily moving average. Targets would be 2,400.
Okay, 2,400 as a target coming in there from both our experts. Let's move on to the next query then. This is coming from Shrikant, who's writing to us from Telangana. He's holding 35,000 shares of South Indian Bank. Price is 20 rupees. Wants to know if he should continue to hold or book his profits. Asta, South Indian Bank.
Looking good to us, as we are expecting the loan growth to be maintained at a CAGR of 11 to 12%. And what we are seeing that now the management is talking more about, their shift towards the MSME and the retail sector. So I think that is also looking good to us, along with the good asset quality. So going ahead, we believe that with the loan growth of around 11 to 12% CAGR, this bank is well poised to move up from here. Recommending a hold as well as buy on dip strategies can also be applied to this counter. However, our price target for both the cases is anywhere between 47 to 50 rupees.
And your view, Saumil?
Absolutely positive in the medium term outlook. In the very short term, I would not suggest anyone to enter the stock right now because it already has very good run up in the last couple of weeks. And now the crucial supports would be around 37. That could be a stop loss as well, a trailing stop loss for a positional trader. On the upside, my targets would be around 40 to 43 levels in the next coming 1 month.
Okay, in the next 1 month, 40 to 43 levels is maybe something that they could keep an eye out on. So short-term target over there is what we could watch out for. Also, Asta had mentioned some levels of around 47 as well. So keep an eye out on the stock. Maybe short-term you can hold and then book your profits. But next query for today is coming from PC Acharya, who's writing to us from Bangalore. He's holding 100 shares of Tata Motors. Price is 600 rupees per share. They want to know whether they should continue to hold this for the long term. What should they be keeping an eye out on? Asta, what's your view coming in for Tata Motors? Obviously, we have now a separate PV as well as a CV division as well. So right now, PV is here on the listed exchanges. CV has come off there and we'll wait for that listing. But Tata Motors, what should they be doing now?
I think one should remain invested in this counter for the price target of somewhere between 440 to 450 rupees. I'm not giving a big price target to this counter, but I believe that this counter can move till those levels. Now, talking about the fundamental, the only optimism right now which we are having is that the UK-US deal or maybe Europe-US deal can have a some sort of positive impact on the JLR. And that is why I think the company will be showing decent performance going ahead. So right now, this is the only thing which we are finding positive for this counter and hence recommending a hold. All the price targets are not higher at this point of the time. We are just restricting ourselves 440 to 450 price targets.
Okay, keep an eye out on those levels over there. This is Asta for Tata Motors PV only, right now?
Right, Tata Motors.
Yeah, because then they'll get the shares of Tata Motors CV as well. So this is for the PV division. Keep an eye out on this level over there. Saumil, your view?
Tata Motors PV, very similar to Tata Motors. We definitely will have CV later on. But lower top, low bottom formation, trading below 200 daily moving average. I will wait for a breakout on the upside. I would avoid at this point of time to enter the stock. If I have a position, I would exit and enter probably Ashok Leyland or some other stock in the auto pack. But right now, for Tata Motors PV, I'll wait for a breakout above 445, which is a very crucial resistance for the stock. Once it is above that, I think the next level on the upside would be 500, 525 in the medium term outlook.
Okay, keeping an eye out on those levels over there. Let's move on to the next query, and this has come from Shweta Agarwal, who's writing to us from Mumbai. She's holding 350 shares of RBL Bank. Price is 220 rupees per share, and 300 shares of Central Bank of India, and price is 30 rupees per share. She wants to know what should she be doing in terms of the long-term story. Continue to hold both the stocks. Asta, your view, RBL Bank as well as Central Bank of India. RBL Bank, obviously, you have those recent announcements that have come in as well. But with the stock, what should they be doing?
So both are the candidates of hold from my side. With the central bank, we have a price target of somewhere at around 45 rupees to 50 rupees. Now talking about the RBL bank, SBI Bank is also looking good to us with a price target of 340 to 350 in the medium term. Talking about this counter, yes, this Emirates deal will definitely be a very great deal, and I think it will unfold some sort of growth opportunities for this counter. And in fact, whatever results they have announced, I think advances growth was a very strong advances growth which they have posted, and there was a margin expansion also. So I think all in all, on the back of a strong numbers and the kind of deal which is ongoing, definitely this is a whole candidate with a price target of 350.
Okay. Saumil, your view for both the and central bank, Asta, did you mention that?
Target? Here also we are recommending a bull with a price target of around, yes, 45 rupees.
45 rupees. Okay. Saumil, your view?
RBL Bank, definitely positive. Medium-term outlook, I think the next target would be around 360, 370 levels. Crucial levels around 300. I'm not expecting the stock to go below 300 levels, so keep that in your mind. For central bank, it has just broken out of a small triangle pattern. It is, there is a basing out pattern going on for a little while now. It was in a downtrend, but I think this is a reversal point for the stock. Anything above a close above 4150, I think that will be a breakout point, and the next target would be around 47, and the next target would be 53. So these are the two targets, but wait for a breakout about 4150.
Okay, keeping an eye on those levels over there. On that note, we're actually going to slip into a very short break, but a quick note for our viewers, you must have noticed there is a money control stock score just above the line graph over there, and this is a score assigned to each stock based on Money Control's multi-factor algorithm. It is calculated by analyzing over 40 parameters, including both current and historical financial statements, price charts, and technical indicators for each stock. Now, each of the individual parameters considered for calculation of the 4 factors are assigned a score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and T factor score. Remember, this is not a buy or sell recommendation. Any investor or viewer is advised to carry out necessary diligence on their own or through certified registered financial advisors for investment decisions. Welcome back to your stocks on CNBC-TV18. Market still about the 26,000 mark. But let's keep it going with the stock-related queries then. This next query that we have is coming from Shankar Das, who's writing to us from Mumbai. 200 shares of M&M is what he's holding. The price is 3,136 crores. And he's asking if we should continue to hold this for the long term. Astha, your view?
View is positive with a price target of 3,750 to 3,800 in the short to medium term. Now talking about M&M, definitely with their new launches in the electric sport utility vehicles and there are various variants which they are really launching. I think the company is well poised to move up from here, from the stock price momentum wise. And in fact, the kind of EV production the company is doing, I think definitely it will have an impact on their financials going ahead. So all in all, M&M is looking good to us with a price target of 3,750 to 3,800. A hold is recommended on this count.
Okay, hold is recommended for M&M. Saumil, your view for the long term, what is the target that you would give the viewer?
For NMM, I think the support here is 3,390. That's the first support, and the next support is around 3,200. These are the two support levels. I'm not expecting a very sharp correction, but in the very short term, there could be a sideways pause for a little while. On the weekly charts also, it's been trading in a broad range between 3,400 and 3,700. So I'm expecting this broad range to continue. Overall, my view remains positive for a target of around 3,800, 3,900 levels. But that will be a medium to long-term view, not in the short term.
Okay, that's the view there coming in for M&M. Let's move on to the next query. This is coming from Sai Prakash, who's writing to us from Hyderabad. He holds 1,850 shares of BHEL. Price is 263 rupees per share. He is asking if he should continue to hold this for the time period of next 3 months. Astha, BHEL, what are you keeping an eye out on? They're expected to report their numbers today as well.
So definitely, I would like to see the order book because order books inflow or the order inflow for Q1 FY26 was strong. I suppose it was above 40% at 13,445 crore, if I'm not wrong with my numbers. So here, I really want to see the order book because what we have seen in the Q1 FY26 that there were some challenges in the earning, which we have seen in this company's financial performance. So my whole analysis is majorly dependent on the strong order inflow which this company will be showing in case if any, and hence right now just wait and watch for the numbers. Meanwhile, I would suggest to hold this counter, and the price target which we are setting for this counter at the initial level is around 260 to 270.
Okay. Keeping an eye out on those levels over there. Short-term target, Saumil, for this one?
BHEL has just broken out of a small triangle pattern on the upside. Great momentum right now. My targets would be around 265 and 272. So these are the two targets. Support would be around 230. So great setup for a short to medium term position.
Okay, great setup there for the short to medium term. Next query for today is coming from Rohit Sarkar, who's writing to us from New Delhi. He's holding 600 shares of KPI Green. Price is 400 rupees per share. Astha, long term, what should they do? Continue to hold this?
Yes, for KPI Green, we are recommending continue holding this counter because what we believe that their earning growth is looking good to us, plus the installed capacity of more than 1+ gigawatt is a strong one. In fact, what we believe that the company has also got a strong ratings from the ICRA. I think it was around A positive. So on that basis, and their geographical expansion is also looking good to us. So all in all, we are recommending hold on this counter.
Okay, recommending a hold on this counter. Saumil, what is your view coming in for KPI Green? Viewer has bought it at 400 rupees. Should they continue to hold this for the long term?
I think in the very short term, I'll be expecting a small correction or a pause because it's already had a very good rally. Support would be around 500 and 480. 480 is exactly 200 daily moving average. But the medium term outlook is great. So I'll suggest to hold for a target of at least 580, 590 levels.
Okay, hold for a level of 580, 590 levels for KPI Green. We'll keep an eye out on that. But that was the last query for today. So Asta as well as Samil, thank you so much for joining us on the show as always and helping our viewers solve all those stock-related queries. Thank you so much for that. Now, looking at the Nifty, a quick check there. 26,000, I beg your pardon, 26,050 is where the Nifty is trading at. Continues to trade around about the 26,000 levels today. No complaining there. And in the last 20-odd minutes, we've seen an up move coming in from Apar Industries. They reported their numbers, good set of numbers that's coming from the company. The stock is up more than 3%. In just the last 1 hour, it's seen an uptick of 3%. So keep an eye on that one. 4% uptick after that as well. And Five Star Business is another one that is managing to hold on to gains or recovered from the day's lowest point as well. So good uptick there in the last 1 hour for this one as well. But with that, we're absolutely out of time. So thank you so much for tuning in. Remember always to email us your stock-related queries on that email ID at the top of the screens. We'll get them solved with our experts. But for the last hour of trade, you have Closing Bell up next.
headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwan index, that's opened with very strong gains today, 1% gains for the Taiwan index.
They have been brought in to bring more transparency and also reduce costs for mutual fund investors.
I think it's going to make companies more productive. We're more productive today because of AI. We're hiring more people.
74 odd points higher is the indicative open.
Net TER will go down. So the industry has to, figure out how to absorb that.
25,980 on the Nifty bank is at 58,290.
Our preference is towards the likes of mutual funds or the wealth businesses.
So I'm doing a trade deal with India, and I have great respect and love. As you know, for Prime Minister Modi, we have a great relationship.
We did fall below that 26,000 mark, but now back above that. In fact, the Nifty is now seeing gains of 109 points.
We are at a stage where oil markets are significantly oversupplied.
Refineries have got a wide basket of the crudes which they can process.
Good start to the November series. We're already in November. Nifty is above that 26,000 mark.
Well, that is the day so far, and the recovery is afoot. Yesterday was a slow day, but today another 100 points on the Nifty is what you have. This is Closing Bell coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Surbi and Rima with me. Guys, afternoon.
Hi. Oil and gas, metals, all up and about. But banks have started moving up now.
Resources doing very well, right? Oil and gas, energy, metals, once again.
Once again. But in the second half of the day, the banks which were flat in the morning.
Yeah.
At least at 11 o'clock, the Nifty bank was absolutely unchanged, but now it's up close to about 200 points.
Yeah, absolutely. And, there's not much recovery, actually, unfortunately, in the entire capital markets / mutual fund part of, things. A lot of those stocks, IIFL Capital 10%, Motilal Oswal 7.5%. So stockbrokers, mutual fund, managers, even stocks like CAMS. CAMS is again down 5.5%. So this whole part of the market has been a casualty of proposed norms. And right now, there's a fair amount of uncertainty that goes on out there. But guys, globally also, it's such an action-packed evening, right? We'll probably get that 25 basis points from the Fed. Tomorrow is this grand India, beg your pardon, US-China. We wish it was India-US, but no. US-China trade agreement. And the market will have to navigate a lot of that. And the wait and watch for us, of course, continues.
And Meta, Microsoft and Google report numbers later today.
Trioka, Trimurti earnings, and so 3 today, 2 tomorrow, by the way. So it's all tech heavy. But, otherwise it's a decent day. Advanced decline, and the last I checked was some 2:1. 2,000 stocks higher, 1,000 stocks lower on the NSE. So it's not a bad screen at all. There you go, on your screen. And lots of individual movers, action. Metals, once again, picking up. Let's just look at Vedanta for a quick bit. I think that, the demerger case is supposed to come up in the NCLT at 2:30 today, which is now. And Ashmat will be tracking it in terms of what comes out of there. So much back and forth between NCLT and NCLAT. And of course, Vedanta itself has postponed timelines for the demerger thing to March 2026 in terms of when they can now do it. But, it needs the clearance. So we'll track that one as well. Numbers also coming and trickling in. Radico Khaitan at the bottom of the screen. Profits are up some 70%. 140 crores is the net profit for the second quarter. This is a very, very strong number. Stocks, of course, in the Alco-Bev space is perhaps the best performing name out there in terms of large players. So that is something which we will highlight in greater detail with Mangalam in just a bit from now. Well, let me just quickly run you through what else is coming up on the program. So steady start to the new series. Nifty is holding above the 26,000 odd level. Metal, energy names, etc. doing very well. Banks are staging a bit of a pullback. Midcap index crossing the 60,000 mark for the first time since October last year. Varun Beverages is surging. So, they've entered into a tie-up with Carlsberg for the African market, and markets are excited. Numbers, though, for the quarter were kind of tepid, not really all that great. Cohans is down still. There's, of course, the MD who's resigned. We had the management will play out some sound bites as well. in a bit from now. And of course, the entire capital market value chain under pressure after those draft norms which SEBI put out yesterday late evening. So that's the picture as things stand right now. How should you position yourself in the last hour? That's the question. Mitesh is with us to help us with that. Mitesh, good afternoon again. Thanks very much for joining in. What's your sense, Mitesh? How would you play it from here? Indices first.
Good afternoon, Prashant. I think one good thing is that till now, I think today, we'll have the highest closing for this up move, which started on the first day of October. And while we still haven't cleared those levels of 26, 180, 26, 220, I think, we might retest them at least. And eventually, my sense is that we will be able to clear them. But yes, as you get closer to the all-time highs, the previous tops, I think some more of profit might happen. But the structure remains positive. So the idea is that if you're long, try to take some profits as you get closer to about 26, 180, 200 zones. See if there's strength to get past 26, 250. If that happens, then I think you get back into long aggressively. Otherwise, you'll get a decline to possibly buy into this markets again. But the directional structure, if you talk about 2 to 3 weeks, my bias is on the upside.
Stocks, Mitesh?
Yeah. I have 2 buy calls right now. DLF is a buy with a stop just below 770, so 769, 769.5. And look for a target of 815 here. And Gas Authority is having a good price and volume breakout today. So GAIL is a buy with a stop at 182 for a target of 19.
Got that. Lots of earnings reactions playing out. So Coal India just came out with the numbers. The stock has nosedived close to about 2.5%. There is a margin decline and a miss. Coal India share price is weak in trade. But on the flip side, names like M&M Financial, 8% higher on M&M Financial, and Varun Beverages. That is clearly the star. And Manglam is now joining in. Manglam, it's not the Q2 numbers, but is it the tie-up with Carlsberg that's got the street excited?
Well, a couple of things, So this time around, 3 things happened. One, the Q2 numbers weren't as bad as feared, so the street wasn't really expecting much. In fact, they were expecting a volume decline in India because of the heavier than usual rains and the flooding in many parts of the country. So seasonally, Q2 is very weak for them. Q2 FY, 26, but for them it's Q3 FY25 because they follow the calendar year. The second part is that beyond the numbers, there was slight change in their articles of association or object clause of the memorandum of association, where they've now included the business of selling, manufacturing, licensing, distributing alcohol beverages as well. And this is beyond the carbonated soft drinks and water and the fruit juices that they sell already. So that was a good pivot. And the third part, to further validate that, the company has gone ahead and using its African subsidiaries tied up for exclusive test market distribution of Carlsberg beer in a few of those African markets. So all of these things put together has had the stock move higher. So if you just look at, the alcohol market versus the carbonated market in India, the regulations for that are far divergent as compared to some of the other companies or other countries, which is why this test is a positive and also works for them strategically, because PepsiCo and Coca-Cola also have their ready-to-drink mixed beverages that they've launched in a lot of the developed countries and a few markets in the world. So this could further enhance their partnership or deepen their partnership with PepsiCo. Does this mean that they will sell alcohol in India? Does not look like in the very near future, largely because the Indian regulations, the Indian supply chain for alcohol versus carbonated soft drinks are totally different. Having said that, the Indian volumes this time around were flat. African volumes grew by about 9%. International volumes grew by 9%, led by Africa. And that was something that the company had expected when they went ahead and acquired that company to de-seasonalize this overall business. So all those factors doing well for them. Lower finance costs, further boosting PAT, and the stock up 9% on the back of that.
How interesting, Manglam. So this is the Africa Carlsberg high right now reflecting on the stock.
It is the Africa Carlsberg high reflecting on the stock, further powered by no problems in India, aided by lower finance costs, and the remainder has come in on account of the possibility that at some point, they will get more than just, soft drinks in India itself. But that's still a very grim possibility.
No, absolutely. And that would be a separate conversation then altogether, and that would be a different line of business altogether in a highly competitive Indian market. We'll park that aside for later, if at all Varun has those thoughts. But for now, 9% higher. Thank you for explaining that to us. Let's discuss this and more with Dharmesh Kant. Dharmesh, good afternoon. Great to have you in. So you just heard Manglam there with all the key features and highlights. How would you look at this Africa foray? And otherwise, how do you look at the base business stock and the valuations overall?
Yeah, good afternoon, Survi. Thanks for having me for the show. See, the balloon beverage has been struggling as far as the volume growth is concerned in the India side of the business, and that's the reason why they are looking to other geographies. Africa, as far as beverages are concerned, which is non-alcoholic, their biggest competitor is Coca-Cola, and their margins are 14 to 15%. So it would be margin dilutive if they, market the non-alcoholic beverages in Africa. So that is not a great, thing for balloon beverages to have it as of now. I think it's more of a Carlsberg high, which the stock is running as of now. And going forward, it will depend upon how they are going to, again, monetize this kind of an opportunity into the margin accretive part of the portfolio, to which I doubt it will be a margin accretive kind of a business. Alcohol, as you said, it's a separate story altogether if they enter into that. But again, it signifies that they are struggling to maintain their run rate of 30% kind of a CAGR, which they have been successfully doing for the last 6-7 years. And with ROEs of 22-23%. So I think going forward, the ROEs will fall below 20% kind of a mark, and the run rate of growth will also come down to 15-16%. If you strip off the finance cost and the inventory gains, which was there in this quarter reporting, so then the PAT growth is only 5-6% stripped of that. So too many caveats out there, but the management is forthcoming. I mean, they are forward looking and they are trying to come out and get into new growth geographies. But my sense is, whichever you look at it, it's going to be margin dilutive rather than accretive going forward.
Dharmesh, at Chola Securities, how have you all analyzed SEBI's proposed norms on capping the TER, distributor commissions? And if you can break that up in terms of AMCs, the brokerages, and even, say, the wealth manager guys who are listed in India. How will the profitability get impacted?
See, everyone is going to suffer from this. The profitability across the value chain will be impacted, and the worst it would be the brokers who are executing the transactions because they don't have a fallback on. So SEBI does have a leeway out there. If you are like selling research services, you can price them separately, or some other company management meets you are doing, you can charge the AMCs separately. But that again goes as a cost for AMCs, and that is not accounted for in the expense ratio. What is perplexing is why, the SEBI is trying to regulate the expense part and the profit part of any of the intermediaries. These are not essentials or life-saving, commodities or Manrega kind of a thing or food subsidy. These are financial products and which well-to-do people are availing of. So let the cost and profit be decided by the competition which is in play. We also have a discount brokerage at the same time, premium brokerage is in place. So I was totally, perplexed to see such kind of, falling into it or trying to regulate the expense and the profit part of it. As long as that is there, it does not amount to free competition or a free economy. So we have a different, call on that altogether. This should not be there in place. So that's our understanding of the situation.
And we spoke to a range of players from the mutual fund side and distribution, wealth management, etc. And we'll play out some of the sound bites. Cohance is down. Cohance is back down 10% as we speak. Managing director of Cohance, Mr. Raju, has resigned for personal reasons. We spoke with Vivek Sharma, who's the executive chairman of the company, on what next. So just want to play out that soundbite. Listen in.
We are creating a new position of COO who will help us at platform levels with operations, including supply chain, EHS, and other functions that are important for the business, while the CEOs will be independently responsible for end-to-end P&L for their businesses. So yes, we are not hiring a new MD or CEO to replace Mr. Prasada. We have also segregated operations in a way that there is complete ownership and accountability of these individuals so that they can go with full speed, full direction to really go and create value for shareholders as well as for our customers.
Dharmesh, I don't know if you have a view on Cohance. Come in if you do. Also, a bit about the metals rally that we are seeing. Is it just sort of gains on top of gains, that kind of a momentum move here? Or something is really changing actually. I mean, on primary metals, copper, of course, in terms of global prices, has broken out, new all-time highs, but very few real exposure to in terms of stock exposure, direct stock exposure to copper prices, except maybe Hindustan Copper in a limited way. What's your sense?
Yeah, good afternoon, Prashant. Cohance, I will give it a skip because we have never, deep dived into that stock. Though the CDMO part of the business is, doing well for most of the players in there, and Lawless Labs continues to really benefit from that. So there are players who have been doing good out there. As far as the metals are concerned, I think there's a structural shift out there. As tariffs get negotiated between countries, and only now India remains the outlier out there. So things are falling into place, and we are into an interest rate down cycle with inflation totally under control. And most of the geographies and economies of the world are trying to push for growth. So that is one factor which is aiding the metal prices going forward. And dollar index also depreciated a bit, around 1% or so over the last few days. So that again is a positive factor. And the third big factor is there is very low inventory of metals across the board. So be it copper, aluminum or zinc, the inventory levels are quite low internationally, and slight demand, if it is there, so it creates a price surge into the metal space, as it is very sensitivity is too high. So that is helping them out. Direct plays in India, maybe a Hind Copper, Hindustan Zinc or Hindalco can be, you can have some play out there. But commodity as a basket, to my mind, I think it's getting into a structural bull trend going forward for next 2 or 3 years. Though it will not be a straight line kind of a movement, you will have this Brevard kind of a movement playing into it. But I do think this all-time highs, most of the metal companies which are commanding like Hindalco or say JSW Steel, Tata Steel, they will continue to trade at higher levels, and declines should be bought into. Because eventually, Prashant, I do think that things are going to get settled, and in a low interest rate regime with low inflation and all the geographies pushing for growth, metals are here to stay for some time on the higher trajectory of the prices.
CG Power numbers also coming through, and they seem to be a bit of a miss here. 313 odd crores was the net profit expectation, and there's a miss there. Even top line and EBITDA. So 377 crores compared to 431 crores is the EBITDA. So there is a miss. Margins are just about 10 basis points lower than what was expected on CG Power. Stock's not done well for a while. It's now slightly higher, about 12 rupees, 734 on a CG Power at this point. So, 2 numbers since we started the program, Radico and CG. We'll try and get you more details as we go along. Anything else on your radar broadly, Dharmesh? Any other sort of individual names to watch out for?
Yeah, one is we are looking forward to Orient Pro Solutions, earnings, which they will be reporting on 3rd of November. That is coming Monday. We are expecting 30% kind of growth out there, and the trajectory to be maintained. And what the management speaks about the data center architecture stack, which they are getting revenues from, 19-20% is there, and how it is panning out. So that is one area. But stock specific, we are more focused right now on most of the public sector banking names, and the trend is very clear. It's like asset quality is getting improved, and because of other income slippage this time around, the profitability is not high, but going forward that is likely to fall into place. So sectors are very few, Prashant, going forward for next 2 months to look forward to with the type of stock prices we are sitting on, and the sectors remains the same. It is the defense space, and going into the budget, railway will again be a big theme to play out for as we roll into budget, and some speed up of execution we have seen there. So Itcon International is one company which we are looking forward to because of the valuation comfort as compared to others in the railway basket, and the infra plays like Larsen and Capital Goods like ABB, Siemens. So these are the numbers. I mean, ABB in particular, we are looking forward to what kind of a number this company is going to lay out. So practically choices are very less, but this is a space which is available as of now.
L&T and BHEL will be the 2 capital goods companies reporting numbers later today. Dharmesh, great chatting with you. Thank you very much for joining in. It's time now to highlight our Super Pro chart of the day, powered by Money Control Super Pro, a segment where we turn data into direction each day. We pick one chart that sums up the story driving the markets and help you understand the why behind the what. Here is today's chart and what it means for your next move. GAIL India is a stock on your screen. showing a falling trend line pattern and a bullish breakout. A falling trend line bullish breakout occurs when the price breaks above a descending resistance line, signaling a potential trend reversal from bearish to bullish. And if you'd like to access more expert-driven insights and actionable chart patterns like this one, simply scan the QR code on your screen and subscribe to Money Control Super Pro. Plus, and this festive season, there is more reason to celebrate because 10 lucky subscribers every day will win 1 gram of gold. So don't wait, scan, subscribe, and make your portfolio shine brighter with Super Pro.
Well, 100 points, 26,000 plus on the Nifty, and things are looking pretty steady this Wednesday afternoon after yesterday's slight pause. And of course, the one sector which is sort of uniformly under pressure, of course, is the entire capital market space, which is down and out so far. Pashupati Advani is with us, founder and chairman at Global Foray. Pashupati, good afternoon. Great to have you with us here. Thanks for joining in. So just wanted to, I don't know if you own any of these capital market stocks or not, or if you have in the past, but longer run, I guess all this will pass, and the bigger story is financialization of savings, and it will continue. But structurally, when you look at, if you are to follow what's happening outside in terms of lower costs, more a market becoming passive, away from active, as is the case in the US now, in Europe. When we talk about more and more savings getting financialized, we take cue from what's happened overseas. In many of these things also, this has all happened the profits of intermediaries keeps shrinking, as we've seen in the US and in Europe, etc. as well. So this is on the same line. I don't know if you have any thoughts on how to think about this, Pashupati. What SEBI is proposing.
Well, as you said, SEBI is a good follower, and we learn from other countries, and we make rules that will hopefully keep us out of trouble. It is a fact of life that we are following the other countries, and I think SEBI is trying to do the right thing, and it helps. But I don't know whether it's going to get passed in this form. I haven't read it completely properly. Obviously, as you said, it's not good for intermediaries. It's probably good for banks, but we haven't seen much movement in the banks today. So let's see. I mean, I don't know what the timeline is. I'm guessing 3 to 6 months before, probably kick in 1st April next year. So let's see what happens.
Pashupati, everyone's talking about LensKart's valuation. You've analyzed a lot of these consumer tech companies, quick commerce. You've nibbled in Paytm at lower rates, come in, come out. Your thoughts on LensKart, and would you be buying it?
You would be an early investor.
I like everything else in.
You would be an early investor, probably.
Well, no, I have a small participation in a fund that has been in LensKart.
Look, I told you.
Its investments. Yeah, but honestly, I mean, Indians are great at copying. LensKart is a copy of an American lens crafter, and they have retail as well as wholesale and online. And we are a country that, as people get more prosperous, they'll start wearing glasses rather than walking around blind. So it's just a matter of, I mean, the whole market cap is going to be huge, and people are going to look at lens crafters and LensKart and say it's going to remain as a percentage, and it's got a sort of what is it, $7-8 billion valuation. So who knows? But I mean, Indians are going to continue to buy glasses. Indians, and they're also going to continue to buy all the fun glasses like sunglasses and reading glasses and regular glasses, and there's no reason.
There's no doubt about the business opportunity, Pashupati. But would you buy it at this valuation, 70,000 crore of market cap, and 200 times forward multiple?
That's a stretch, but I've kind of looked at IPOs, and I wait for them to settle. So I wait for 6 months to a year out, and then decide whether I want to be in it, and look at it, and then decide to take a position. Most of the IPOs that we've seen in the last few months are trading at or below the offer price. So let's see how they are 1 year out, and then that's the time to actually come in and take positions. According to me, there are too many IPOs. It's sucking a lot of money out of our market, and that's actually a threat to our market as a whole, even though we're lucky that Nifty's crossed 26,000 finally. 25,800 was a support. But I think that, these are the challenges. You can't keep sucking money out of our market, given that the foreigners have taken their money out, and how much domestic money is going to come in, and how much you're going to suck out for IPOs. So that's the other challenge.
Pashupati, hi. Good to have you with us this afternoon. Speaking of the market, today's big story, right? If these SEBI rules come through and mutual funds have that much lesser elbow room to charge investors, and they pay that much lesser to brokers to execute those trades, I mean, does it materially alter the investment case for both AMCs and for stockbrokers? For stockbrokers, the going is tough. That's why they've all gotten into wealth businesses. But what are your thoughts looking at the uncertainty today? The price is reflecting that uncertainty.
Yeah, to be fair, I think what is happening is that the cost, Indian mutual funds have actually charged a lot compared to, let's say, the US, where the charges are the least. So there has to be some contraction, and definitely the US mutual funds, you're not going to get paid anymore. So we obviously have to get less. And now that the proper mutual funds, and I would say the top 10 mutual funds have got AUM where they're able to, they've got economy of scale, so they can quite afford to give some of it back to the customer, and that's what they have to do, because that's what SEBI is saying. You want more customers, you have to pay, and hopefully the market will be another trillion dollars bigger in about 2 years' time, and therefore maybe even faster. And a lot of that will be in stocks that are with the AMCs, so they'll get money another way. They'll get it by the bulk rather than trying to make money on the same amount of money that they have. And all of them have had great growth in AUM over the last 2 years.
Yeah.
So why not? It's time for them to give a little back to the poor consumer that's actually paying for it. And because you've got a tough market where the return is going to look not so great. It's okay to take 2% when the market's giving you 20.
You're doing 15-20% return. Yeah.
Yeah. So if you're going to give them 4% and then you start charging 1.5%, that's not healthy. So I think that's what SEBI is trying to get in front of.
Pashupati batting for the common investor. Okay.
Why not?
Why not? Okay. Speaking about those returns, Pashupati, just want to get your sense on larger global issues that have been, on top of mind really. One is this whole, trade fiasco or this trade standoff between India and the US. And we'll just play out a soundbite, the latest one from the US president in just a second. And the other is a Fed meeting. Earlier it used to be a very straight line. Fed is going to cut rates. If global markets rally, you will have a bit of that sentiment flow through in India, and India will do well. All those correlations have broken in the last 1 year. So let's do one thing. Let's just hear out what the US president has said now. The latest statement coming from him on where the India-US trade negotiations stand and the fact that he's quite confident of signing a trade deal with China tomorrow.
So I'm doing a trade deal with India, and I have great respect and love. As you know, for Prime Minister Modi, we have a great relationship. Likewise, President Xi of China is coming tomorrow here, and we're going to be, I hope, making a deal. I think we're going to have a deal. I think it'll be a good deal for both. And that's really a great result. That's better than fighting and going through all sorts of problems and, no reason for it. I think it's going to be a great deal for both.
Okay. So, Pashupati, we've spent the last 6 to 7 months waiting and negotiation, and enough has happened back and forth, India and the US. Do you believe if this gets resolved, and at some point it has to, will it be a big trigger for the market? Or is it not so much, and it basically boils down to earnings?
So I'll tell you, we will sign. So far, the president has been known to also change his mind after signing. So that's a thing that one should be cautious about. And it still doesn't, it's created a lot of havoc on the ground. Is your stuff on a boat? What is the rate of duty that's going to be at when it lands at the port? Is it the date on which you sent it? Is it the date that it's been received there? There's a moving goalposts are happening there. I think if he signs the deal with China, he signs the deal with India, and he doesn't do anything signing deals with either of us for the next 3 to 6 months, I think that'll be fantastic to the market. I don't know if anyone's going to really get in front of it. Obviously, the market thinks that something's going to happen, and that he needs us as well. But honestly, China is normally mentioned 50 times more than India in the US. So I think they are definitely the focus is on India, China, because China has got such a huge trade partner with the US. We're less, and I think that even though he's friends with our PM, at the end of it all, it's all about the money, honey, and China, the numbers with America are a lot bigger. So we'll see.
Okay, so give us a new idea. We've been seeing in trade and all. We'll wait and watch. Let's talk companies and stocks. What are you studying these days? What's new?
So actually, what I'm looking for is what I'm seeing is that I'm quite bearish on the IT sector because I think that they've got lots of issues which they're not going to be able to resolve. That's my view, and I would not encourage anyone to actually jump into IT with both feet. I think the foreigners have taken their portfolio investments and gone, and then instead of which, when they do come back, they're going to come back into our big stocks. And, it'll be into infrastructure and L&Ts and the cement stocks and the steel stocks. So that's where the first money is going to come back. I don't see any trigger right now to make it come back, but it ought to come back because we are definitely a viable market which should receive money. And right now, all we've been seeing is negative outflows from foreign investors. So we'll see. But I think that in the interim, our retail public is enjoying themselves in the mid caps and small caps and having fun. New fund managers are opening up mid cap funds, so that's another inclination of where they think the market's going to move. But at the end of it all, the real money is going to be brought into big stocks, and I want to see a little bit of movement in those before I jump in with both feet. And I also feel that there'll be some interesting PSUs that will come to market and will be given an attractive Ps. We saw that in the defense sector about a year ago when they started pushing out secondaries in the defense sector. They were quite reasonable. I think the government will probably do some more disinvestment and at attractive levels. So that'll be interesting places to put money. Those are my thoughts on the market.
Okay. All right, Pashupati, we will let you go on that note. Thanks very much for joining in. Good conversation as always, and we look forward to the next one. Well, with that, let's quickly get back to the screen and see what's happening. As far as the Nifty is concerned, still about a 108-point up move for the time being. We have Mangalam back with us to tell us what's the latest in the F&O arena. Mangalam, how's it looking?
Well, it's been a good start to the November series so far after what was a stellar October series. However, the curse of that 26,100 mark still continues. So if you have the Nifty that's doing well, the Midcap index as well, today the Nifty bank is conspicuous by its absence in the up move. It has moved higher from the earlier part of today, but still not as much as the Nifty. We have the Nifty IT, Reliance and the Metals pack, which have actually been doing a lot more of the heavy lifting in today's trading session so far. But if you look at the Nifty days high, we still haven't crossed the earlier high of 26,104, which was hit on October 23rd. In fact, the one thing that we'll be watching out for today is that whether the Nifty closes above that 26,000 mark or not. Nothing to believe that it won't, but the last 3 occasions it's crossed 26,000 on an intraday basis. It hasn't closed above that, so it actually fell from those levels. Today, it looks like it will close marginally above that 26,000 mark, and that has got a lot of put writers fairly active. The other thing we'll look at is the 26,277 mark, which is the previous all-time high for the frontline index. So 26,000 and 26,277 are the 2 marks which are very important in terms of a range, and that's exactly where a lot of the action is. 26,000 put, fairly active, 94 rupees premium, telling you first support comes in at the psychologically important 26,000 mark, and thereafter is 25,900. On the way up, however, 26,100 call, which is closer to today's high, continues to see some writing, and that too has a higher premium. So closer to record high, we might face some sort of supply coming in. 26,250 thereabouts is what the premium on the 26,100 call tells you. A lot of individual stocks are on our radar. Varun Beverage is a big move coming in out there. A lot of long positions added. Metal stocks doing extremely well. That sale also, open interest jump of nearly 22%. We'll watch out for whether that stock goes into F&O ban or not. Suzlon Energy is the other one, which has seen a lot of long positions being added too. And finally, as we move towards the end of November series, in 4 weeks from here on, as we start a new series, a few triggers that we'll be tracking, a lot of them will be front-ended. Obviously, tonight we'll have the outcome of the US FOMC, thereafter developments around the trade deals, both India, US and US-China, and also remainder of the second quarter results. All of them would be extremely crucial to track.
All right, Mangalam, thanks very much for that. So it's action-packed next couple of next few days, but of course, next few weeks as well. Vedanta is spiked up about 2% in the last 10 minutes. If we can have the intraday up. So there you go. It's up. It was up 2 when we started. It's up 4 now and moving up as we speak. I'm not sure. The case is supposed to come up in the NCLT. We checked about 15 minutes back and, we were still waiting for the case to start to come up in the court. But we'll check again. 523 on Vedanta. So that's a sharp move that we are looking at. We'll take a quick commercial break here. As always, we'll get you some short-term trading ideas. And of course, dealing room chatter with Nimesh as well comes up in just a bit.
Welcome back. It's a good start in the November series. The Nifty continues to hold on to 26,400, a gain of about 0.4%. Stocks related to the shipping sector are now moving up. So dredging, SR shipping are up double-digit. Dredging is up nearly 16-17%. Graphite India is seeing a bit of a spike, and Blue Dart came out with good numbers, and that stock has also soared nearly about 18-19%. Urban Company is back on the buyer's radar. ARC reports that Radhakishan Damani has bought stake worth via his various entities worth 175 crore rupees in Urban Company. So his investments in new age tech companies continue, and that stock has made a bit of an up move. But Mitesh is now back with us for Bonanza from Bonanza Portfolio. Mitesh, what are you doing now?
I have two BTSC calls. I think the power stocks are doing very well. So I have picked up Power Grid as a BTSC call. Keep a stop below 222.7 for a target for around 298. And Havels is the other one trading near the day's high. I think that's a BTSC with a stop at 1496 for targets of 1525.
Okay. Mitesh, got it. Thank you very much. And thanks for all the trading advice through the day. You have a good evening, and we'll catch you again with the market action tomorrow. But for the time being, it's time for all the D-Street chatter. Nimesh is joining in with that action. Nimesh, so quite a roller coaster today for the asset management and the broker stocks, right? But beyond that, what else? What's the sentiment like? What did you pick up?
Well, it should be a good start to the November series. Again, the leader of the pack seems to be the PSUs, and I've been saying this that selectively there is PSU buying happening, and the PS index is at 1.5%. But within the PSUs today, it looks like some of the underperformers of the laggards within the PSUs are now seeing a bit of a catch-up rally. So clearly that's playing out within the PSU basket. Flows again a mixed day is what I understand. But as I said, PSUs is something where there is a bit of buying interest. Capital market stocks, of course, they are under pressure today on the back of that SEBI order, and that can have a bit of an impact for sure in terms of earnings, and that's why those stocks are reacting in today's market. I guess for the November series, I've been saying for the last 2 days, the latter part of the earnings as well as the Indo-US deal, that's going to be a big trigger to watch out for. So clearly, again today, because of some noise, you're seeing a bit of rally in Adani stocks as well. But it looks like the momentum is clearly there, and now it's spreading out to the broader markets as well.
Okay, all right. That's the broader take in terms of what's happening in the market. Stocks, Nimesh, what's on the list today?
So the first stock on my list, Prashant, is Colgate. We normally don't talk about this name, but surprisingly, this is one stock where one of the domestic leading mutual fund seems to be adding this name in the last couple of days. So that's something to maybe that explains a bit of delivery-based buying happening in Colgate of late. Second, couple of stocks where I'm expecting large block deals very soon. Himadri Chemicals and Shyam Metallics. Both have been in that narrow range of late, but expect large block deals soon. So just to clarify, both these blocks are non-promoter blocks. So none of the promoter entities are going to sell in these block deals. The third name is Max Healthcare. Within the so-called insurance names, this stands out in terms of buying interest back. So maybe a bit of buying from larger FIs in Max Healthcare today. And last is Jubilant Pharmova. This is interesting. The earnings are yet to come, but I understand one offshore fund has been an aggressive seller in the last couple of days. Looks like it's at the fag end, and that can exhaust very soon. And some domestic mutual funds and AIFs have already bought this name. So watch out for Jubilant Pharma in terms of large block and maybe earnings as well in Q2.
We highlighted Varun with Mangalam. Nimesh, anything you're picking up on this? It's a sharp move. I mean, the quarter was not all that great, but of course, it's that Carlsberg thing.
I think a couple of things, Prashant. One, there was no big, ownership or a bit of buying before the results, so to speak. And result has actually beat the estimate. I was looking at the numbers. The street was somewhere around 680 in terms of profit, and it's come at 724. One. And second, of course, that Carlsberg's deal will mean that they're going beyond, they're getting into the alcohol space as well. So I guess these were the two main reasons why you've seen a big reaction. I guess large part of the reaction is because there was no preemptive buying going into the results in Varun Beverages.
The other one is M&M Finance. Again, I mean, it sits up 6 after. Usually, we don't see a positive reaction after earnings, but this one, and of course, I mean, it's not that new, but the CEO is what, a year old, maybe a little more now, right?
Yeah.
Raul Rebello. So that's up. I think this got to upgrade as well. Maybe I saw one of the foreign brokerages with the note post results.
Actually, there were a couple of upgrades, Prashant. Most of the streets has raised the target price on M&M Financial. And even if you look at something like Morgan Stanley, while they have an underweight rating, they still believe that, from a downside, at least the downside seems to be protected while upside may not be the case there. But at least from a street perspective, most of them has raised the target price in M&M Financials.
Okay. Nimish, thanks for that. Stay there. Stay with us. Yeah. Because Vedanta is also, there's news coming in on Vedanta as well. And maybe we can talk about that as well. So, I think Ashmit is... Okay, Ashmit is not with us. So, Nimish, what we'll do is we'll just get Ashmit on as well, and then we'll come to you. Vedanta application for demerger in NCLT suffers a delay. That is the news which is coming in. And look at the stock. I was pointing out how at about 3, it was up 4%. It's basically given up bulk of those gains. And NCLT is going to hear Vedanta's plea government objections once again. So it's been long in the making, but of course, no decision yet again. Vedanta is seeking rehearing at the earliest. NCLT to begin rehearing case on the 12th of November. Anything else, Urbi?
No, I'm just saying the surprising fact is that apparently the entire bench has been reconstituted. Yeah. Which is why the fresh delay. And then therefore everything has to be, the whole matter has to come up for hearing all over again. I think maybe Ashmit can give us the details as to why the whole bench had to be reconstituted, what the legal issues at play were. But yeah, it seems the wait for that demerger is just continuing.
Typically in courts, etc., if a judge retires, a new judge comes in.
Or if a judge recuses, himself from...
Yeah. But if somebody's been hearing the case the last few hearings, why would they recuse now? Yeah. So we'll see. But typically, if somebody retires and a new comes in, they start hearing the matter from the beginning. So we'll see. But it's not done. At least today is not the day when this kind of goes through. So there's a delay. 12th of November is when the rehearing will start once again. So we'll revisit this with Ashmit in just a bit because he's been tracking and I think he was listening into the court proceedings as well. But L&T will report later today. So let's get a quick preview out with Vivek, who's with us. Vivek, take it away.
Well, a lot of news flow, but L&T also very important to watch out for. Remember, Capital Goods Infra Major will report its results maybe the next couple of hours. This particular quarter, it's been an eventful quarter. Lot of order wins as well as L1 positions or lowest bidder position as far as West Asia is concerned. So that will be key to track. The second important point is, remember, Hyderabad Metro divestment is something that the management has already alluded to. So commentary on that will be key to track. Talking about the numbers, revenue seen higher by close to 13.5%. EBITDA seen higher by close to 10%. The EBITDA margin seen softening on a year-on-year basis, down 40 basis points, and profitability higher by 17%. JM Financial says that the company should go ahead and beat the order inflow guidance of 10% that they had given at the start of FY26. H1 order inflows, they expect at close to 2 lakh crore rupees. Now, core EBITDA margins, the key to track as far as L&T is concerned, is expected by JM Financial at close to 7.9%. That is something that the management has been looking to go ahead and improve, but again, that will be key to track. In terms of the guidance, top line growth for 15% for FY26, order inflow guidance of 10%, which is expected, the street expects the company to go ahead and increase the order inflow guidance.
Okay. All right, so we'll watch out for those numbers. Vivek, thank you for the heads up on that. Mayuresh Joshi is with us to take us to the final leg of today's trading action. Mayuresh, great to have you in. Let's start with Vedanta, actually, because it's a different beast for investors to track because you have access and exposure to a lot of the interesting metal businesses, which are anyway, at their own level doing very well. We've seen what happened to metal prices, whether it's aluminum, copper, everything in metals is going up. But then you have this 5-way demerger, and it's still in the works. What would your advice be? Because the stock actually has risen pretty well. It's very close to its all-time highs at 500 plus now.
Afternoon, Surbi. So I think it's penciling in the best to come once the demerger happens. And the caveat here is once. And therefore, I think the court proceedings and the delay thereof is something which will act as an overhang on the stock. And you're clearly seeing the kind of reactions the stock probably gives as either the court date approaches or the news that you just flashed in terms of the entire bench getting reconstituted. So I think any delays hereof, at least as far as court proceedings are concerned, I think that can create some element of an issue as far as the entire demerger process is concerned and the entire value unlock. Anybody holding can hold on to the stock at this juncture, Surabhi, but I think clearly it has to go through these court hurdles to probably ensure that this process starts working in terms of the estimates expected to come through at least on a standalone company basis from FY27.
20% on Blue Dart, Mayuresh. What have you all made of it?
I think decent set of numbers. Afternoon, Rima. I think the ground express division is still 35% for Blue Dart. and that is expected to grow in double digits over the next few quarters. When it probably comes to the Air Express division itself, I think the expectations in terms of new fleet addition that Blue Dart has probably done, the utilization levels are pretty decent. In fact, they've reached around 80-85%. And therefore, I think as these utilization levels start inching up, you might probably see the leverage component or the operating leverage component play out. Q2 is expected to be relatively softer for Blue Dart, and the numbers were relatively stronger. They head into Q3, which is probably their strongest quarter that they will probably witness. And therefore, I think the street remains very, very optimistic based on Q2 numbers, that both the volume growth in terms of Ground Express, in terms of recovery of the Air Express, in terms of utilization levels, might actually show in terms of recoupment of margins taking place, and therefore better numbers in terms of earnings. So I think very good set of numbers. The street is very, very optimistic as far as Q3 is concerned.
Okay, that's Blue Dart. What a mover today, 20% circuit. Now let's just go back to that Vedanta story for a bit to understand why is this delay happening at the NCLT. Ashmit is joining in with the latest. Ashmit.
Well, a minor setback being suffered here at the hands of the NCLT. Bear in mind that Vedanta's application for demerger was pending approval before the NCLT. The arguments were in fact made. There were lengthy arguments made by SEBI. There were extensive arguments that were actually made by the Centre, the Ministry of Petroleum Natural Gas. They had in fact expressed their opposition to Vedanta demerger. Now, all of these arguments had broadly been completed in September. And since then, the matter was listed twice in the month of October, but the matter could not get taken up. Now we are in a situation where the bench of the NCLT itself has changed. The judges who were hearing this case, they themselves have changed, which has led to a situation that a new bench of the NCLT now says, we want to rehear this entire case once again. Now, bear in mind that Vedanta counsels were present before the NCLT. They expressed a sense of urgency, said they want to hear this matter and get it over with at the earliest. The government counsels were also present. They too were given the opportunity that they will also have to argue once again. Bear in mind, the Centre is opposing Vedanta's application on a number of counts. Number one, they say there hasn't been full disclosure with respect to the liabilities. Also think there's a financial risk to government dues, to statutory dues once this demerger process is underway. Also going on to say that there are a number of liabilities that were not disclosed. There hasn't been, Vedanta hasn't come with clean hands. That's the broad sum and substance of what the government has been arguing. SEBI on its part placing their stance on record today, clarifying that they were not happy with Vedanta modifying the demerger plan once the approval had been granted, but Vedanta today clarifying before the NCLT that even SEBI, which though was not happy and gave a rap on the knuckles to Vedanta, has also concurred, has granted its blessings to the modified demerger plan. So as of right now, a minor setback, a delay being suffered. The hearing in this case will resume from scratch all over again, and that's beginning November 12th.
Ashmit, thanks very much for that. I guess people waiting for something sort of a forward movement of this would be disappointed a little bit at the margin. So 512 has come off the highs, which it had hit at about 3 o'clock or so. We'll take a quick commercial break here. We'll come back with more markets. I think there's about 8 minutes to go for close. Stay tuned.
Welcome back. 3 minutes left to wrap up today's trading session. Good close, likely to be above 26.50. Mayuresh, CG Power came out with their numbers. I don't know if you had a chance to look at it. It looked like a bit of a margin miss, but the stock is up 4.5%. Any early thoughts?
I think the stock has performed extremely well, Rima, over the last few years. And therefore, I think the expectation in terms of more orders coming their way as we head into the second half is clearly reflecting in terms of the price action. Yes, margins were a little bit lower than what the street probably estimated or expected. But a large part of the expectation largely is that as they keep on executing well and as more orders come their way, with relatively better margins, and they've got a lot of the working capital requirements under control, that will efficiently show up in ROEs, in reported ROEs and ROCs as well. So I think very, very optimistic in terms of more orders coming their way from the central government or otherwise to boost execution and numbers there.
Yesterday's big winner, Cartrade Tech, is down 5.5%. It's been a big mover, 200% higher in the last 1 year. What from here?
I think we'll have to wait for declines. I think it's been a significant move as far as Cartrade Tech is concerned. And it has been backed by decent fundamentals from the all-time lows that it probably saw last year. But again, valuations have become very, very expensive. As we see it in markets with India, I think it's trading way above its pivot and probably making a late-stage base. So you'll have to wait out for significant declines on this one.
Cartrade Tech came out with numbers yesterday. Margins were 33%. But in the conference call, they said that margins can reach 55 to 60%.
Wow.
Yeah, I mean, that's what, and I think that's what got the street excited yesterday. But of course, it's moved up a lot.
What is it? Car Wale, Bike Wale, OLX, right? All these platforms.
All these platforms.
Margins should be very high, asset light, right? It's just a platform.
It's just a platform, right? And then it benefits from the GST cuts. I mean, the OEM sales, etc., will show up in the revenues. And plus, margins are so much higher.
Well, the stock's done phenomenally well, right?
Yeah.
I was just looking at actually, that's the thing. Anything, you look at something like Allied Blenders, completely different business. It's a second year in the listed space. Was available at $300 last year. No takers. $650 now in basically a year. So yeah, I mean, post listing, and I think that's the time to look at many of these names. Right after listing, the fizz gets out 4, 5, 6 months in. And the stock starts languishing, and then but you got to keep a track and track some of these businesses when they come to attractive kind of levels. And many of these stocks, of course, I mean, there is the liquidity aspect. People are bereft of ideas, so there's a lot of liquidity chasing underperformers, and maybe where there is beyond the short term there is growth visibility, and maybe Allied Blenders from the Alcobev space is one such player. But generally speaking, underperformance right after listing for many of these names for a few months, and then they all start to pick up again. Mayuresh, of course, is going to be with us on markets forward in a bit from now. I just want to quickly wrap up things. So Nifty is at about 26,070. Nifty Bank at 58,400 actually, 185 points higher. And of course, the mid and small cap indices, no problems today. And market breadth looking very, very solid, 2:1. The only problem point was the capital market index, which ends down about 2%. Otherwise, on the gaining side, it's oil, energy, resource companies, basically, metals. That was the winning side today.
Well, just to list out some names, NTPC was your top gainer, 3% up. Power Grid, the entire Adani Group complex had a good day. Adani Ports, Adani Enterprises, Adani Green. In the metal stocks, JSW Steel, Tata Steel, higher in trade. And then you had a Shriram Finance, SBI Life, HDFC Life also gaining close to about 2%. On the way down, Coal India posts numbers. Dr. Reddy's was the top loser. Stock closed above the 200-day moving average, but below the 50 and 100-day moving average. BEL, Eternal, M&M, Hero MotoCorp, Maruti, so auto a bit on the back foot. The Midcap index closes up with a gain of about 0.6%. Well, with that, it's a wrap on closing bell. Thank you very much for watching. Stay tuned for more news and updates.
Market ends higher. Nifty closes above 26,000 and Sensex ends at 85,000. Midcap index hits one-year high. Auto index slips in a good market while metals, media and FMCG stocks among the top gainers. SEBI issues a consultation paper on mutual fund rules that seeks to enhance transparency on expenses but also trims outgo to brokers. The tightening move spooks stocks of AMCs and other market participants. Copper nears its all-time high, aluminium scales to a 3-year high, and zinc trades close to its 10-month high as optimism over a US-China trade deal coupled with supply concerns give bulls reason for cheer. Indian metal stocks rally with Nifty metal at record high for 6th straight session. Hello and welcome. In today's special edition of Markets Forward, we put the spotlight on SEBI's consultation paper on mutual fund rules, which aims to enhance expense transparency and trim outgoings to brokers. But before we talk about it in greater detail, let's understand what these changes are now. SEBI has proposed a sweeping overhaul of how mutual funds charge investors, aiming to make the system more transparent, fair, and performance-driven. The proposal, if implemented, could lower costs for investors, but also squeeze profits for fund houses and brokers. To begin with, SEBI has proposed reducing the total expense ratio, or TER, charged by mutual funds. For open-ended schemes, the cut could be up to 15 basis points, and for close-ended schemes, as much as 25 basis points. In simple terms, that's the portion of your investment that goes towards the fund's management and operational costs. Currently, equity-oriented schemes can charge up to 1.25%, but under the new proposal, that will be capped at 1%. For debt and hybrid funds or schemes that are not equity-oriented, the ceiling will fall from 1% to 0.8%. SEBI has also proposed removing the additional 5 basis points charge that mutual funds were allowed to levy on their entire assets under management. That extra charge was introduced in 2018 as a transitional allowance, and now SEBI feels it's time to rationalize investor costs. SEBI has also proposed that fund houses venturing into non-mutual fund businesses such as portfolio management or advisory must do so through separate business units. This ensures that costs are not cross-subsidized and that investor money in mutual fund is used strictly for that purpose. In addition, statutory levies like STT, GST and stamp duty, they will remain outside the expense ratio. This means these taxes will be shown separately, allowing investors to see the real cost of fund management versus regulatory levies. Now to one of the most interesting proposals, performance-linked expenses. Under this framework, mutual funds may be allowed to charge a higher or lower TER depending on how the scheme performs. If the fund outperforms its benchmark, the AMC could earn a slightly higher fee, but if it underperforms, the expenses charged would reduce. The idea is to align the fund manager's incentives with investor outcomes so they earn more only when you, the investor, does well. A detailed framework for this will be developed after consultations with the industry. This also marks a shift from SEBI's 2023 approach, when the regulator had proposed including all such charges within the total expenses, an approach that was met with significant pushback from the industry. While these proposals are investor-friendly, they may tighten profitability for asset management companies. According to estimates by Jefferies, a 5 basis point reduction in equity-related charges could impact AMC profits by 8 to 10% if the new rules take effect from FY27. The cut in brokerage fees could also hurt institutional brokers who might see lower revenue from mutual fund transactions. However, for investors, this could be a positive development with fewer hidden costs, lower expenses, and more transparency in how their money is managed. Comments are invited from the industry, and the deadline is 17th of November. In fact, earlier today, we spoke with Ashish Somaiya of White Oak Capital AMC and Sandeep Bagla of Trust Mutual Fund to understand the implications of the proposals if it goes through. Somaiya calls this a positive move. Meanwhile, Bagla says the impact will not be big. Listen in.
I think obviously the key takeaway is that for let's say you and me as investors and our viewers at large, it's really positive on two counts. One is obviously because mutual funds do have transactions and turnover. Buy-sell trades, and obviously if you assume, of course, the cost incurred was not actually 12 basis points. On an average, it would be lower. But net, if they're saying that the cap is down from 12 to 2, A couple of clarifications. First, of course, it will reduce the cost of transaction, and to that extent, the alpha generated by funds, to that extent, should actually go up because the benefit will go to investors. Second thing is that if you think of brokerage or whatever is paid to brokers as 12 bips, it's not entirely paid to brokers because there are components like exchange fees and stamp duties and STT and so many things out there. So it's not like 12 becoming 2. It will be more like, say, as per the regulatory paper, if it was 10, it might become like 4, 5, 6 or something like that. It will settle at because everything doesn't go to the broker. What the broker bills, there are further components into it which go to exchange and stamp duty and all those kinds of things. But yes, that will benefit investors. The second thing to keep in mind is that when you look at the, statutory levies within the TER other than this. So like you rightly pointed out, GST on the management fee was outside the TER, but let's also understand that there are various other components of operating expenses that we pay. Depending on the size of the fund, we may be paying anywhere between 8 up to 14, 15 bips as operating expense. And that has, say, the registrar's fees, it has the custodian's fees, a lot of other operating expenses we incur. Everything has a GST component in it. So for a moment, if I say that the OPEX is 12 basis points, you must assume that it is more like 9.5 plus 2.5, something like that. Because that 2 to 2.5 basis point of statutory levies, which is there in all the OPEX, that was also going from TER. So that has to be actually moved out. Then obviously one needs to wait for, further straightening out or, clarification on this. But there are other components in the TER also where there is a GST, which was actually hidden inside the TER. So net, lot of rationalization. And
what about that 5%, Ashish? 5% on
5 bips.
I think that 5 on exit load, which you could charge, right?
Yes.
But that basically, it was not there pre-2012, right? So you're basically going back to that regime. It was introduced, I think, in 2012.
It was brought in when exit loads were removed in 2012.
Yes.
In lieu of that, it was 20 basis points and it was reduced to 5 basis points in 2018. And now it has been abolished. So how big a hit is that, Ashish?
Yes, so yes, that's what I'm saying, that net, I think the TERs will go down. There is no doubt about it, because while the regulator has said that we are trying to remove all these components from the TER, and to that, so if that becomes X TER, then we are trying to reduce the TER and remove these components and make them TER++. But
is it bad for business, Ashish? That's the simple question. Now that you can't charge this additional 5 basis points and all the other, statutory charges have to go out of TER, I mean, if you look at the rationale the regulator has put out, it seems very clear, very clear. So I want to know how much is the expense ratio, GST, stamp duty, etc. is all plus.
Yes,
and
I think that...
Yeah.
Sorry. So you're right that at least that 5 basis points plus a bit more. So that will be, it depends what the AMCs take a hit and how is it shared with the channel going forward. But for the investor, I think the TERs will come down even after making all these adjustments of removing from TER, adding plus, etc. Net TER will go down. So the industry has to, figure out how to absorb that.
This is, gentlemen, I don't know if you agree, Europe has this MiFID regulation, right, which was brought about a few years ago. This is like India's MiFID moment. If this goes through, Ashish, you would agree?
Yeah, to an extent, it is looking like moving in that direction, especially when you talk about the cost of transacting and, brokerages, etc. But I think, over a number of years, what has happened is, as asset management companies' scale and size has increased, people have invested heavily into research, right? And not just the large AMCs, even, players like us, say we are more like 10 billion in size, but even we have a very large research team. At the same time, I would say that brokers don't just do transactions. There is definitely a lot of value addition, but I think we have to, arrive at some kind of working equation.
Okay, Mr. Bagla is also with us. Now, Mr. Bagla, you tell us, I'm asking a very simple question. Does this impact profitability? Will profits and margins for asset managers come under stress? That's the big question that shareholders of listed AMCs need answers to.
So, SEBI has proposed that what we charge, the total expense ratio, be reduced by 15 to 20 basis points. And lion's share would probably be reduction in distributor fees also. And some of the expenses like GST, STT, CTT are now allowed to get charged. So the impact will not be as much as the top line suggests. And it depends on how much distributor fees are also compressed by the AMCs. So in the short run, yes, there would be an impact in terms of lower fees when this goes through. But over a small to medium period of time, I think it will adjust. And if, looking at the growth at which the mutual fund industry is growing, I think we will see it as a small blip in the longer term.
Ashish, comment on this point. I mean, it essentially boils down to just this, right? How much can you compensate by lowering the distribution fee and the commissions, and how much can the AMCs absorb? Right now, what's your, I know it's very early days. If this goes through, can 50% be absorbed and, the share is 50-50 between distributors and the product manufacturers? How will it play out? The hit.
So listen, I think that 5 basis points plus, that 10 to 15 basis points depending on slab. So let's say that net the regulator has spoken about reducing about, say, 15 to 18 basis points, right? And then let's say we benefit 2-3 basis points because a lot of the stuff which we're absorbing goes outside the TER. So I think, all told, if you really ask me, the industry has to contend with figuring out how to manage this. I think it will be 10-12 basis points, not more, which is what the knock will be. But 10-12 basis points is a significant number. And yes, within that, clearly, we have to arrive at an equation. Now, different players will have different equation with the channel partners, but it will have to be split. Because ultimately, if let us say on an average 60% is going to the channel partner and 40% is going to the AMC in terms of retention, then it's only fair that even the knock is split accordingly. So I think that will be the bare minimum. So ultimately, when you ask about AMCs, it will boil down to low single-digit basis points of impact.
Meanwhile, Prateek Gupta, CEO and co-head at Kotak Securities, believes small and mid-sized brokers will be impacted if SEBI norms are implemented. In fact, he went on to add regulators should let free market forces to prevail and that they should encourage competition. Listen into what he had to say.
Obviously, the impact would be quite negative for partly the mutual fund industry and also the distributors and brokers who service or who are very heavily dependent on the mutual fund industry. But I think it will be very, very negative for some of the smaller brokers and also for some of the smaller mutual funds in particular. And even the larger funds and distributors, they will be impacted to some extent. And I think you will start seeing resources being directed more away from mutual funds towards other categories like PMSs, AIFs, or foreign portfolio investors. It's a free market, and brokers charge whatever. Even when we service FIIs, we have different rates for different customers depending on how much servicing they're taking from us, etc. So the best thing in my view is encourage competition, let free market forces prevail.
Okay, with that, we'll slip into a short break for now, but do not go anywhere. We'll continue the discussion on the other side of this very short break. Stay tuned. Welcome back to the special edition of Markets Forward. We are discussing and analyzing SEBI's consultation paper on changes in expenses charged by AMCs or mutual funds for investors. Let's go across to a discussion I had with Shweta Rajani of Anand Rathi Wealth and Akhil Chaturvedi of Motilal Oswal Asset Management. I started by asking them about the impact of proposed rise in base level charges and if this impact will be neutral for AMCs or it will largely favor investors. Listen in.
firstly, I have to say, the overall circular, if I look at it from a client standpoint, it's very good. And, over the years, we've seen SEBI has been focusing towards investor protection, investors' benefit, bringing in transparency in mutual funds, having more disclosures. And this is one welcome step, towards that again. Specifically talking about the 5 bips exit load, see earlier on, also, if you see this till 2018, this used to be 20 bips of exit load oriented fees charged, which was brought down to 5 bips. And this was any which way is supposed to be transitionary in nature. This 5 bips actually goes back into the scheme. It doesn't go into the AMC profits any which way. So from an AMC profitability standpoint, I don't think it's going to have any implication. From a expense ratio standpoint to the investor, this is again a good thing because it will reduce the expense to that impact. Because earlier on, what would happen is if the base TER was, let's say, around 1.8 and then you had this additional 5 bips. Now, while there has been a reduction on the total base TER as well, this 5 bips is now included as a part of that TER. So it brings down the expense for the scheme for the investor. So for an investor, this is good because it will mean marginal improvement in the NAVs and the return that you would see. As far as an AMC is concerned, this used to anyways get passed on to the scheme, not to the AMC profitability, so it should not have an implication there.
Oh, okay, all right. So it should not be that big an impact on the AMC because it was passed on to the scheme. Akhil, what's your take and how do you view these proposed changes?
So I agree with Shweta that largely the regulator is keen to ensure that as the industry scales up and reaches newer milestones, there are economies to scale and, and such economies of scale, probably should be passed back to the investors. So cost coming down in any way is always positive for the investors because, the leakage of return actually drops down. Now, broadly what we see is there are 2 large changes from investors' perspective. The larger change, what we see is obviously the cost of trades where we were paying up to 12 basis point as brokerage. This comes down to 2 basis points. So that's a straight shot 10 basis point benefit back to the investors. So that's a significant, I think, development, point number 1. From the AMC perspective, like Shweta mentioned, 5 basis point, which was being charged in lieu of the exit loads, now goes away, right? And they're saying that they've included that in the first 2 slabs. But having said so, the base TERs have come down by 15 basis points. The only flip is that the statutory charges like GST, STT, all of these charges will be now loaded on the total TER and will be then eventually passed on to the investors, right? So, net, I feel that there is a marginal impact on asset management companies and distribution, but a big benefit coming to investors by way of operating costs coming down via reduction of cost on the trades.
Okay. Will this new framework meaningfully reduce the cost gap that we see between active and passive funds? Shweta, let me start with you first on this.
Yes. So, let me talk about a passive fund today. If you're investing in an index fund, most of them have, while they're allowed, I think, 1%, they generally would charge somewhere around 50, 60 odd paisa as the base TER and little add on to that. So even in the passive fund space, there's been a 15 paisa reduction now to that 1%. It's come down to 0.85. So to that extent, it's a 15 bips reduction. But your brokerage and all those costs included, if I look at even the active space now, clearly between the 2 fund structures, active and passive, in the active side, if you put everything together, the reduction in the TER, the exit loads going away, the brokerage costs coming down could mean somewhere around 20 bips of reduction across the slabs on the expenses. So would it bridge the gap between the returns that you see? Definitely. The cost reduction would mean that your active fund is seeing little more reduction in your expenses. To that extent, the return differential between a passive and the active fund would go up. The costs would come down between the 2. The cost gap would come down, I would say maybe around 10 paisa. And to that extent, the performance of the active funds would further go up.
Okay, and that continues to be the debate always, active versus passive. How do they perform in a market like this? So you are saying the cost would go down and active funds would perform better in that case because of the cost differential that would come by. That's an important clarification. Akil, the other part of this notice has been that this performance-linked TER framework, which the AMCs can or cannot adopt. The other one is separated execution from research cost. Both of these, will that be a challenge for AMCs, or do you think this is a welcome move?
No, so on the first part, obviously, I think it's a welcome move. Since we also run a large alternate book, and we see that a lot of the high net worth family offices, they prefer to have lower fixed expenses, and a lot of the performance fees needs to be paid once the manager performs. And that kind of a structure, if it can be implemented on the mutual fund structure, so definitely from HNI's perspective, I think it's a welcome move. Now, how and in what format it will happen, obviously it needs to be seen, and we'll wait for a lot more clarity. But if there can be a separate, like in alternates, we have separate share class. Here, if we can have a separate performance plan, and what kind of flexibility is given in terms of hurdle rates, the carry share, etc. But clearly there is an audience in the market who's looking at rewarding the fund managers basis their performance, and will have one more option to choose from between a fixed fees or a variable fees basis the performance. So I think definitely it's a welcome move.
All right, that is some opinion coming in. Let's get you some more. Sandeep Parekh, who's the managing partner of FinSec Law Advisors, spoke to us on the SEBI's proposal as well. He also expects this to discourage smaller players in the market. Listen into what he had to say.
It does disadvantage new players. It disadvantages smaller players because it will make them either less viable or make them viable over a longer period of time with longer gestation periods. This point is really low, and I think like I said, unless there's evidence that there's either cartelization, that the market doesn't work, and there has to be price cap, I think we should trust capitalism to work. Trust competitive markets to work, and as far as I know, they do work, and I would not kind of support these new price caps.
All right, that's the word coming in from Sandeep Parekh. But with that, it's a wrap on this special edition of Markets Forward. Stay tuned. More news and updates on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty end in the green after a steady session. Nifty moves back above 26,000. Midcap index hits a one-year high. Nifty Metal Index hits a record high for the 6th session in a row. Market regulator SEBI recommends lowering the brokerage charges imposed by mutual fund houses, also tweaks rules dictating fund management fees. Asset management companies and broking stocks suffer sharp cuts in trade.
Prime Minister Modi is the nicest looking guy. He says, oh, and he looks like you'd like to have your father. Like, he's a killer. He's tough as hell.
US President Donald Trump praises Prime Minister Modi, says he's doing a trade deal with India. Also reiterates his disputed claim of personally averting a nuclear war between India and Pakistan. President Trump says they have reached a trade deal with South Korea as he addresses the APEC summit in Seoul. Also expects a good deal with China ahead of his summit with President Xi Jinping tomorrow. ChatGPT maker OpenAI transitions into a traditional for-profit structure, clearing the decks to go public. The move pushes Microsoft's valuation beyond $4 trillion with a 27% stake worth $130 billion. Shares of Nvidia rally in pre-market trade. The tech giant is on track to become the first company to cross $5 trillion in valuation. Israel claims to have resumed enforcing the ceasefire after killing at least 100 people across Gaza. President Trump defends Israel's actions and claims nothing will jeopardize the ceasefire now. Cyclonic storm Montha weakens after making landfall in Andhra Pradesh. Death toll rises to 2. Heavy rains lash parts of Andhra Pradesh, Odisha, Bengal, Jharkhand and Madhya Pradesh. President Draupadi Murmu takes a sortie in a Rafale fighter jet from the Air Force Station in Haryana's Ambala, calls it an unforgettable experience. All right, let's start with the day's market action. The last street ended higher with Nifty closing above the 26,000 mark. Midcap index hit a one-year high. Nifty Metal surges 2%, gaining for 6 straight sessions. A day after MCX exchange went offline for more than 4 hours, the exchange confirmed that all trading activities have resumed and all operations are functioning normally today. MCX noted that the delay in operations was caused by an issue pertaining to data processing at the trading gateway. The exchange also said that corrective measures have been taken to address the issue. The US Federal Reserve's 2-day policy meeting will kickstart tonight. A CNBC survey has found that markets are expecting a 25 basis points rate cut, even as inflation remains well above the Fed's target. The respondents also expect the Fed to lower rates by 100 basis points by the end of 2026. However, top economists raised concerns about factors like lack of data on the impact of the government shutdown. Remember, the Fed cut rates by 25 basis points during the September meeting as well. President Trump has been pressurizing Fed Chair Jerome Powell to lower rates since he took office in January. Back home, stocks of AMCs and other market participants declined after SEBI proposed norms which would reduce mutual fund expense ratios and brokerage fees. The market regulators suggested lowering expense ratios by up to 0.15% for open-ended MFs and up to 0.25% for closed-end schemes. Sonal Putra has more.
SEBI has proposed a sweeping overhaul of how mutual funds charge investors, aiming to make the system more transparent, fair and performance-driven. The proposal, if implemented, could lower costs for investors but also squeeze profits for fund houses and brokers. To begin with, SEBI has proposed reducing the total expense ratio or TER charged by mutual funds. For open-ended schemes, the cut could be up to 15 basis points and for close-ended schemes, as much as 25 basis points. In simple terms, that's the portion of your investment that goes towards the fund's management and operational costs. Currently, equity-oriented schemes can charge up to 1.25%, but under the new proposal, that will be capped at 1%. For debt and hybrid funds or schemes that are not equity-oriented, the ceiling will fall from 1% to 0.8%. SEBI has also proposed removing the additional 5 basis points charge that mutual funds were allowed to levy on their entire assets under management. That extra charge was introduced in 2018 as a transitional allowance, and now SEBI feels it's time to rationalize investor costs. SEBI has also proposed that fund houses venturing into non-mutual fund businesses such as portfolio management or advisory must do so through separate business units. This ensures that costs are not cross-subsidized and that investor money in mutual fund is used strictly for that purpose. In addition, statutory levies like STT, GST and stamp duty, they will remain outside the expense ratio. This means these taxes will be shown separately, allowing investors to see the real cost of fund management versus regulatory levies. Now to one of the most interesting proposals, performance-linked expenses. Under this framework, mutual funds may be allowed to charge a higher or lower TER depending on how the scheme performs. If the fund outperforms its benchmark, the AMC could earn a slightly higher fee, but if it underperforms, the expenses charged would reduce. The idea is to align the fund manager's incentives with investor outcomes so they earn more only when you, the investor, does well. A detailed framework for this will be developed after consultations with the industry. This also marks a shift from SEBI's 2023 approach, when the regulator had proposed including all such charges within the total expenses, an approach that was met with significant pushback from the industry. While these proposals are investor-friendly, they may tighten profitability for asset management companies. According to estimates by Jefferies, a 5 basis point reduction in equity-related charges could impact AMC profits by 8 to 10% if the new rules take effect from FY27. The cut in brokerage fees could also hurt institutional brokers who might see lower revenue from mutual fund transactions. However, for investors, this could be a positive development with fewer hidden costs, lower expenses, and more transparency in how their money is managed. Comments are invited from the industry, and the deadline is 17th of November. In fact, earlier today, we spoke with Ashish Somaiya of White Oak Capital AMC and Sandeep Bagla of Trust Mutual Fund to understand the implications of the proposals if it goes through. Somaiya calls this a positive move. Meanwhile, Bagla says the impact will not be big.
Right. Thank you, Sonal, for this update. Shifting focus to the top international story we are tracking. U.S. President Donald Trump is in South Korea for the third leg of his Asia tour. He met President Lee and was awarded the country's highest honor. Trump said he has concluded a trade deal with South Korea. Speaking at the Asia-Pacific Economic Cooperation meeting, Trump also praised Prime Minister Narendra Modi as the nicest-looking guy and described him as quote-unquote killer. Trump hinted at finalizing a trade deal with India soon. However, he reiterated his claim of stopping a potential war between India and Pakistan.
President Xi of China is coming tomorrow here, and we're going to be, I hope, making a deal. I think we're going to have a deal. I think it'll be a good deal for both. And that's really a great result. You know, that's better than fighting and going through all sorts of problems and, you know, no reason for it. I think it's going to be a great deal for both. And I called Prime Minister Modi. I said, we can't make a trade deal with you. No, we must make a trade deal. I said, no, we can't. You're starting a war with Pakistan. We're not going to do it. And then I called Pakistan. I said, we're not going to do trade with you because you're fighting with India. Prime Minister Modi is the nicest looking guy. He says, oh, and he looks like you'd like to have your father, like, he's a killer. He's tough as hell. No, we will fight. I said, whoa, this is the same man that I know. But after a little while, and they're good people, and after literally 2 days, they called up and they said, we understand, and they stopped fighting. How is that? Isn't that amazing?
The U.S. Senate, where Republicans are in a majority, passed a bill to terminate President Trump's tariffs against Brazil. The legislation was passed by a 50-48 vote after 5 Republicans joined the Democrats. Legislative measures to terminate Trump's tariffs on Canada and tariffs against other countries are expected to come up for votes later this week. Democrat Senator Tim Kaine has said that people are suffering and paying more for food, clothes and health care because of Trump's tariff policy. Commerce Minister Piyush Goyal has concluded his visit to Brussels after discussions with the European Union Trade Commissioner on a free trade agreement. In a social media post, Minister Goyal said he discussed India's concerns on non-tariff measures and the new EU regulations. He also said that both sides agreed that issues related to steel, auto and other EU regulations still require further discussions. EU's technical team will visit India next week. Prime Minister Narendra Modi congratulated Sane Takaichi after she assumed charge as Japan's first female Prime Minister. In a post on social media, Prime Minister Modi said they discussed their shared vision for advancing the India-Japan strategic partnership. The two leaders also agreed that stronger bilateral ties are vital for global peace and stability. Amazon Web Services will invest $5 billion to build AI data centers in South Korea by 2031. This will be the country's largest foreign investment and will overtake the previous record set by Amazon in June, when it pledged $4 billion for another AI data center. NVIDIA is investing $1 billion to buy 2.9% stake in Nokia as part of a strategic push to bring AI to telecom networks. Nokia will also integrate NVIDIA's AI chips into its 5G and upcoming 6G network to boost automation. The chip maker will leverage Nokia's networking and data center technology for its AI infrastructure. NVIDIA's market cap is all set to cross the $5 trillion mark. The stock rose more than 3% in pre-market trade. This will make NVIDIA the first company to cross this threshold. The stock price has risen nearly 50% year to date. And speaking of NVIDIA, CEO Jensen Huang has dismissed fears of an AI bubble. He said that AI is profitable and it is going to change people's jobs while making companies more productive. He further said that NVIDIA is hiring more due to AI. He also revealed that NVIDIA has bookings worth $500 billion for its artificial intelligence processors.
I think this idea that AI is going to take jobs is going to change everyone's job. That's for sure. But I think it's going to make companies more productive. We're more productive today because of AI. We're hiring more people.
Now, ChatGPT maker OpenAI has transitioned into a traditional for-profit structure, clearing the decks to go public. The move will push Microsoft's valuation beyond $4 trillion, worth a 27% stake worth $130 billion. Rachna Dhanrajani joins us now with the details. Rachna, what are you picking up?
That's right. OpenAI and Microsoft are taking their partnership to the next level, signing a new definitive agreement that cements OpenAI's transformation into a public benefit corporation with its non-profit arm, the OpenAI Foundation, firmly in control. Now, under the recapitalized structure, Microsoft now holds a 27% stake in the OpenAI Group, PBC, valued at around $135 billion, while the foundation owns 26% and employees and investors holding the rest. This is all at the latest valuation milestone of $500 billion. Now, this partnership keeps the core alliance intact. OpenAI remains Microsoft's frontier model partner, and Microsoft retains exclusive IP and Azure API rights until the milestone of artificial general intelligence, or known as AGI. But this new phase also gives both sides more room to grow. Any AGI claims by OpenAI will now be verified by an independent expert panel, and Microsoft's IP rights are extended through 2032, even for post-AGI models, though OpenAI's consumer hardware is now off limits. Microsoft can now pursue AGI on its own as well, while OpenAI gains the freedom to collaborate more with third parties, release open-weight models, and serve non-API products on any cloud. OpenAI CFO Sarah Freer in Riyadh said that this deal with Microsoft now allows the company to continue raising capital in a much less complex manner. The companies have also rebalanced their commercial terms. OpenAI will buy an additional $250 billion in Azure services, but Microsoft no longer has the first right of refusal to be its cloud provider. Both the firms say that the agreement builds on 6 years of partnership and sets the stage for long-term collaboration, combining OpenAI's innovation with Microsoft's scale as the race towards safe and responsible AGI enters its next chapter globally.
Right. Thank you, Rachna, for that comprehensive update. Shifting focus to the other big story that we are tracking, the demerger of Vedanta will be delayed as the NCLT bench hearing the case has now been reconstituted. This newly bench will now hear Vedanta's plea and the government's objections to the demerger scheme of arrangement all over again. The NCLT will begin hearing the case once again on the 12th of November. This comes as SEBI clarified that it was not happy with Vedanta's modification of the scheme of merger after approval. All right, in global earnings now, Swiss banking giant UBS has reported strong numbers in the third quarter. This was largely driven by solid banking performance and release of legal provisions. Net profit during the quarter came in at $2.5 billion, marking a 74% growth on an annual basis. The bank posted steady revenue, which came in slightly above street expectations. Coal India posted a mixed performance in the second quarter. Net profit fell short of estimates despite rising 32% year-on-year. The company's operational performance was weak, with margins missing below estimates and EBITDA falling 22%. However, revenue surpassed expectations despite falling 3.2%. Ola appealed in the Karnataka High Court to quash the FIR, alleging that the company abetted the suicide of an employee. The matter has been adjourned to the 17th of November. Ola argued that a case of unnatural death has been registered, so it's not homicide. The company also told the court it has remitted all the dues to the deceased. The court directed the police to continue the investigation as a suicide note was found. Telecom Minister Scindia has said that the government will evaluate implications of Supreme Court's order on Vodafone Idea's AGR dues before considering any relief for the telco. Speaking off camera to CNBC-TV18, Scindia said that the government has yet to comply to the Supreme Court's written order. He added that the centre will wait for Vodafone Idea to apply for seeking relief. This comes after the Supreme Court allowed the centre to reconsider the cash-strapped company's AGR dues worth 93,000 crore rupees. All right, on that note, it's time for a short break. Coming up next, Hindustan Aeronautics has signed an MOU with Russia's UAC to manufacture the SJ-100 passenger jet in India. The Russian firm had been sanctioned by the United States in 2022. More details when we return. Welcome back. You're watching Business 360. Air India CEO Campbell Wilson, in his first public event since the Ahmedabad plane crash, said that the interim report had indicated that there was nothing wrong with aircraft engines or practices that required changing. He said that crash, which claimed the lives of 241 people on board, was devastating for the company and was a cause for reviewing practices at the airline. Hindustan Aeronautics has signed an MOU with Russia's UAC to produce the SJ-100 passenger jet in India. The Russian aerospace firm has been sanctioned by the United States. It was sanctioned by the US in 2022. The arrangement gives HAL the rights to manufacture the aircraft for domestic customers. Madiha Mujawar is here with more on this aircraft. Madiha.
Well, the SJ-100, originally marketed as the Sukhoi Superjet 100, is a twin-engine, single-aisle regional jet, smaller than the narrow-body Airbus and Boeing planes that we typically fly in. This seats about 87 to 98 passengers, and in denser layouts can carry up to 100 passengers as well. It first flew in May 2008 and entered commercial service in the early 2010s. Now, SJ-100 never became a global bestseller. Estimates vary, but roughly 125 aircraft have been in service as of today, with total production reported at a little over 200 planes. That's it. Today, the most active operators are only Russian carriers. According to available fleet data, Rossiya is the largest operator with 61 planes in service and 14 grounded. Red Wings flies 19 SJ-100s. Azimuth has 18. Yamal Airlines around 10. IR Aero 6. Gazprom Avia 5. And Yakutia has 2 SJ-100s. Several of these planes bought by these airlines are also grounded for different reasons. The small fleet size and concentration with Russian operators limits resale and leasing appeal. That's the commercial reality. The program's reputation was then dented by high-profile accidents. The SJ-100 has been involved in 3 fatal accidents, killing 89 people. Most notable was the 2012 Mount Salak crash, which was a demonstration flight in which all 37 passengers and 8 crew members on board were killed. There are also long-standing operator complaints about spares and maintenance support. Those issues reduced overseas sales and left the type, the SJ-100, with a limited international footprint. Now, the MOU with Russia's UAC aims to give India the option to produce a ready regional jet for a large domestic short-haul market. For example, routes under the Udan regional scheme. The argument in favor is simple: quicker access to an off-the-shelf regional aircraft, potential jobs, technology transfer, and new MRO capacity. Now, HAL's experience with licensed production of Russian military types also strengthens the industrial case here for HAL. But on the flip side, the SJ-100's small global fleet, past reliability and after-sales issues, and the post-2022 Russification of components raise questions about certification, parts supply, and export markets. Now, pre-2021, the Superjet was built with many Western components, including the engine. But after Russia's invasion of Ukraine, those Western companies terminated the contract. Russian industry announced an accelerated import substitution program to replace Western systems. March 17, 2025 was the maiden flight of an SJ-100 fitted with the new Russian engines. So to conclude, we don't know if HAL has any confirmed orders yet from any airlines to buy this jet. Which SJ-100 variant will HAL build, and the original with Western components or the one with a Russian engine, and how HAL plans global certification given the company, the UAC, under Western sanctions. So that's the big question.
All right, thank you, Madiha, for that comprehensive update. Shifting focus now, Israel has claimed to have resumed enforcing the 3-week-old ceasefire after killing at least 100 people across Gaza. The strikes followed accusations from Israel's military that Hamas attacked its forces in the area. President Donald Trump defended Israel's actions, stating that nothing will jeopardize the ceasefire now. Russia has said that Ukraine launched drones at Moscow for the 3rd consecutive night, forcing airport closures. Russia's defense ministry said that forces shot down 124 Ukrainian drones in a 24-hour period. This as Russia launched 400 attacks in southern Ukraine, killing 1 person. Ukrainian President Zelensky said Ukrainian and European officials will meet at the end of the week to discuss the details of a ceasefire plan. Hurricane Melissa has made landfall in Cuba as a Category 3 hurricane after leaving a trail of destruction in Jamaica. Hundreds of thousands of people had been evacuated to shelter in Cuba. The storm has weakened after hitting Jamaica as a Category 5 hurricane. Jamaica's Prime Minister has warned of devastating impact as officials assess the damage. The hurricane will move northeast towards the Bahamas and Bermuda after hitting Cuba. From one storm to another, Cyclone Monta has wreaked havoc in Andhra Pradesh after making landfall last night. A woman was killed after a tree fell on her house. Thousands have been displaced as flooded roads and uprooted trees brought life to a standstill across southern Andhra and parts of Odisha. The India Met Department said the cyclone is expected to weaken into a deep depression over the next few hours, but the remnants could still affect North Telangana and South Bastar. And before we wrap, President Draupadi Murmu took to the skies for a 30-minute sortie in a Rafale fighter jet. She now becomes the first Indian president to undertake sorties in 2 Indian Air Force aircraft. President Murmu was flown by Group Captain Amit Gehani from the Ambala Air Base in Haryana. She called the experience unforgettable and a moment of pride for India's defense capabilities. We leave you with these visuals. Thank you for watching.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, those of you who follow equity markets here in India and around the world would know that the AI theme has been dominating investor psyche around the world, particularly in the United States. Stocks that are relating to AI or deep tech, analytics, they've been really going through the roof. We all know the story of NVIDIA becoming the most valuable company in the world. Now, the issue here is that in India, while we have a large number of traditional IT services companies, do we have enough options when it comes to cutting-edge technology? If yes, and what are these options? How should we look at them as investors? And how should we ensure that our portfolio is in sync with the time when technology is the name of the game? Well, that is exactly what we're going to discuss on the show today. Investing in the innovation theme here in India. Well, helping us demystify some of these aspects are Shreyas Devalkar, Head of Equity at Axis Mutual Fund, and Ashish Nayak, who is a fund manager and actually manages Axis Mutual Fund's Innovation Fund. Gentlemen, good morning. Great to have you with us. Thank you so much for joining in. And I want to start with that opening question, actually. Shreyas, with you first. This last 1 year has been a year of patience for the investor. He's quietly sat and looked at the screen with very range-bound returns in the Indian market while watching the NASDAQ gallop away, the US market gallop away. So what are the lessons from this 1 year, and what are some of the investor behavior trends that you picked up?
Sure. So yeah, it was 2025 actually it witnessed a mix of euphoria and consolidation in the equity market. So typical of market consolidation phase it is. You'll notice that in large cap, actually it gets unnoticed. One part is the large cap, it gave you a 12% return YTD versus mid cap 4% and small cap was down 2% YTD. I'm talking about the frontline benchmark indices. A key dampener was actually the reciprocal tariff by US on India. And after that steep tariff, there was also increase in the tariff. Apart from that, though the investor sentiment actually got boosted because of the GST rationalization. And there was a festive season, the current festive season. It has been so far record-breaking for many industries, not all, while it has signaled a strong consumer demand. So this has been really good news. As far as corporate earnings cycle is concerned, I think that earning downgrade cycle has now bottomed out. So though the earnings are subdued relatively in this quarter so far, but the downgrade cycle which started almost 1.5 years ago, I think that is broadly getting bottomed out. So India, because of this underperformance YTD actually, and we have seen, and as you highlighted the AI theme globally, India has actually underperformed by 20 to 25% compared to Asian market, as well as obviously the US market. And hence the relative valuation of India has emerged now relatively better. So in response to this market volatility, what investors have done, actually, investors, especially when you analyze the flows of the investors have diversified into multi-asset allocation funds like gold, as well as silver and multi-asset allocation fund. Industry has launched multiple products, factor-based products, quant model, narrow thematic products, fund-of-fund structures in both active and passive space. So the exposure to equity-oriented mutual fund might have got slightly trimmed, but it got into the other schemes, which I talked about, and the overall exposure remains good. And that's where, despite the trimming of the exposure to the equity-oriented funds, the passive fund gained, this multi-asset allocation funds gained, and overall SIP of the system remains intact. And that indicates a sustained confidence as well as disciplined investing by investors.
Okay. Ashish, what about you? How has this year been for you as a fund manager, and what are the interesting trends, nuggets, investing patterns? What did you pick up? What's the highlight of 2025 for you?
Sure, thank you so much. So yes, I mean, from investing in this year, one has really seen how euphoria, as Shreyash mentioned, was there at the start of, let's say, earlier year, and over the years, things had actually subdued in the Indian markets, where investments were actually going lower from the public investment side, and the other side, expectations were much higher. From there on, with the global situation on the tariff side being worse off, also meant that there was some more pressure from that end. Over time, what we saw is that there was resilience in the consumer demand, especially which was visible post the GST rationalization and the festive demand, which has again kind of picked up sentiments across various sectors. Even when we look at some of the specific areas such as multi-asset fund, which incidentally I also manage Nexus, there was obviously a lot of interest. The returns in the gold and silver were quite surprisingly positive, and that really helped the fund. On the innovation side, if I have to look at also, there were many companies that have started to get listed in the Indian space, not just this year, but over the last 2-3 years. But how they have evolved and sort of matured is an interesting phenomenon that we have seen in this year, especially.
And we'll talk about this. We'll talk about some of these businesses which are looking interesting, which are adopting innovation in various ways, and how to analyze a lot of this. But, you know, Shreyas, I want to start with an even more fundamental question, right? As investors, there's a tendency to chase returns. Everybody has this major FOMO when you see a market running away and you realize, oh, I don't have those kind of stocks. So now, first of all, let's talk technology in a broad sense, technology or cutting-edge innovation. One way of playing that would be straight away to buy the NASDAQ, right? I mean, you have ETFs here in India. You can just go invest in the US market, in those US stocks. Is that the approach? Should we be looking at Indian technology and innovation bets at all? Or is it too late now in the game? I mean, where are we in the cycle? Because globally, there's a debate playing out, whether there's already an AI bubble which is about to burst.
Sure. So always when it comes to such themes that the bubble, etc., that when it comes to valuation, definitely a lot of froth may be there in most of the spaces. However, this space is here to stay, that one should recognize. And its applications will evolve. First, now we are in the phase of actually developing the deep tech and the large language models. There is a investment which is going to happen in the infrastructure, including data center. So we are in that investment space. And I think a lot of material you already must have seen and read regarding how the amount is humongous. And compared to that, if you want to generate a return on capital employed, and especially when these investments are going to be depreciating, right? So unlike any other plant and machinery, it doesn't depreciate so fast. While here, whatever investments are there, they are going to depreciate a lot. And accordingly, if you want to generate a return, it will be a challenge. However, there are companies who are funding this out of their existing cash flows. Most importantly, what they are trying to do is they're using their current cash flows so that in future, their ability to generate revenue as well as ability to sustain improves, and that's where the entire focus of the market will be. So initially there may be euphoria in some of these spaces, but there may be more focused approach which will emerge once this valuation bubble dies down in particular areas like chips, as well as the developer of AI, and obviously the backward investment into the data center. So this entire revolution, in my opinion, will have a role to play in investors' portfolio. But having said that, as of now, yes, there is sort of high valuations as of today.
Okay, and that's why we have to be extra cautious. So with that caveat being placed on the table very, very carefully, let's now go step by step. Now, Ashish, the first issue with finding some of these ideas in India is that you don't have a direct one-on-one play. I mean, you don't have a company that's making these big GPUs, graphic processing units, or these big, supercomputing chips. So there's no direct play. But then there are indirect plays. There could be vendors that in some way are part of the NVIDIA ecosystem. So where do you start looking when you're talking cutting-edge technology, deep tech, AI, etc.?
So completely agree with you. Yes, I mean, India does not have a global deep tech or AI investment plays or the wave that we have seen in some of the other countries like US and China, where we have seen hundreds of billions being poured into these foundational AI models and various deep tech platforms. In India, what we have seen, or Indian companies have actually lagged on the R&D side. There has been, in terms of the tech, there is a services-led mindset and also some level of risk averseness in terms of the funding ecosystem. So for instance, if you look at, let's say, 2023, India just got about $1.1 billion in AI funding in terms of the entrepreneurs. That is also to do with the fact that we do not have that many highly profitable internet companies, as Shreyash mentioned, who are able to pump in capital into these kind of innovations. But that does not mean that there is no promise. We also have a great digital infrastructure in India, the India Stack. We also have a vast talent pool as well as a growing ecosystem of startups. So at the end of the day, what it will come down is, with the help of the government's AI mission, which is about $1.2 billion being spent over the next 5 years, we should start seeing more and more industry partnerships happening, especially starting with the unlisted space, where the foundation is being laid for the probably a GPT movement or a DeepSeek movement for India. We are seeing sectors like, as you mentioned, data centers. There are companies in EdTech as well as FinTech who are adopting to AI quite strongly in terms of applications. What we should watch out for probably in terms of emerging plays are maybe AI infrastructure plays, localized models, as well as sector-specific applications. So it will be a play that will happen over a period of time, which will depend on policy support, maybe some level of private capital appetite for deep tech, and some level of cultural shift in terms of long-term innovation. So it's a mix of all. It's yet to happen.
No, absolutely. But it gives us a starting point. And like you outlined, some subsectors of innovation and, deep tech. So let's do one thing. Let's, talk about the valuation debate for each of these subsegments. Like you said, there could be data centers, there could be EV, there could be several other facets of it. FinTech, there is obviously the internet companies, there is, food tech, food delivery and quick commerce, so on and so forth. So, Shreyas, let me open with you and maybe Ashish chip in on this. As stock pickers, when you look at these individual buckets, which are either internet-related businesses or beyond internet businesses, where do you see excess euphoria, where you would be cautious, and where do you see some value, some visibility of growth, and at least reasonable valuation or not over-the-top valuation? So if you could go segment by segment. Shreyas?
Sure. So when it comes to a space like innovation and investment into this, it's very difficult to find out, so to say, growth at reasonable price. It's probably growth is there everywhere. As far as valuations are concerned, you have to make a judgment based on multiple factors. So just to give you an example, in some of these spaces, especially the application space, more so. So you take a consumer tech company, which is applying tech to develop a consumer tech model. Now, in most of these spaces, what is happening is these companies are initially not making money. What we tend to observe is these spaces where there is loss-making phenomena is there. During that phase, these companies are mostly in the unlisted space. While in the listed space, what is happening is the companies are using their cash flow or potential cash flow from the existing businesses and they are reinvesting into the new. So when it comes to the valuation, we have to be very careful on the path to profitability. So in most of these cases, what we look forward is the path to profitability, and that path to profitability depends on what? It depends on, one, the intention of consumer to pay, because initially, as you're observing, that consumers are not paying for most of these things. So the intention of consumer to pay, one. And secondly, once that path starts for few companies in the vast sector, and like here we can use the example of quick commerce industry, even in the ride-hailing industries, and that also we have seen that when few companies start going to that path, the others who tend to fall out, and then there emerges a structure of duopoly or so. So this is what the end game we need to watch out for. Now, whether that end game is near term, 2-3 years, in that case, the argument of yes, there is a reasonable value that comes in at 4, while in other cases, the valuation look really high.
Okay, all right. So, well, determining whether something is overvalued or adequately valued, that will always be a tough call. But we'll keep discussing this as we go forward. We'll ask Ashish, which are some of the themes, these innovation themes that he likes the most? And then the big question for us investors. Do you play this through regular diversified mutual funds, or is the theme ripe enough and interesting enough to actually play via a dedicated thematic sectoral fund? We'll discuss this on the other side.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week we are discussing the innovation theme and whether we as investors need to look at it far more closely, whether we need to have a more dedicated approach towards investing in companies that are leading innovation here in India. And as you've just heard the experts tell us, innovation can have several definitions. It's not limited to AI or to internet commerce alone. So on that front, Ashish, let's get your thoughts, because you track the whole gamut of all these companies. Which sub-segments of innovation are you most bullish on?
So as you rightly said, it's not just a theme about new age companies. It is cutting across so many futuristic fields which are at the cutting edge, including AI, fintech, EV, digital platforms, clean energy, and advanced manufacturing. So when we look at our Axis Innovation Funds, it also has exposure not just to the Indian companies, but also to global companies, where we invest across the chain, starting from core tech disruptors. So for instance, if we take a pharma company in let's say, the developed markets like US, who is working along with Indian pioneers such as the CDMO players in India, you're playing across the supply chain. And that's how you really make the most out of the innovation theme. Where we do not have access to some of the companies in the Indian market, you can take that in the global side. Having said that, this is not just about the innovators or the new age companies. We also look at the enablers of innovation. So what we mean by that is companies who are, for instance, into semiconductors, battery technology, chemicals, R&D plays, for instance. All of these are enablers for, say, innovation in electric vehicles or, for that matter, electronics. Similarly, one can play with aerospace or defense component suppliers at the high end of technology. And also, if we want to play the green economy-led innovations, we can look at companies in the recycling space or even solar component manufacturers. On the other side, we can also look at companies who are adapting to innovations. So one of the examples that comes to mind is the Indian financial services space, where there are companies who are leveraging the digital infrastructure in the form of the India Stack as well as UPI, and they are able to transform their businesses. So all of these kind of include the gamut of innovation theme.
Okay, so those are all the examples of the innovation theme out there. But then really the question, gentlemen, that as an investor, I mean, I'm okay to take moderate risk, but I don't want to get too caught up. And like you said, many of these companies may not even be profit-making at the time that they start their listed market journey. So Shreyas, if, not a conservative, but say a medium risk investor wants to have a portfolio which is future ready, then what should he or she do? I mean, how do you add this piece of innovation to the portfolio?
So definitely the thematic fund, like innovation fund, definitely add a value to it. If you look at even Axis Innovation Fund, we have exposure to even foreign equity into it. So some part of the exposure actually is given to these new age technology businesses. Broadly, when it comes to the exposure to this space, what we believe is the investors should have exposure, but in a limited manner, and to the entire thematic space. It is not only about innovation. So that thematic includes multiple narrow themes. And in that context, in my opinion, innovation is definitely a broad-based theme wherein we touch upon right from consumption-oriented investment companies to EVs, to some other companies which are into the capital goods space, and obviously the foreign activity space. So you get a great diversified exposure in this kind of thing. So one should have exposure to this, but in my opinion, in a limited, to the limited extent in the thematics.
Okay. Ashish, what would you say? I mean, what should the right mix be? And also talk to us about the right amount of allocation, because you don't want to have too much risk in the portfolio as well. So would you argue, I mean, you manage the innovation fund, of course, so would you argue playing it through the thematic route, and if yes, then you should be capping it at what level?
So absolutely. So the way Shreyash mentioned, I completely agree that overall thematic basket of the equity portfolio should not exceed about higher double digits, maybe 15% of the portfolio, given that that is the prudent amount which one can have into some of these sectors. While innovation can give us exposure to high growth disruptive sectors, and while maintaining diversification and also managing volatility, what is also important is the time period that we have when we are holding these investments in the portfolio. There should be a time investment horizon of at least 5 years. The reason I say that, and as you rightly mentioned, some of these businesses are still evolving. They're still not yet profitable and not yet generating sustainable cash flows and profitability. So to that extent, there might be entry points which might require, let's say, higher valuation entry points, and then over a period of time that gets factored into the stock. So to that extent, to scale these longer gestation periods, one needs to have a slightly longer period of time horizon so that one can ride the valuation cycles and capture the full potential of this compounding growth.
Okay, fair enough. And it's important to keep those risks in mind as well. And on that, Shreyas, to sum it up, I mean, if you talk about the riskometer, right? So if we were to map the innovation theme vis-a-vis other thematic areas like consumption or let's say defense or manufacturing, then does it carry higher risk because it's a very futuristic theme? And if yes, finally, what are the checks and balances, and what are the final tips that you'd like to leave our viewers with, investors with, for investing in innovation?
Definitely at current juncture, since globally innovation-oriented stocks has gone up and the valuations are high. So standing today, definitely the valuation risk is one of the at the higher end when compared to the other themes as such. The good part is, as I highlighted, that unlike a consumption or manufacturing or any other narrow thematic like defense, etc., this theme has investment across the multiple segments of economy, right? From consumption to, so it is well diversified compared to other thematics or narrow thematic schemes which are available in the market. However, because there is an element of innovation and there is an element of valuation re-rating which has happened over the last 6 months to 1 year, because of which we definitely carry a valuation risk. And that's where Ashish explained that the time horizon for such investment in such thing should be up to 5 years.
Okay, all right. That explains the concept quite well, the risks and the potential rewards as well, if one looks at investing in the innovation theme here in India. Gentlemen, thank you so much. This was a very helpful conversation. Good to have perspective on this subject. Well, with that, we're out of time on this edition of Let's Talk Money. Thank you very much for joining in. Keep sending us your feedback, your comments and queries. We'll see you again next week.
Let's Talk Money.
Hello and welcome to News Center. I'm Parikshit Luthra. US President Donald Trump says he's doing a trade deal with India and praised Prime Minister Modi. Trump is in South Korea for the final leg of his Asia tour, which began in Malaysia, followed by Japan and South Korea. Trump said a trade deal with South Korea has been finalized and was also optimistic about a deal with China ahead of his scheduled meeting with President Xi Jinping tomorrow. While he sounded hopeful about a trade deal with India, Trump reiterated his disputed claim of personally averting a nuclear war between India and Pakistan. Trump claimed he stopped the conflict by using bilateral trade and told Prime Minister Modi, and I quote, "We can't make a trade deal with you. You're starting a war with Pakistan. End of quote. Before we discuss the prospects of an India-US trade deal, here's what President Trump had to say in South Korea.
And I called Prime Minister Modi. I said, we can't make a trade deal with you. No, we must make a trade deal. I said, no, we can't. You're starting a war with Pakistan. We're not going to do it. And then I called Pakistan. I said, we're not going to do trade with you because you're fighting with India. Prime Minister Modi is the nicest looking guy. He says, oh, and he looks like you'd like to have your father, like, he's a killer. He's tough as hell. No, we will fight. I said, whoa, this is the same man that I know. But after a little while, and they're good people, and after literally 2 days, they called up and they said, we understand, and they stopped fighting. How is that? Isn't that amazing?
All right. It is important to also point out that India and European Union are negotiating a trade deal. In fact, Commerce Minister Piyush Goyal has just held talks with his counterpart, Maros Sefcovic, in Europe. And he has said that both sides have made substantial progress on outstanding issues as far as the negotiations with EU go. So it seems that both with the United States and EU, we are in advanced stages of negotiation. Joining us right now is former diplomat Gurjeet Singh and former ambassador to the WTO, Jayant Dasgupta. Shashank, former foreign secretary and former Indian ambassador to Denmark, South Korea and Libya, is also with us. Thank you very much for being with us, gentlemen. Ambassador Gurjeet, if I can begin with you. Let's start with the US. Donald Trump saying that I'm going to have a trade deal with India soon. From several quarters, we've been hearing that a deal now is in the final stages. It needs the blessings of Donald Trump and Prime Minister Narendra Modi. What do you think will be the right moment when this can happen? And what will be the victory that both sides would be looking at?
So if President Trump is once again saying that a trade deal with India is imminent, he's perhaps having a conditioned reflex, because in the last 3 days, he has signed so many trade deals, most one-sided ones, with countries of the region, that he's probably got used to rolling over people and saying, this is my trade deal. And people seem happy to sign it, even though this disadvantageous to them. Now, where India is concerned, it is my understanding that before President Trump went ballistic on India with regard to Russian oil and Pakistan, a trade deal was perhaps close to conclusion. And then it fell apart because additional requirements were projected, sanctions were placed because we were buying Russian oil. And this was not all part of the original discussion on the trade deal. Therefore, the trade deal now is much more complicated due to President Trump's various enunciations on Operation Sindoor, how he managed India and Pakistan, and on India should not do this with Russia, and cozying up to Pakistan, and now cozying up to China, all of which is geopolitically unhappy space for us. So from a sweet spot of early in the Trump administration to a bitter spot is where we find ourselves. So therefore, I think unless a trade deal is fully negotiated and ready to be signed, I don't think it is done.
Right, that's an important point. Let me get in Ambassador Dasgupta at this point. Ambassador Dasgupta, and as Ambassador Gurjeet was pointing out, Donald Trump has got the one-sided deals with Thailand, with Cambodia, with other nations, just the way he wanted to. With India, that is going to be difficult because India wants a competitive edge with the average tariff compared to a Bangladesh, a Sri Lanka, a Cambodia, a Thailand, or an Indonesia for that matter. Do you think what has happened over the last few days, there is momentum for a trade deal, or is it going to be difficult for exactly this reason?
I think I have read something in the papers quoting President Trump saying that we will have something like 15% or thereabouts for India. So that is something which India would be looking for as a prerequisite for signing any deal. That this 50% of that, 25% is for buying Russian oil. That has to be rolled back for sure. There is no compromise on that. And the balance 25%, which was imposed with effect from the 7th of August, reciprocal tariff, that has to be reduced substantially. So I think India can accept perhaps 15% or so, because most countries have 15% at least or more. And Vietnam and Indonesia, Cambodia, all the others, they are all in the region of 19-20%. So I think balance would be restored if that happens. But having said that, there are two other issues. One is about this agricultural products. If the Trump administration makes a big deal out of that, about trying to push in GM soya and corn and the other GM products, that I think will be a no-go. So that will probably spook the whole deal. Of course, from the statements emanating from both the Commerce Secretary, who was in Washington about a week ago, and from the Minister, Commerce Minister, it appears that they are close to concluding the talks. But then one also gets to hear what Minister Jaishankar had to say at the ASEAN meeting. And he said that, it is time for the world to stop having double standards and a difference between what they preach and what they practice. And obviously the target was both the US as well as the EU, which are sanctioning countries or entities which trade with Russia for oil and gas. But while they continue to buy Russian oil and gas, in the case of the EU, and uranium for energy purposes for the US.
All right, let me get Ambassador Shashank, who's joining us right now, former Foreign Secretary. Ambassador Shashank, thank you for being with us. My question to you would be, there seems to be still no understanding of India's sensitivities around the recent India-Pakistan conflict. Donald Trump has, even today, while speaking to business leaders in South Korea, he's gone on to say that he stopped the war. He spoke to both the leaders, both the Indian and Pakistan prime ministers wanted to continue fighting, but he told them that I won't do trade if you don't stop fighting. And then they stopped. But he also praised Prime Minister Modi. He said that I really like Prime Minister Modi. He's a really nice guy. He's a hell of a tough guy. He's the kind of guy you want to have as your father. Is that a olive branch? Or do you feel those repeated references to the India-Pakistan conflict make it difficult, politically difficult for the Prime Minister to agree to a trade deal?
Firstly, I would say that it's the uncertainty about the tariff issue which affects the bilateral trade much more than the actual tariff which has been imposed, because even if they want to have 50% or 15%, the commodities which can still be sold in the American market perhaps will go. The others will find alternative markets over a period of time. There will be pain, naturally, for the exporters and for the manufacturers. But the point is that the way the tariffs have been introduced from time to time, and still there remains that uncertainty, that brings the whole issue of the exporters and importers not being able to plan their trading relationship. So I think that is something which is very important for President Trump. As a businessman, he should understand that the market should be kept stable. The number two is that as regards the India-Pakistan end of conflict, I think India has very clearly said that Operation Sindoor is still on. So whether that particular phase of fighting ended and who all were responsible, maybe President Trump says that he was able to convey some views to Pakistan not to use the nuclear weapons, because Pakistan has been repeatedly saying earlier and even now also that they would use the nuclear weapon because they feel that Pakistan's existence is under threat. Now, Pakistan's existence is under threat because of their own domestic issues and their problems with all their neighbors. So they should not try to put it on India and convey to President Trump and hand him over the mines and the oils and all kinds of things in order to ensure that President Trump's family gets involved into these political affairs, which have been very complicated in this region.
Okay. Important points. Let me get in Ambassador Gurjeet as well. Ambassador Gurjeet, does India have a choice here? Can we live without a trade deal? Because now there is ample commentary from the World Bank, from the IMF, that if India does not get a positive trade deal, and if these tariffs at 50% continue, this is going to impact India's GDP growth. For next year, they've downgraded India's GDP growth by about 0.2 or 0.3%. Going forward, if we don't have a deal and we continue with the tariffs, will this continue impacting India's GDP growth on a year-on-year basis?
Indeed, a very important question. And this is why we can't do the kind of deal several ASEAN countries have done, who have simply opened their markets to American products at 0%. So India can't do that. That is one essential difference between India and the others. Similarly, unlike South Korea or Japan or even the EU, India cannot promise hundreds of billions of dollars of investment into the United States to offset low tariffs. So India is a unique case by itself. Now you ask me, can we survive? I think if you can reduce the sanctioned 25% for buying Russian oil, then you are in a negotiating stage of bringing it down from 25% to about 15-16%, which is what is reported in the press. But as Ambassador Shashank correctly says, it is the uncertainty. But uncertainty not only of the Trump administration, it is the uncertainty of Indian exports competitiveness, which is severely lacking. Now, in Trump 1.0, they remove all the GSP benefits, impacting all our traditional exports like leather, textiles, gems and jewelry, and things like that. It was about a $5.6 billion hit to our exports. We did not squeak much. We absorbed that hit. Even today, I know that Indian companies exporting to the US have adjusted the increased tariffs either into their price or by raising consumer prices. And they seem to be finding a way out. I think this requires a very great analysis of whether India's critical engagements on semiconductors, electronics, on solar, on energy, on defense products, on buying aircraft and pharmaceutical exports, among others, can they be somehow saved from this excessive punitive tariffs, where textiles...
Okay, I'm going to come to that. Ambassador Dasgupta, what we hear that India is trying to work on one comprehensive landing zone which tackles both the 25% additional penalty because of purchase of Russian oil and also the 25% reciprocal tariff. The hope is that the landing zone will be in the average tariff rate of 10 to 15%. Do you think we can give some concessions on agriculture? There have been a lot of reports about how the US is seeking access for US corn, soybean, corn for India's ethanol industry. Could some concessions be made? Could some small contracts be given? Can we give concessions in niche areas? Or do you feel that it will be politically very difficult to do so in an election environment?
I think it would be very difficult, my personal opinion, that agriculture, after having taken a tough stand, announced it several times that there would be no compromise, and the Prime Minister himself has mentioned it, that we will not bargain away the interests of the farmers and the fishermen, etc. So I think it would be just not possible, apart from the economic impact it may have on our farmers. So I think on these two issues, GM, soya and corn, I don't perceive any compromise. And of course, India has, on the other hand, held out an olive branch in the form of increased, I think, oil and gas imports from the US. So it should more than compensate for the perceived, lack of market access that the US may think is suffering from in terms of soya and pork and a few other things.
Okay.
So that is there.
Okay, I'll put the final question to Ambassador Shashank because I'm running out of time. Ambassador Shashank, do you feel that the Russian sanctions will in a way help India? Because India was not ready to compromise on the strategic partnership with Russia. We were getting discounts, very compelling discounts by Russian refiners through third-party intermediaries and also directly. Now that these sanctions have been imposed, it'll be difficult to do business with Russia on oil post the 21st of November. Do you think the biggest irritant in talks is now off the table?
Well, Indian companies have taken their own decision that they would like to abide by the sanctions which have been imposed on the Russian oil. So that be it. I think India will go for the most economical sources for the oil because we import almost 85% of our oil requirement. And therefore, it would be unfair for the United States or for any other country to say that India should buy only more expensive oil and not the oil which is available at the most economical rates in the market. And I think this is affecting the Indian growth story. It's also affecting the credibility of the United States as a long-term partner with India. So I think really we have to negotiate with the United States. And we find several times that even their ministers and officials are helpless because they say that, okay, go and talk to the president. No, I don't think that's the way to deal in these international relations, that today it is Russia, then some Lindsey Graham goes into the Senate or somewhere and says, no, now it's BRICS, and we have to hit any country which is a member of BRICS. So I think the whole thing is very uncertain, and I think the United States is not performing its role as a responsible superpower. I think they need to change their attitude.
Absolutely. And there are reasons, of course, which make it difficult for India to accept the kind of terms being offered to other economies around the world by the United States. We've run out of time, but thank you very much to Ambassador Gurjeet Singh, Ambassador Shashank and Ambassador Dasgupta for being with us here on News Center. We're taking a short break, but lots more coming up on CNBC-TV18 when we return. Welcome back to News Centre. With less than 4 months to go for the union budget, the industry has pushed for easier tax compliance and relief for the middle class. Shivani Bazaz joins us now with more details. Shivani, take us through the industry's wish list.
Well, yes, the Revenue Secretary has now begun meeting industry bodies as part of the pre-budget consultations, and the message coming from India Inc. is consistent. Reduce litigation, simplify compliance and improve ease of doing business. Starting with FICCI's wish list, industry wants the government to clear pending tax disputes faster. Over 5.4 lakh direct tax cases are stuck, locking up large sums of money. Businesses want high-value disputes settled first and income tax refunds processed faster to ease cash flow pressures. Now, they're also asking for relief from the rule that requires 20% upfront payment to get a stay on the tax demand, suggesting bank guarantees instead. Another key demand from the industry is simplifying TDS, fewer rates, fewer categories, and no TDS in cases where a valid GST invoice already exists. And finally, companies want faster approvals for mergers and demergers, stability in transfer pricing rules, and a single uniform online customs notice system across ports. Meanwhile, PhD Chamber of Commerce met the Revenue Secretary today and has focused on boosting investment and manufacturing. It wants the government to reintroduce the 15% concessional corporate tax rate for new manufacturing units under Section 115 BAB, saying companies missed the benefit during the pandemic years. They're also calling for weighted tax deduction on R&D spends to push innovation and middle-class tax relief, suggesting 20% tax up to 30 lakh rupees and 25% on up to 50 lakh rupees. Now, the chamber has additionally flagged delays in faceless appeals and wants a statutory time limit for disposals, along with modification of MSME payment rule, which they say is currently adding compliance burden for MSMEs. Back to you.
All right, let's move on. Amazon's layoffs have begun to impact employees in India who are being informed via meetings. Shilpa Rani Peta has more. Shilpa, which verticals are likely to be impacted the most?
Well, you know, Parikshit, it's been a day of uncertainty and panic across Amazon India's offices as the company's latest global round of layoffs has hit the India operations too. What we're given to understand is that employees across multiple divisions and cities have been called into one-on-one meetings to be informed that they have been laid off. And some of them at their offices are also being told to leave within a few hours of being informed. Now, basis some of the employees that I spoke to, it seems like Prime Video and the devices teams have been most impacted with the most number of layoffs happening there, but layoffs are also happening across the finance and global businesses services team, the HR team, and also the CMT, which is also called the competitor monitoring team. And most of the job cuts seem to be from Bengaluru, while there are also some happening in Chennai and Hyderabad as well. Now, some of the employees have told us that the standard exit package that's being offered to employees includes 2 months of garden leave where they can look for another job, 2 months of severance pay, and also 1 month of notice pay. And there are also additional payouts based on the tenure and the leave balance, along with other transition support announced by the company yesterday, including also the opportunity to look for some roles internally as well. Now, remember, these layoffs are a part of Amazon's global plan to cut about 14,000 roles as it reorganizes to become more agile and double down on artificial intelligence. Yesterday, Beth Galetti, Amazon's Senior VP for People and Experience and Technology, called AI the most transformative technology since the internet. And CEO Andy Jassy also earlier this year had alluded to the fact that Amazon is now investing heavily in generative AI. Now, while the layoffs are happening across levels, most impacted seem to be the junior level employees and many at the mid-managerial levels, which are usually, these are like in Amazon terms called L3, L4, L5, L6. And we did reach out to Amazon India to get a sense of the overall number of employees that are being impacted, but we were directed to the global statement and being told that India not having anything additional to add on the same. Back to you.
All right. Thank you very much, Shilpa Rani Peta, for joining us and telling us how Amazon's latest round of layoffs in a bid to push AI infrastructure is going to impact their workforce in India. Let's move on to another big story. India's sugar sector wants lesser market barriers in Western countries to increase exports. Madhav Sriram, the Executive Committee member of Indian Sugar and Bioenergy Manufacturers Association, tells my colleague Abhimanyu Sharma that large sugar consumers like the US and European Union have quantitative quotas on sugar, which is a major non-tariff barrier for Indian companies.
What do we do with the other countries and the FTAs there? So sugar is discussed in a separate bracket because it is a very sensitive product, and European countries and the US, who are large consumers of sugar, actually have quantitative quotas, and they don't allow us to sell more sugar into their countries. So we are at a disadvantage, and the association is taking it up with the government of India how we can find better markets for our sugar in these restricted markets as well.
All right, with that, it's a wrap on this edition of News Center. More news and updates continue right here.
Well, the much-awaited LensKart IPO opens for subscription later this week. Remember, the company is seeking a post-money valuation of almost $8 billion and 7,300 crores worth an IPO size as well. We have with us the CEO or the founder, Piyush Bansal, and the CFO of the company joining in as well. Gentlemen, thank you so much. It is a fairly momentous occasion in the journey of the company. And to be very honest, it's a brand that needs no introduction. Everyone in India, the nooks and crannies, do know about LensKart. And at the same time, if I look at your revenues, 18% comes in from sub 2,000 rupees a pair and 18% above 10,000 rupees a pair. That tells you that it's been accepted as widely across the price range. And the only other brand that comes to one's mind is Decathlon, which has cut across this price value positioning equation. So congratulations on creating that business. More importantly, let's talk about the growth from here on, because what has happened so far is great. Now you're entering the world of capital markets. Now every quarter people will be asking you tougher questions. So the growth that you guys have been, reporting over the last 3 years on a compounded basis, do you think that sustains, or can you grow faster than that?
See, I think overall, if we look at eyewear as a problem or eyewear as a market, today almost 7 out of 10 adults need glasses.
Yeah.
And this number has been growing from 5 or 6 to about 7. Even if you look at children, about 20% kids used to have myopia. Now that number as of FY25 has become 40%, and we are seeing that number is growing. If we keep that in mind, our view is that the market will continue to grow. Market will continue to grow. And at LensKart, as long as I think we can do more and more eye tests, which we have been compounding more than 50%. FY23, we did about 6 million eye tests. And FY25, we did 16 million eye tests. And India needs light. We have almost, very soon going to have over 500 million people who need glasses. Without glasses. So I think as long as we can continue to do that, there's a lot of opportunity.
The organized market obviously likely to grow nearly 1.6 times the unorganized market. Let me ask you the numbers specifically. What rate is the market projected to grow at? In the past, what have you been growing versus the market? And is that sustainable in the future as well?
So Indian market in eyewear category has been growing at about 13%, caused by both the increasing myopia rates, increasing adoption, and people buying more eyewear per head. We have been outperforming the market, and we think we will continue to do that in the foreseeable future.
By a factor of how much?
Similar to what we have done in the past.
What has been that number in the past?
We did about 24-25% growth, and we've been adding to our share.
So 2x of the market is a number that is sustainable. Let's talk about the margins as well. Your operating leverage has begun to kick in. The international operations, which have a lot more margins as well, all of that has meant that your margins are just sub 18% at the end of the previous quarter, the numbers that you've reported so far. What are the levers for the margins to go further from here, and what's the headroom here?
Yeah, if you see our last 3 years, we have increased our EBITDA margins by almost 8 to 9%. And that has come as a combination of product margin expansion, operating leverage, and marketing efficiencies. So all these three levers continue to be relevant. And as we look at future, they will keep adding to the margin profile. There is a natural operating leverage in our business. And given that this is a high product margin business, the flow-through helps in overall, EBITDA expansion.
Gross margins of almost 68%, employee costs at 25%, your EBITDA margins are close to 18%. So realistically speaking, if all things work, your margins have a headroom to go all the way up to 25 to 30%. Is that directionally an aspirational number?
I would not get into direction of margin right now. I think as a business, I would still say that we are very early in the journey. Like I said, right now, of course, the business has hit a certain scale, and we like to believe that we are creating a lot of value for the customer, and we want to do that even further. It is too early, I think, in the journey for us to really set expectations for the numbers that you're talking about right now. I think our goal right now is how do we take our 16 million eye tests to 100 million eye tests a year. As long as we can do that, I think we would like to be focused towards that. Margins is a outcome. They have been, we have been fortunate that they are coming along, and let's see where they go. I'm sure we continue to surprise everybody.
Well, you better be surprising people. The reason why I say that is because, you're saying you don't want to set expectations for people so early in your journey and speak about adding value to customers and all of that and stuff. In the secondary market is the valuation that matters the most. And I'm looking at your numbers, you're seeking a post-money valuation for almost 70,000 crores in terms of market cap. Just basis trailing numbers, you are, offered at a little over 230 times price to earnings, nearly 10.5 times sales. Even if you triple your profits from current levels over the next few years, you would be at around 70 times, right? So what I'm trying to understand is how much value do you think personally you've left on the table for people who are entering right now?
I would say that firstly, as a company and as an entrepreneur, our job is to create value for the customer.
Yeah.
Right?
And now increasingly shareholder as well.
Yes. And the shareholder, as far as valuation is concerned, it is what the market decides. Even if we look at the valuation, there are investors who are selling shares, there are investors who are coming in, and they have done a lot of working to arrive at these numbers. All I can say is they'll be very close to comparables. They won't be off. Sometimes when you look at things without looking at the full perspective, they look different. But yeah, be rest assured that everything will be in line with what they should be. I don't expect anything abnormal here.
Can you give us the full perspective then? Because, what people have right now from the RHP are the numbers that I just spoke about, trailing PE of over 234 times. How do you justify that? Especially because, coming from a person who's been speaking on national TV to startups and asking them about valuation. So if you could give us a sense.
See, we have had very detailed feedback from all the investors of the world, including domestic mutual funds, foreign long-only investors, including our advisors, and based on that, the investors and the sellers have kind of decided the price. From a business standpoint, what I can say is that as a tech company, when the operating leverage starts kicking in, the bottom line grows much faster than the revenue growth.
The EBITDA growth CAGR over the last 3 years has been over 90%. Obviously, there has been operating leverage which has kicked in. How much more is left ahead versus what has happened already? Can you tell us a sense?
As our revenues grow, we will continue to compound and continue to add margin.
All right. Let's talk a little more about the objects of the issue. A large part of the money that you're raising, the fresh issue that you're raising, will be deployed towards company-owned stores. Can you explain to us the strategy of having company-owned stores at a time when a lot of the retailers are looking at franchise-owned stores? How does that...
LensKart, our model is not like a traditional retail.
Yes.
Our model is, we are almost like we are a centralized supply chain model.
Yeah.
So what you're doing really in the retail stores is booking an order. We don't actually keep inventory in the retail store.
Got it.
Plus, as a company, we believe that we do not want to open a franchise store to pass any risk. Even, we have a few franchisees, and in that franchisees, we still continue to carry all the inventory risk ourselves. So in our model, we believe that, the company-owned store or a franchisee store doesn't make a lot of difference. As of now, the stores have been paying back quite well. I think we are also an evolving model. We continue to reinvest in the store experience because we want people to have a surprising experience all the time. So keeping all those factors in mind, we continue to still open a mix of both, but largely, yes, we have more company stores than franchise.
So roughly 2150 stores as of now in India, around 600, 700 stores abroad. How is that number likely to evolve over the next 3 to 4 years?
India is a very large market. If you see the optical density in India, it is about 60 stores for 1 million people. Yes. If you think about that, it is 1/8 the size of pharmacy and 1/20th the size of jewelry stores. For a modern day epidemic, which is affecting at least half of the population, and with only 1/3 penetration levels, the number of stores are bound to grow, right? So it is a very large market. It is growing very fast, and and we will continue to try and address it.
Let's talk about one of the other risks as well, which was the kind of supply that you got from China. That was about 55% a few years ago. That number's come down to around 45%. How much more are you looking to indigenize? What's the capex plan for, manufacturing in India, and how does that turn your return ratios?
Overall, I think for most categories, including frames particularly, we are dependent on international markets for import. We have not had a supply chain ecosystem for manufacturing of frames, particularly in India. I think we are, as one of the key players in the market, we are making a lot of investment into bringing that supply chain ecosystem. It requires all aspects on the supply chain, from molding, from plating, from tools to come into the picture. We have initiated on that journey. Over the years, you would see us moving more and more manufacturing into India.
Could you give us a target?
No. Not that now.
No, because the new plant which is coming in, right? If you could give us a sense.
So we are making the investments, right? We are coming up in Hyderabad.
Exactly.
And we are making investments in terms of setting expectation of what percentage would move by then. We would refrain from that right now. But our steps are in that endeavor that we move more and more manufacturing to India.
All right. Let's talk a little more about the international business as well. You guys have, because of some of the acquisitions that you've made, one of a brand in Spain recently, and the Japanese companies, etc. You've now gotten about 40% of your revenues coming in from international business. But more importantly, that business has a little over 500 basis points margin advantage over what you're doing in India as well. How is that mix likely to evolve over the next few years?
See, overall, if you look at the journey of LensKart, it depends on where are you standing and looking at. If you feel LensKart as a company is just about there and now there is little room, I think as far as we are concerned in this category, the market is just beginning to open up. I mean, the amount of digital penetration we have in all markets, including India, the amount of the rate at which myopia is growing, one has to assume that you haven't done much right now. So keeping that in mind, there is a long journey for us. As part of that journey, there are two aspects that are very important for us. One is how do we bring selection to our customers? At LensKart, we operate like a house of brands. We don't operate under one particular product brand name. LensKart, we see it as a platform brand. I honestly feel that unlike apparel and shoes, eyewear has that mid-layer of D2C brands missing, which will be the brands of the future. So, I mean, you have a Zara, you have an H&M, you have a Uniqlo in apparel, but in eyewear, you either have the luxury brands or you have non-brand. So we are trying to create these brands of the future. And in that same strategy, we acquired Miller, which is a Spanish-based eyewear brand. We think it's a very cool brand. You should try it out. They've really created a huge sensation amongst a certain section of the population. And we are launching that brand in India as we speak right now in a few stores and going to more stores. And similarly, if you see Ondays, which was earlier the brand that we acquired, which is a Japanese brand, that is more around precision eyewear. And that brand is now a big part of the LensKart story in India, as well as what we want to do in international.
while I don't wear prescription glasses, I have to tell you that I am a customer of LensKart purely from a fashion standpoint. I don't know why, but I do have a feeling that maybe eyeglasses are the sneakers of the future, where earlier you had one shoe and now you have more. Speaking about that itself, what is the opportunity on non-prescription eyewear for you? Fashion glares, have you seen thought of that as an opportunity?
See, overall, yes, there is opportunity there. And Miller, the brand which we have acquired, is predominantly a sunglasses first brand right now. So even in these sunglasses, a lot of work that we are doing is towards prescription sunglasses, right? And you mentioned like on the fashion side, actually, I think eyewear is going to be more fashion than anything else. I mean, this is the product that we wear on our face throughout the day. So I know the market feels that sunglasses is fashion and this is utility. Actually, we see the two converge, and already, I mean, the number of pairs that people buy at LensKart is already about 3.6 pairs every 2 years, which used to be much lesser earlier.
What's your revenue mix right now? How much comes in from prescription? How much comes in from sunglasses? How much comes in from non-prescription? And how much comes in from your app? How much comes in from offline? If you could give us that sense.
See, majority of our business is prescription, right? And on the channel side, we're a truly omni-channel player. It is a combination of online, offline, store. Even the people who are punching the orders at the stores, 45% of them engaged with us online, tried the virtual try-ons, checked out the reviews, and then they wanted an eye test, and that's why they went to the store and punched there. So it's a good mix of omni-channel.
And what about the ROCE accretion that happens to the fees that people pay for being premium members, for being gold members, etc.? You know, the last number was over 100 crores that you got annually from these fees. Do you have any target on how you expect that to contribute to your overall?
We don't have a target, but overall we feel that we need to allow people to own multiple fares. I mean, that's the whole genesis of the LensKart membership, to get people to enjoy owning multiple pairs. Ironically, people would think that if I make you buy multiple pairs, you would use them in a sequence. But what we see is people actually use them together, and then they have this subconscious desire to buy more. Right? So I think we would see that habit is only going to grow more and more.
How's competition in the international market? Because in India, obviously, you are 2.5 times bigger than the next biggest, person in this business, the organized player, that's Titan Eye. How is competition in the international business, and have you faced any, difference in the competition there versus here?
See, all the markets that we are present in, they are highly fragmented and unorganized, and the traditional optical stores continue to be the, a large part of the market. So the value proposition that we bring to our customers in India, whether it is quality, whether it is value for money, whether it is the design element of it, whether it is the functionality, I think we have seen that hold equally true for all our markets and all types of consumer segments, whether it is Indians living outside India or the local residents of these markets.
We don't really have players which are trying to organize the whole market. But the demand is very high. If you look at, I was reading the Singapore government website, they say 83% people get myopic now by the age of 80. And myopia rates there are very high in terms of the prescription levels. It's not -1, -2, -4, -5. And the solutions that are available across these markets are quite expensive. And there's a big gap in the number of optometrists that are available to do the eye test and the number of people who need eye test. So I actually think there is a huge gap here, and it will require a certain amount of scale to be able to solve this problem. And I think so we are looking at this as a combined market, India, Southeast Asia, Middle East, and Japan. And India is definitely at the core of the technology and the supply chain that we are building.
What do you make of people who wear contact lenses?
I mean, we have a brand called Aqualens, which is been growing again. We have been trying to use the fashion approach on color lenses. It is one of the key brands right now, and in prescription also it is.
What's its size right now, and where do you see that going?
It is, I mean, overall contact lens market in India is only, I think, in somewhere in the $100 to $200 million size. So it is a market which I think in the years to come will explode. There are events in the Southeast Asian market and China market where, I still remember a story in Southeast Asia. There was a lens that was launched, which wasn't a color lens, but you'd make your eyes look bigger. And that's what exploded the market. India, I think, will go through a phase like that. Contact lens, if we see in our markets like Japan, in Singapore, this is a key, key component of the market, as a key part of the fashion. I don't see this as a substitute for eyewear. I just want to clarify that, because I see people who are wearing contacts are also wearing glasses. Contacts, overall, my senses is about, again, fashion overrules everything else, right? And there's a color market, or there is you want to look good. Eventually, eyewear is about looking good.
What about tech eyewear? Because everyone's now talking about smart glasses. Obviously, Ray-Ban has the Meta glasses, etc. And the next wave of tech accessories, wearables, are likely to be from the glasses point. And where have you been on that one?
So our approach on this has been full stack, right? We clearly feel that at LensKart, being a tech company, we don't want to just be on the frame side or on the distribution side. We actually also want to be on the data side. So we have partnered with Qualcomm. We would have a camera-based glasses coming out in the near future. We recently integrated with UPI, where you can make payments. So the way at least I'm looking at the world right now is that we had laptops, and then we had mobile phones, and laptops still are a big part of our everyday life. But there are activities that move from the laptop to the phone.
And similarly,
there are activities which I think would move to the smart eyewear. One such example is payment. Second such example is monitoring the diet that you're eating every day. I mean, it is kind of uncomfortable to take out your phone, scan, and check the calories. So similarly, for visually impaired people, this is a huge use case. In corporates, for delivery ecosystems, in warehousing, there'll be a lot of use cases. So I think what we are doing is we are investing in the full stack. I think it's time that we start innovating this. So at LensKart, we are taking a slightly longer term bet. So we have put a team together. We are designing the hardware. We are designing the firmware. We have all the best partners. And we want to create world-class smart eyewear out of India.
All right, we take that point. Let's wrap this up with a quick rapid fire, and we'd like you to, give as many numbers or as many, nuggets as possible in as little time. So let's start with the first one. Let's, market share.
No projections.
No projections. Current market close to 70,000 crores. Your revenue 6,600 crores. Sub 8% market share in India. Where do you see this headed?
Well, it's too early. I mean, we would want to, like I said, Maruti gave the comfort of four-wheeler to India. We would like to give the comfort of vision to India. We would want to give vision to a billion people eventually.
All right. Your margins from here on go how much higher?
Higher.
Much higher, not much higher, or very much higher?
It is. I would say.
I think priority is right now growth. We are very small market share.
Okay.
But we will, the naturally flow through will be the compounding of margin.
All right. And
very early in the journey, let's see.
Revenue growth aspirations. You said growth is your target, India and international markets. Give us a sense. And
we have been growing well. I think can we do more? Yes.
30% CAGR over the last 3 years.
I won't set any expectations.
No, that's been happening over the last 3 years. So obviously.
Yeah. Let's see. I think I would say that we are still very early in the journey.
Okay. 60% revenue from India, 40% internationally. Does that mix stay the same?
It will keep changing depending, how things are at different stages. Right now in India, we are in a high scale mode. We have been adding about 300 plus stores a year. International, we are integrating our tech. I think less relevant, I would say. It is something that you will see will evolve over the years. But international continues to be a good focus for the company.
4,000 stores by 2030?
Again, I would say.
Possible?
Definitely. I mean, India has 80,000 eyewear stores, approximately, conservatively. We have 20 times more jewelry stores in India. So one would say, can you add at least another 80,000 optical stores as a country? Yes. Right? Out of that 80,000, let's see how many LensKart adds.
All right. Your favorite LensKart pair?
Hustler.
Yours is Hustler as well?
As of now, but very soon it's going to be something else. I'm looking forward to wear our camera glasses. I keep playing with them. There's one in my bag right now. I don't want to show anyone.
I like the new Meller as well.
You like the new Meller as well?
Actually, yes. The Meller is quite cool.
A competitor's product that you really admire?
Decathlon. Not a competitor.
Right. I'm all about Uniqlo. I am top to bottom Uniqlo.
1,000 crore PAT by 28, FY28. Is that possible? On a 10,000 crore revenue base?
I won't comment on that right now.
Our Q1 numbers are out. You can look at them.
Well, if we do that, thank you so much for joining in. Wish you good luck for this IPO, and more importantly, valuations. You've said that they're based on certain parameters. There is a growth opportunity here. Let's see what the market says. So as they say, over to the markets.
Thank you.
Thank you.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty end in the green after a steady session. Nifty moves back above 26,000. Midcap index hits a one-year high. Nifty Metal Index hits a record high for the sixth session in a row. Market regulator SEBI recommends lowering the brokerage charges imposed by mutual fund houses, also tweaks rules dictating fund management fees. Asset management companies and broking stocks suffer sharp cuts in trade.
Prime Minister Modi is the nicest looking guy. He says, oh, and he looks like you'd like to have your father. Like, he's a killer. He's tough as hell.
US President Donald Trump praises Prime Minister Modi, says he's doing a trade deal with India. Also reiterates his disputed claim of personally averting a nuclear war between India and Pakistan. President Trump says they have reached a trade deal with South Korea as he addresses the APEC summit in Seoul. Also expects a good deal with China ahead of his summit with President Xi Jinping tomorrow. ChatGPT maker OpenAI transitions into a traditional for-profit structure, clearing the decks to go public. The move pushes Microsoft's valuation beyond $4 trillion with a 27% stake worth $130 billion. Shares of Nvidia rally in pre-market trade. The tech giant is on track to become the first company to cross $5 trillion in valuation. Israel claims to have resumed enforcing the ceasefire after killing at least 100 people across Gaza. President Trump defends Israel's actions and claims nothing will jeopardize the ceasefire now. Cyclonic storm Montha weakens after making landfall in Andhra Pradesh. Death toll rises to 2. Heavy rains lash parts of Andhra Pradesh, Odisha, Bengal, Jharkhand and Madhya Pradesh. President Draupadi Murmu takes a sortie in a Rafale fighter jet from the Air Force Station in Haryana's Ambala, calls it an unforgettable experience. All right, let's start with the day's market action. The last street ended higher with Nifty closing above the 26,000 mark. Midcap index hit a one-year high. Nifty metal surges 2%, gaining for 6 straight sessions. A day after MCX exchange went offline for more than 4 hours, the exchange confirmed that all trading activities have resumed and all operations are functioning normally today. MCX noted that the delay in operations was caused by an issue pertaining to data processing at the trading gateway. The exchange also said that corrective measures have been taken to address the issue. The U.S. Federal Reserve's 2-day policy meeting will kickstart tonight. A CNBC survey has found that markets are expecting a 25 basis points rate cut, even as inflation remains well above the Fed's target. The respondents also expect the Fed to lower rates by 100 basis points by the end of 2026. However, top economists raised concerns about factors like lack of data on the impact of the government shutdown. Remember, the Fed cut rates by 25 basis points during the September meeting as well. President Trump has been pressurizing Fed Chair Jerome Powell to lower rates since he took office in January. Back home, stocks of AMCs and other market participants declined after SEBI proposed norms which would reduce mutual fund expense ratios and brokerage fees. The market regulators suggested lowering expense ratios by up to 0.15% for open-ended MFs and up to 0.25% for closed-end schemes. Sonal Putra has more.
SEBI has proposed a sweeping overhaul of how mutual funds charge investors, aiming to make the system more transparent, fair and performance-driven. The proposal, if implemented, could lower costs for investors but also squeeze profits for fund houses and brokers. To begin with, SEBI has proposed reducing the total expense ratio, or TER, charged by mutual funds. For open-ended schemes, the cut could be up to 15 basis points, and for close-ended schemes, as much as 25 basis points. In simple terms, that's the portion of your investment that goes towards the fund's management and operational costs. Currently, equity-oriented schemes can charge up to 1.25%, but under the new proposal, that will be capped at 1%. For debt and hybrid funds or schemes that are not equity-oriented, the ceiling will fall from 1% to 0.8%. SEBI has also proposed removing the additional 5 basis points charge that mutual funds were allowed to levy on their entire assets under management. That extra charge was introduced in 2018 as a transitional allowance, and now SEBI feels it's time to rationalize investor costs. SEBI has also proposed that fund houses venturing into non-mutual fund businesses such as portfolio management or advisory must do so through separate business units. This ensures that costs are not cross-subsidized and that investor money in mutual fund is used strictly for that purpose. In addition, statutory levies like STT, GST and stamp duty, they will remain outside the expense ratio. This means these taxes will be shown separately, allowing investors to see the real cost of fund management versus regulatory levies. Now to one of the most interesting proposals, performance-linked expenses. Under this framework, mutual funds may be allowed to charge a higher or lower TER depending on how the scheme performs. If the fund outperforms its benchmark, the AMC could earn a slightly higher fee, but if it underperforms, the expenses charged would reduce. The idea is to align the fund manager's incentives with investor outcomes so they earn more only when you, the investor, does well. A detailed framework for this will be developed after consultations with the industry. This also marks a shift from SEBI's 2023 approach, when the regulator had proposed including all such charges within the total expenses, an approach that was met with significant pushback from the industry. While these proposals are investor-friendly, they may tighten profitability for asset management companies. According to estimates by Jefferies, a 5 basis point reduction in equity-related charges could impact AMC profits by 8 to 10% if the new rules take effect from FY27. The cut in brokerage fees could also hurt institutional brokers who might see lower revenue from mutual fund transactions. However, for investors, this could be a positive development with fewer hidden costs, lower expenses, and more transparency in how their money is managed. Comments are invited from the industry, and the deadline is 17th of November.
Right. Thank you, Sonal, for this update. Shifting focus to the top international story we're tracking. U.S. President Donald Trump is in South Korea for the third leg of his Asia tour. He met President Lee and was awarded the country's highest honor. Trump said he has concluded a trade deal with South Korea. Speaking at the Asia-Pacific Economic Cooperation meeting, Trump also praised Prime Minister Narendra Modi as the nicest-looking guy and described him as quote-unquote killer. Trump hinted at finalizing a trade deal with India soon. However, he reiterated his claim of stopping a potential war between India and Pakistan.
President Xi of China is coming tomorrow here, and we're going to be, I hope, making a deal. I think we're going to have a deal. I think it'll be a good deal for both. And that's really a great result. You know, that's better than fighting and going through all sorts of problems and, you know, no reason for it. I think it's going to be a great deal for both. And I called Prime Minister Modi. I said, we can't make a trade deal with you. No, we must make a trade deal. I said, no, we can't. You're starting a war with Pakistan. We're not going to do it. And then I called Pakistan. I said, we're not going to do trade with you because you're fighting with India. Prime Minister Modi is the nicest looking guy. He says, oh, and he looks like you'd like to have your father, like, he's a killer. He's tough as hell. No, we will fight. I said, whoa, this is the same man that I know. But after a little while, and they're good people, and after literally 2 days, they called up and they said, we understand, and they stopped fighting. How is that? Isn't that amazing?
The U.S. Senate, where Republicans are in a majority, passed a bill to terminate President Trump's tariffs against Brazil. The legislation was passed by a 50-48 vote after 5 Republicans joined the Democrats. Legislative measures to terminate Trump's tariffs on Canada and tariffs against other countries are expected to come up for votes later this week. Democrat Senator Tim Kaine has said that people are suffering and paying more for food, clothes and health care because of Trump's tariff policy. Commerce Minister Piyush Goyal has concluded his visit to Brussels after discussions with the European Union Trade Commissioner on a free trade agreement. In a social media post, Minister Goyal said he discussed India's concerns on non-tariff measures and the new EU regulations. He also said that both sides agreed that issues related to steel, auto and other EU regulations still require further discussions. EU's technical team will visit India next week. Prime Minister Narendra Modi congratulated Sane Takaichi after she assumed charge as Japan's first female Prime Minister. In a post on social media, Prime Minister Modi said they discussed their shared vision for advancing the India-Japan strategic partnership. The two leaders also agreed that stronger bilateral ties are vital for global peace and stability. Amazon Web Services will invest $5 billion to build AI data centers in South Korea by 2031. This will be the country's largest foreign investment and will overtake the previous record set by Amazon in June, when it pledged $4 billion for another AI data center. NVIDIA is investing $1 billion to buy 2.9% stake in Nokia as part of a strategic push to bring AI to telecom networks. Nokia will also integrate NVIDIA's AI chips into its 5G and upcoming 6G network to boost automation. The chip maker will leverage Nokia's networking and data center technology for its AI infrastructure. NVIDIA's market cap is all set to cross the $5 trillion mark. The stock rose more than 3% in pre-market trade. This will make NVIDIA the first company to cross this threshold. The stock price has risen nearly 50% year-to-date. And speaking of NVIDIA, CEO Jensen Huang has dismissed fears of an AI bubble. He said that AI is profitable and it is going to change people's jobs while making companies more productive. He further said that NVIDIA is hiring more due to AI. He also revealed that NVIDIA has bookings worth $500 billion for its artificial intelligence processors.
I think this idea that AI is going to take jobs. It's going to change everyone's job. That's for sure. But I think it's going to make companies more productive. We're more productive today because of AI. We're hiring more people.
Now, ChatGPT maker OpenAI has transitioned into a traditional for-profit structure, clearing the decks to go public. The move will push Microsoft's valuation beyond $4 trillion, worth a 27% stake, worth $130 billion. Rachna Dhanrajani joins us now with the details. Rachna, what are you picking up?
That's right. OpenAI and Microsoft are taking their partnership to the next level, signing a new definitive agreement that cements OpenAI's transformation into a public benefit corporation with its non-profit arm, the OpenAI Foundation, firmly in control. Now, under the recapitalized structure, Microsoft now holds a 27% stake in the OpenAI Group, PBC, valued at around $135 billion, while the foundation owns 26% and employs and investors holding the rest. This is all at their latest valuation milestone of $500 billion. Now, this partnership keeps the core alliance intact. OpenAI remains Microsoft's frontier model partner, and Microsoft retains exclusive IP and Azure API rights until the milestone of artificial general intelligence, or known as AGI. But this new phase also gives both sides more room to grow. Any AGI claims by OpenAI will now be verified by an independent expert panel, and Microsoft's IP rights are extended through 2032, even for post-AGI models, though OpenAI's consumer hardware is now off limits. Microsoft can now pursue AGI on its own as well, while OpenAI gains the freedom to collaborate more with third parties, release open-weight models, and serve non-API products on any cloud. OpenAI CFO Sarah Freer in Riyadh said that this deal with Microsoft now allows the company to continue raising capital in a much less complex manner. The companies have also rebalanced their commercial terms. OpenAI will buy an additional $250 billion in Azure services, but Microsoft no longer has the first right of refusal to be its cloud provider. Both the firms say that the agreement builds on 6 years of partnership and sets the stage for long-term collaboration, combining OpenAI's innovation with Microsoft's scale as the race towards safe and responsible AGI enters its next chapter globally.
Right. Thank you, Rachna, for that comprehensive update. Shifting focus to the other big story that we are tracking, the demerger of Vedanta will be delayed as the NCLT bench hearing the case has now been reconstituted. This newly bench will now hear Vedanta's plea and the government's objections to the demerger scheme of arrangement all over again. The NCLT will begin hearing the case once again on the 12th of November. This comes as SEBI clarified that it was not happy with Vedanta's modification of the scheme of merger after approval. Right, in global earnings now, Swiss banking giant UBS has reported strong numbers in the third quarter. This was largely driven by solid banking performance and release of legal provisions. Net profit during the quarter came in at $2.5 billion, marking a 74% growth on an annual basis. The bank posted steady revenue, which came in slightly above street expectations. Coal India posted a mixed performance in the second quarter. Net profit fell short of estimates despite rising 32% year-on-year. The company's operational performance was weak, with margins missing below estimates and EBITDA falling 22%. However, revenue surpassed expectations despite falling 3.2%. Ola appealed in the Karnataka High Court to quash the FIR, alleging that the company abetted the suicide of an employee. The matter has been adjourned to the 17th of November. Ola argued that a case of unnatural death has been registered, so it's not homicide. The company also told the court it has remitted all the dues to the deceased. The court directed the police to continue the investigation as a suicide note was found. Telecom Minister Scindia has said that the government will evaluate implications of Supreme Court's order on Vodafone Idea's AGR dues before considering any relief for the telco. Speaking off camera to CNBC-TV18, Scindia said that the government has yet to comply to the Supreme Court's written order. He added that the centre will wait for Vodafone Idea to apply for seeking relief. This comes after the Supreme Court allowed the centre to reconsider the cash-strapped company's AGR dues worth 93,000 crore rupees. All right, on that note, it's time for a short break. Coming up next, Hindustan Aeronautics has signed an MOU with Russia's UAC to manufacture the SJ-100 passenger jet in India. The Russian firm had been sanctioned by the United States in 2022. More details when we return. Welcome back. You're watching Business 360. Air India CEO Campbell Wilson, in his first public event since the Ahmedabad plane crash, said that the interim report had indicated that there was nothing wrong with aircraft engines or practices that required changing. He said that crash, which claimed the lives of 241 people on board, was devastating for the company and was a cause for reviewing practices at the airline. Hindustan Aeronautics has signed an MOU with Russia's UAC to produce the SJ-100 passenger jet in India. The Russian aerospace firm has been sanctioned by the United States. It was sanctioned by the US in 2022. The arrangement gives HAL the rights to manufacture the aircraft for domestic customers. Madiha Mujawar is here with more on this aircraft. Madiha.
Well, the SJ-100, originally marketed as the Sukhoi Superjet 100, is a twin-engine, single-aisle regional jet, smaller than the narrow-body Airbus and Boeing planes that we typically fly in. This seats about 87 to 98 passengers, and in denser layouts can carry up to 100 passengers as well. It first flew in May 2008 and entered commercial service in the early 2010s. Now, SJ-100 never became a global bestseller. Estimates vary, but roughly 125 aircraft have been in service as of today, with total production reported at a little over 200 planes. That's it. Today, the most active operators are only Russian carriers. According to available fleet data, Rossaya is the largest operator with 61 planes in service and 14 grounded. Red Wings flies 19 SJ-100s. Azimuth has 18. Yamal Airlines around 10. IR Aero 6. Gazprom Avia 5. And Yakutia has 2 SJ-100s. Several of these planes bought by these airlines are also grounded for different reasons. The small fleet size and concentration with Russian operators limits resale and leasing appeal. That's the commercial reality. The program's reputation was then dented by high-profile accidents. The SJ-100 has been involved in 3 fatal accidents, killing 89 people. Most notable was the 2012 Mount Salak crash, which was a demonstration flight in which all 37 passengers and 8 crew members on board were killed. There are also long-standing operator complaints about spares and maintenance support. Those issues reduced overseas sales and left the type, the SJ-100, with a limited international footprint. Now, the MOU with Russia's UAC aims to give India the option to produce a ready regional jet for a large domestic short-haul market. For example, routes under the Udan regional scheme. The argument in favor is simple: quicker access to an off-the-shelf regional aircraft, potential jobs, technology transfer, and new MRO capacity. Now, HAL's experience with licensed production of Russian military types also strengthens the industrial case here for HAL. But on the flip side, the SJ-100's small global fleet, past reliability and after-sales issues, and the post-2022 Russification of components raise questions about certification, parts supply, and export markets. Now, pre-2021, the Superjet was built with many Western components, including the engine. But after Russia's invasion of Ukraine, those Western companies terminated the contract. Russian industry announced an accelerated import substitution program to replace Western systems. March 17, 2025 was the maiden flight of an SJ-100 fitted with the new Russian engines. So to conclude, we don't know if HAL has any confirmed orders yet from any airlines to buy this jet. Which SJ-100 variant will HAL build, and the original with Western components or the one with a Russian engine, and how HAL plans global certification given the company, the UAC, under Western sanctions. So that's the big question.
All right, thank you, Madiha, for that comprehensive update. Shifting focus now, Israel has claimed to have resumed enforcing the 3-week-old ceasefire after killing at least 100 people across Gaza. The strikes followed accusations from Israel's military that Hamas attacked its forces in the area. President Donald Trump defended Israel's actions, stating that nothing will jeopardize the ceasefire now. Russia has said that Ukraine launched drones at Moscow for the 3rd consecutive night, forcing airport closures. Russia's defense ministry said that forces shot down 124 Ukrainian drones in a 24-hour period. This as Russia launched 400 attacks in southern Ukraine, killing 1 person. Ukrainian President Zelensky said Ukrainian and European officials will meet at the end of the week to discuss the details of a ceasefire plan. Hurricane Melissa has made landfall in Cuba as a Category 3 hurricane after leaving a trail of destruction in Jamaica. Hundreds of thousands of people had been evacuated to shelter in Cuba. The storm has weakened after hitting Jamaica as a Category 5 hurricane. Jamaica's Prime Minister has warned of devastating impact as officials assess the damage. The hurricane will move northeast towards the Bahamas and Bermuda after hitting Cuba. From one storm to another, Cyclone Monta has wreaked havoc in Andhra Pradesh after making landfall last night. A woman was killed after a tree fell on her house. Thousands have been displaced as flooded roads and uprooted trees brought life to a standstill across southern Andhra and parts of Odisha. The India Met Department said the cyclone is expected to weaken into a deep depression over the next few hours, but the remnants could still affect North Telangana and South Bastar. And before we wrap, President Draupadi Murmu took to the skies for a 30-minute sortie in a Rafale fighter jet. She now becomes the first Indian president to undertake sorties in 2 Indian Air Force aircraft. President Murmu was flown by Group Captain Amit Gehani from the Ambala Air Base in Haryana. She called the experience unforgettable and a moment of pride for India's defense capabilities. We leave you with these visuals. Thank you for watching.
welcome to this special edition of Startup Street. I'm Ritu Singh. Now, in a first-of-its-kind such partnership, global venture capital firms Accel and Prosus have come together to back the next generation of Indian founders that are creating what they call Leap Tech, which goes beyond deep tech, really looking at technology that is at the intersection of deep science and bold engineering. Now, through this global alliance, the two venture capital firms are going to back founders that are creating the next frontier companies from day zero. So Prosus is going to match Accel's early stage investments through Atoms X, giving founders the support that they need from seed to scale. To understand the nature of this unique partnership, I have with me Prateek Agarwal, who's partner at Accel, along with him Ashutosh Sharma, the head of investments at India and Southeast Asia at Prosus. Prateek and Ashutosh, both of you, thanks so much for your time here. Prateek, let me start with you about why this partnership. It's not like there's dearth of capital between the two of you. Why did you come up with this?
First of all, thank you for taking time and speaking with us and giving us an opportunity to talk about it. See, this is a pretty important partnership, we feel. See, Accel has been in India for a long time now, almost since this startup ecosystem's inception.
Yeah.
And we've been very fortunate to partner with some of the important companies that are birthed here and pretty proud of contributing to the ecosystem. And what we've noticed is, in the last 15, 20 years or so, we've had from a standing start, we have created some institutions, which I would argue power a big part of the average Indian's lifestyle. Like from e-commerce to food delivery to consumer goods, etc.
Yeah.
And so that has given a lot of confidence to the ecosystem that the startup ecosystem can build things that have durable value and become an important part of customers' life. That said, now we feel at Accel it's a huge time to kind of change gears and multiply the ambitions of the ecosystem. In some way, so far, India was catching up to the global progress in the startup ecosystem. And now we feel it's we have to kind of lead it. And we feel it's time for original, ambitious, uncharted, unproven ideas that can kind of transform markets.
I get that, but why is now the right time, for a market like India? Why now?
Yeah. So it's a progression, right? So if for something like this to happen, there has to be enough talent pool. There has to be enough operating pool who has worked at startup. They can almost assume execution for granted. Previously, you could, even figuring out how to get something off the ground was a challenge. Now, the ecosystem is limited by ideas and novel insights. And you could assume that you can find the right capital, you can right talent to get it going.
Right.
Plus, on the bottoms up, we are seeing a lot of companies like this. We've invested in a few companies, actually a company that both Ashu and I work with called Vyom, which we are very excited about, which they are going after kind of getting unlimited internet to 500 million Indians.
Okay.
All the telecom players right now, while India has the cheapest 4G, it's only 25 gigabytes a month.
Yeah.
I cannot service on 25 gigabytes. We can't survive. So they're trying to get it unlimited internet for much cheaper than that. So that's a pretty ambitious idea to start a telco in 2025.
All right.
So yeah, we are looking for more people like that, and we feel right now is the time where the ambition is there and the opportunity is there to accelerate India's path to the developed
Never mind
economy.
the large competition out there in the telecom market. But Ashutosh, let me ask you that. I mean, what's in it for Prosus? Technically, I mean, if you look at Prosus's investments, they've been late-stage investments globally. What made you pivot to this, and what are you getting out of the partnership?
Yeah, for us, I think it's a very complementary partnership. Accel is extremely deep in India. They have many, many more investments than we do in India. They have a team which is much larger than ours in India. But we have a global footprint which is much broader. So we have investments in 40 countries across the world. So we can bring that to this partnership. The other reason this is complementary is that Accel is amazing getting a company from 0 to 1, 1 to 10, 10 to 100. And Prosus is slightly late stage, as you said, and so we can help companies grow from 100 to 1,000 to 10,000. And therefore, for a company like this, where the idea is really, really audacious, to help them grow from 0 to 1,000 and 10,000, I think collectively we can do it.
So Prosus has what, about $8.5 billion invested in India?
That's right.
To what extent can that grow with these kind of partnerships that you're looking at?
To a great extent, and I completely agree with Prateek. I think while India's startup ecosystem has matured, but it's still a baby. US is 60 years old, China is 40 years old, India at best probably 20 years old.
Okay.
And the first set of companies we saw were inspired from something that was happening in US or in China. Now we see brand new ideas with a very specific India challenge, with a very specific India-based solution. And therefore, we feel the adaptability of such ideas is over a large part of our population, a much larger part of our population. And therefore, in impact, this could be much, much larger than what we have done so far.
All right. Just give us some technicalities in terms of what kind of check sizes will you be writing? I mean, you're in it for the longer term. You've been doing these early stage investments. And if there is a sunset clause to this partnership?
So the starting investments that we propose is like anything from 200K to $1 million from each side. So like a company would get up to $2 million as their first check from AMCs. And progressively it can keep going. Both of us have, like, as you said, like there's no dearth of capital within us. So as the companies keep progressing, we can continue to invest them a long way.
But Ashutosh, from a Prosus point of view, have you set aside a certain amount of capital to specifically invest through this partnership?
We've not, and we don't do that for anything. We don't have a specific geography allocation. We don't have a specific sector allocation, and we don't have a specific partnership allocation. So I think the onus is on both of us, and primarily Prateek, because this is his baby, this is his brainchild, this is his idea, to show success. And I think if we are successful, capital is not a problem.
So when you say primarily Prateek, is Axel going to be doing the due diligence on which companies, which founders to back? I mean, how will the partnership work?
We'll do all of this together, for sure. But the idea is specifically, and as we were discussing before we started, we are neighbors, and we take...
And yet this is the first time Prateek has come to your office.
I go to his office much more often. That clearly shows the hierarchy.
Not to meet me.
That clearly shows the hierarchy. And so yes, I have to... But over many long walks, actually, we discussed this. And I was just telling someone the other day, Prateek talks very passionately about how India can leapfrog from a developing economy to a developed economy at the back of such ideas. And so he feels very passionately about these. And he told me he has a dream that we will be able to find not 10, 15, 20, just like Martin Luther King. Like, I have a dream. So
this is your dream.
Yeah. So we're in it together. Of course, we'll do everything together, but he's the champion.
All right. So you will initiate the finding of these founders and the kind of sectors that you're looking at. Speaking of which, you use this interesting term called leap tech.
Yeah.
If you could define that for our viewers, I mean, we've heard plenty of deep tech.
Yes.
What exactly is leap tech?
See, so deep tech is anchored in the idea of deep technology. And then that technology could be doing a variety of things. It could be something wide-ranging, or it could be a niche kind of application in some healthcare, science, or something like that. Leap tech anchors in the idea of population scale impact.
Okay.
That the gating criteria for a leap tech company is, does it impact the lives of hundreds of millions of people, and not something niche. And the second idea is it has to be a step function transformation of the industry or the market. It's not about incremental changes. It's about like 100x differentiation. Like if you look at some of these ideas in India, like if you look at Geo or if you look at UPI, like, I would argue that India has leapfrogged. Like what are the Western experiences, some of these industries, even quick commerce. Like I would argue that our grocery buying experience is now like state of the art globally. Like none of my peers in any country enjoy the kind of convenience that we do. And we feel this is not like by accident. It's not like 1 or 2 or 3 ideas by accident are happening in India. It's happening in India because like the Indian consumer base is massive. And that consumer base is increasingly aspirational, has higher willingness to pay for convenience. And India is getting developed with technology. A lot of the infrastructure of organized markets in the West or in the East developed without technology, without digitization. So India's growth is internet native, is like technology native. So like the pharma factories in India may be like completely automated from the get-go versus like what would happen in other geographies or a similar idea. So the idea is leap tech stands for step function transformation through a technology breakthrough, business model breakthrough, or a product breakthrough. But it has to be a breakthrough.
The way I internalize this is like deep tech is some sort of a sub-segment of leap tech. Till the time such deep tech has population level impact. If it has, then it is a sub-segment of leap tech.
But if I were to, sort of pinpoint certain sectors or certain themes, because this is a very broad theme that you're talking about, because what makes sense for a 1.4 billion customer country? I mean, what are the sectors, that would fit into this category? Yeah, what are the kind of things?
It's going to be very foundational. It's going to be like big parts of the economy, big parts of a consumer or business need. Like it's going to be like stuff in energy. It's going to be stuff around manufacturing. It can be stuff in like new kind of computer interfaces. It can be obviously the AI technology is like really powerful right now. This will have far-ranging impact in society. It can be like the problems that we face, like right now, problems of pollution, problems of transportation. Like one company we invested in called Sarla Aviation, which is building like
robotaxis, EVT or whatever they call it.
EVTOL, So those technologies have insane promise because overnight, like it costs like hundreds of crores to build a kilometer of metro, and it costs 5 lakhs to build a helipad. So these kind of ideas. We're looking for ideas which are unproven, uncharted, bold, ambitious, but if they work, they will transform society.
It could also be in an old school industry, healthcare, education, right? 1.5 billion people need healthcare, and 1.5 billion need education. And how many hospitals can we build? And how many schools can we build? How many teachers can we train? Not enough. There has to be, as Prateek said, there has to be a leapfrogging of product here, such that it caters to so many people.
Let me get even more specific then. You've given us an idea of sectors and ideas. Are there companies either of you already identified you could share with us that'll be part of this joint investment Accel and Prosus do together?
So we have a pretty big pipeline. At this point, we won't be able to reveal specific names, but we've gotten over 1,000 applications already from actually Indians globally, not just in India, building for India and outside. And there are certain companies that we're very excited about, and you'll hear about them soon enough.
But out of these thousands, how many will you end up practically investing in? And is there anything that's already been shortlisted?
Yeah, so look, there is no number that we have in mind. What we have decided between both the organizations is that we'll keep the bar very high.
Okay.
Right? And so if we can find 5 that meet that bar, is fine. If you can find 50, even better. So that's not a problem, but the bar is high, and the bar is that population level impact that he was talking about.
Let's say you shortlist these 10, 20, 50 companies. Given some of the expertise that the both of you have, whether that is early stage or global presence, what will building in India, building for the global market look like in practice? And what kind of support would somebody like Prosus be able to provide to give them access to those global markets?
Yeah. So one or two things. One, because we have such a big global footprint, there is around 5.5 billion people that we reach out to through our portfolio companies. I'm not saying all that market is available day one, but if someone has a product which is interesting, there is markets beyond India that we can enable for them, right? And then the second aspect is in certain functional areas like artificial intelligence, between our portfolio itself, we have a lot of talent that we can bring to bear, but specifically for Prosus internally, we have 150 people in our AI team. Our AI team is bigger than our investment team. And so if there is something to be done with that, we're happy to enable that. And Accel has a much longer history, so I'm sure there's much more.
Look, see, there is a lot of support we provide to any of our portfolio companies, which is very custom to their requirement. I think the most important thing that we hope to signal through this initiative is that often when we meet founders who are doing something new, refreshing, hard, difficult, with a longer gestation period, every investor asks them, like, even if I invest in an early stage investment, who would do the follow-on round? Where's the capital going to come from? Is there enough appetite for these ideas? The biggest signal we want to give is between us, I think there's an infinite pool of capital that is there for these ideas now.
To cover them through the stages of their journey.
All the way. So the biggest message we want to send is be unafraid. If you are bold, we are bold with you and backing you with conviction, which wasn't possible before. And so a lot of people who were very excited about these ideas either would not pursue it or would leave Indian borders in the hope of like believers. They don't have to do that anymore.
So, what in this partnership are you going to have to look back to later and say, that really changed the game? I mean, what is that metric you're going to track?
Yeah, look, there is no metric, but I think 2 or 3 years out, if we are able to find enough entrepreneurs who were sitting on the fence so far, just because they didn't see a platform that will support them.
Yeah.
If we are able to find and fund enough of these, I think we will be very happy. 5 years out, 10 years out, these have to be very promising businesses, creating a generational impact, I would say.
100%. I think if we can culturally change the narrative that only these kind of startups are viable to go after in India, to the idea that anything is possible now, and the bolder the ambition is, the better it is. If we can change that, if we can add this color to the culture of the ecosystem, that would be the biggest success.
Is that the message you'd like to send out to entrepreneurs out there that
100%.
are watching, probably looking to approach either of you with an application?
Absolutely.
All right. We've broadly covered what the nature of this partnership would look like. We'll wait to see what these companies are that you two look to back together. But briefly, since we're ending 2025, starting 2026, what are some of the bold themes, new ideas that's got both of you excited individually as well at Accel and at Prosus?
There is a lot happening. See, I feel there are several themes. One is like, as he said, like the entire massive consumer base of India is now looking to kind of
is an ongoing theme.
Yes, a better experience. And that's happening in products, in services, in all kind of sectors. Then outside of that, Indian rise as a sovereign nation. So all the core competencies around manufacturing, export, building the core technologies in-house. That's a big theme. Then with AI, like we have a lot of scale-up companies now who've seen like problems in those companies, and with the possibilities of AI, they have global level insights now to build like really global institutions. So I think like I don't think there was ever a better time, and progressively every year is going to be better.
Yeah, so Ashutosh, for Prosus, big themes to watch out for in 2026 and any big exits?
Oh yes, look, I mean, we've been lucky so far. Swiggy last year, we've had 2 this year. Hopefully Meesho shortly. So fingers crossed. I think as for bold themes, AI is not a bold theme anymore. I think everyone knows about it. I think the adoption of AI in the Indian context continues to be a bold theme for me. How does AI impact innovation in agri, in education, in health? We have a company together called Arivihan, in education meets AI. So how can we use AI to completely change how products were consumed in these old school industries is something that I'm looking forward. And next year we'll probably do much more in that.
But in terms of the kind of risk appetite you're seeing globally and the kind of dry powder the two of you are sitting on, of course, apart from this one partnership you've signed, any hints you could give us?
Also, I mean, we have around $13-14 billion in cash on the balance sheet, and I think all of it is available. We used up $6-7 billion last year, not just in India, but globally. And yes.
All right. Prateek?
So I spoke to some of the themes that we're excited about. But in terms of dry powder like Accel's, like we're running our Fund 8 right now. And we operate very closely with our global teams. So I think everything from a 100K check to 100 million check is par for the course, and you'll hear some of them.
I think the bottom line is, if you have a good idea in India, and I'm not just talking about us, I think capital will not be a problem.
All right. I mean, that's a good sentiment to end on for founders, especially listening out there, that capital is not going to be a constraint. What could be?
Ambition.
Ambition could be a
conviction,
constraint. And conviction could be a constraint. Hopefully they'll work on the two of those. Thanks very much on that note, Prateek and Ashutosh. It was a pleasure speaking with you, and we look to hear more from the two of you on how you take this partnership ahead. Thanks very much.
Super. Thank you so much.
Thank you so much.
All right, on that note, we're going to take a break on this show, but don't go anywhere. We're back in just a moment with more news and updates. Welcome back. You're watching Startup Street. Now, at Dreamforce 2025 in San Francisco, the conversation around artificial intelligence was not just about technology, but it was also about empathy, about storytelling, and about purpose. Now, in this exclusive conversation with CNBC-TV18's Aishwarya Anand, Salesforce's Chief Digital Evangelist Vala Afshar spoke about the future of intelligence, on leadership, and the true potential of human-AI collaboration. Take a look.
One of the first questions that I have for you is that everyone at Dreamforce is talking about agentic enterprise.
Yes.
But if we just remove the tech, what does it actually mean in human terms? Okay. I want to understand that what's the emotional or behavioral shift that we're really describing here?
In the last 11 years of Salesforce innovating in the AI space, we first started with predictive use of AI, using software to predict outcomes. And then we grew and matured into the second phase, which was generative AI. Yeah. Now we're in the third wave, the agentic AI. And what has happened over time is software can understand language. We call it natural language processing. Software has now reasoning capabilities. So for the first time in humanity, software is not just a tool. Software can now execute and mimic some of the tasks that humans do to conduct their jobs. So it's an inflection point for the first time where in an agentic enterprise, people and AI agents can work together and co-create value. I've been in tech for 30 years, and I thought cloud computing was going to be perhaps the most important technology of my lifetime.
Yeah.
I now view AI and agentic AI as electricity for the 21st century.
As AI agents begin making independent decisions, okay?
Sure.
How do we build systems for accountability? And who takes responsibility when an AI agent misrepresents tone, cultural context, or customer intent?
When we develop products, the first thing we do is we have our research team and folks that understand ethics and trust, because trust is our number one core value.
True.
Before the first line of code, we ask, is this something that's going to be better for companies, society, our communities as a whole? If it's not, we don't build it. The question will always be, humans are going to be accountable. It's not technology that does good or bad. It's the people behind the technology, I believe.
So, I've heard you often talk about customer experience as a love story.
Sure.
Right?
Sure.
So in an era of AI-driven interactions,
sure,
how do brands design for delight and not just data accuracy? And can empathy still scale when algorithms are in the driver's seat?
All AI projects start and finish as data projects. So they're critically tied to each other in terms of success. Yes, you can build empathy in an algorithm.
Okay.
I got to tell you, when we launched Agentforce to help our customers on our website, help.salesforce.com, we made a mistake. We didn't modify the algorithm to say, look for words where if there's a sense of urgency or tonality, immediately get them to a human. To stay relevant, you have to deliver value at the speed of need. Great agentic enterprise companies have the ability to forecast and predict, what can I do to make you smile, to make you fall in love with my brand? Those are the companies that are going to win.
Traditional KPIs measure speed, scale, ROI, right? But when AI starts thinking and acting, how do you measure success then?
That's a great question. I think you have to adopt a mindset of working backwards.
Okay.
Start with asking a question, what does your customer consider success?
Okay.
What does your customer need to grow their business? Innovation doesn't happen in the centers. Innovation happens on edge. How does your customer serve their customers? That's where you find innovation opportunities. Once you understand what success looks like for your customer, then you can define the key performance indicators in terms of the progress you're making to ensure your customer is successful.
Now, you've seen innovations across continents. When you look at India specifically.
India specifically?
Yes.
Yeah, I love
its scale, speed, and scrappy, experimentation, I would say. What do you think the world can actually learn in how India is adopting and humanizing AI?
I've been a strong advocate of innovation in India. Right now, and the numbers speak for itself. Right now, when you look at the number of startups valued at $1 billion or more, unicorns, India is number 3 in the world.
Yes.
US, China, India. You're approaching about 100 unicorns in India, which again, 3rd in the world, and big distance between 4, 5, 6, 7, and 8. So India will play an incredibly pivotal role in the success of Salesforce and our ecosystem. The investments we're making in India and the growth trajectory from 2022 to 2025, we've had 6x growth in terms of number of resources we have in India. The investments we're making in startups in India, Salesforce Ventures is super. The actions of my company clearly speak to the importance of India in terms of what could be a global superpower when it comes to AI innovation.
Vala, my final question to you is, you've been part of the Dreamforce for over a decade now.
Absolutely.
You've seen trends come and go. What's your one thing that you wish that the world would unlearn about AI?
In the last 15 years, I've come to Dreamforce. What are some new ingredients? Cloud computing, social networking, the mobile revolution, Internet of Things, the data revolution, metaverse, distributed ledgers, blockchain, quantum computing, AI, agentic, predictive, generative, physical. So my answer to your question, unlearn about most of the recipes you have. And if you're not operating like a chef, if you're not unlearning all the recipes of the past, you may ignore an ingredient that frankly is going to either keep your restaurant up and running or it's going to close. You're either an agentic enterprise or you're on the path of a declining business.
All right, on that note, we're going to wrap up this special edition of Startup Street. Thanks very much for tuning in. It's a goodbye and thank you from all of us.
Well, the much-awaited LensKart IPO opens for subscription later this week. Remember, the company is seeking a post-money valuation of almost $8 billion and 7,300 crores worth an IPO size as well. We have with us the CEO or the founder, Piyush Bansal, and the CFO of the company joining in as well. Gentlemen, thank you so much. It is a fairly momentous occasion in the journey of the company. And to be very honest, it's a brand that needs no introduction. Everyone in India, the nooks and crannies, do know about LensKart. And at the same time, if I look at your revenues, 18% comes in from sub 2,000 rupees a pair and 18% above 10,000 rupees a pair. That tells you that it's been accepted as widely across the price range. And the only other brand that comes to one's mind is Decathlon, which has cut across this price value positioning equation. So congratulations on creating that business. More importantly, let's talk about the growth from here on, because what has happened so far is great. Now you're entering the world of capital markets. Now every quarter people will be asking you tougher questions. So the growth that you guys have been, reporting over the last 3 years on a compounded basis, do you think that sustains or can you grow faster than that?
See, I think overall, if we look at eyewear as a problem or eyewear as a market, today almost 7 out of 10 adults need glasses.
Yeah.
And this number has been growing from 5 or 6 to about 7. Even if you look at children, about 20% kids used to have myopia. Now that number, as of FY25, has become 40%, and we are seeing that number is growing. If we keep that in mind, our view is that the market will continue to grow. Market will continue to grow. And at LensKart, as long as I think we can do more and more eye tests, which we have been compounding more than 50%. FY23, we did about 6 million eye tests. And FY25, we did 16 million eye tests. And India needs light. We have almost, very soon going to have over 500 million people who need glasses, without glasses. So I think as long as we can continue to do that, there's a lot of opportunity.
The organized market obviously likely to grow nearly 1.6 times the unorganized market. Let me ask you the numbers specifically. What rate is the market projected to grow at? In the past, what have you been growing versus the market? And is that sustainable in the future as well?
So Indian market in eyewear category has been growing at about 13%, caused by both the increasing myopia rates, increasing adoption, and people buying more eyewear per head. we have been outperforming the market, and we think we will continue to do that in the foreseeable future.
By a factor of how much?
Similar to what we have done in the past.
What has been that number in the past?
We did about 24-25% growth, and we've been adding to our share.
So 2x of the market is a number that is sustainable. Let's talk about the margins as well. Your operating leverage has begun to kick in. The international operations, which have a lot more margins as well, all of that has meant that your margins are just sub 18% at the end of the previous quarter, the numbers that you've reported so far. What are the levers for the margins to go further from here, and what's the headroom here?
Yeah, if you see our last 3 years, we have increased our EBITDA margins by almost 8 to 9%. And that has come as a combination of product margin expansion, operating leverage, and marketing efficiencies. So all these 3 levers continue to be relevant. And as we look at future, they will keep adding to the margin profile. There is a natural operating leverage in our business. And given that this is a high product margin business, the flow-through helps in overall, EBITDA expansion.
Gross margins of almost 68%, employee costs at 25%, your EBITDA margins are close to 18%. So realistically speaking, if all things work, your margins have a headroom to go all the way up to 25 to 30%. Is that directionally an aspirational number?
I would not get into direction of margin right now. I think as a business, I would still say that we are very early in the journey. Like I said, right now, of course, the business has hit a certain scale, and we like to believe that we are creating a lot of value for the customer, and we want to do that even further. It is too early, I think, in the journey for us to really set expectations for the numbers that you're talking about right now. I think our goal right now is how do we take our 60 million eye tests to 100 million eye tests a year. As long as we can do that, I think we would like to be focused towards that. Margins is a outcome. They have been, we have been fortunate that they are coming along, and let's see where they go. I'm sure we continue to surprise everybody.
Well, you have to. You better be surprising people. The reason why I say that is because, you're saying you don't want to set expectations for people so early in your journey and speak about adding value to customers and all of that and stuff. In the secondary market is the valuation that matters the most. And I'm looking at your numbers. You're seeking a post-money valuation for almost 70,000 crores in terms of market cap. Just basis trailing numbers, you are, offered at a little over 230 times price to earnings, nearly 10.5 times sales. Even if you triple your profits from current levels over the next few years, you would be at around 70 times, right? So what I'm trying to understand is how much value do you think personally you've left on the table for people who are entering right now?
I would say that firstly, as a company and as an entrepreneur, our job is to create value for the customer.
Yeah.
Right?
And now increasingly shareholder as well.
Yes. And the shareholder, as far as valuation is concerned, it is what the market decides. Even if we look at the valuation, there are investors who are selling shares, there are investors who are coming in, and they have done a lot of working to arrive at these numbers. All I can say is they'll be very close to comparables. They won't be off. Sometimes when you look at things without looking at the full perspective, they look different. But yeah, be rest assured that everything will be in line with what they should be. I don't expect anything abnormal.
Can you give us the full perspective then? Because what people have right now from the RHP are the numbers that I just spoke about, trailing PE of over 234 times. How do you justify that? Especially because, coming from a person who's been speaking on national TV to startups and asking them about valuation. So if you could give us a sense.
See, we have had very detailed feedback from all the investors of the world, including domestic mutual funds, foreign long-only investors, including our advisors, and based on that, the investors and the sellers have kind of decided the price. From a business standpoint, what I can say is that as a tech company, when the operating leverage starts kicking in, the bottom line grows much faster than the revenue growth.
The EBITDA growth CAGR over the last 3 years has been over 90%. Obviously, there has been operating leverage which has kicked in. How much more is left ahead versus what has happened already? Can you tell us a sense?
As our revenues grow, we will continue to compound and continue to add margin.
All right. Let's talk a little more about the objects of the issue. A large part of the money that you're raising, the fresh issue that you're raising, will be deployed towards company-owned stores. Can you explain to us the strategy of having company-owned stores at a time when a lot of the retailers are looking at franchise-owned stores? How does that...
At LensKart, our model is not like a traditional retail.
Yes.
Our model is we are almost like we are a centralized supply chain model.
Yeah.
So what you're doing really in the retail stores is booking an order. We don't actually keep inventory in the retail store.
Got it.
Plus, as a company, we believe that we do not want to open a franchise store to pass any risk. Even, we have a few franchisees, and in that franchisees, we still continue to carry all the inventory risk ourselves. So in our model, we believe that, the company-owned store or a franchisee store doesn't make a lot of difference. As of now, the stores have been paying back quite well. I think we are also an evolving model. We continue to reinvest in the store experience because we want people to have a surprising experience all the time. So keeping all those factors in mind, we continue to still open a mix of both, but largely, yes, we have more company stores than franchise.
So roughly 2150 stores as of now in India, around 600, 700 stores abroad. How is that number likely to evolve over the next 3 to 4 years?
India is a very large market. If you see the optical density in India, it is about 60 stores for 1 million people.
Yes.
If you think about that, it is 1/8 the size of pharmacy and 1/20th the size of jewelry stores. For a modern day epidemic, which is affecting at least half of the population, and with only 1/3 penetration levels, the number of stores are bound to grow, right? So it is a very large market. It is growing very fast, and and we will continue to try and address it.
Let's talk about one of the other risks as well, which was the kind of supply that you got from China. That was about 55% a few years ago. That number's come down to around 45%. How much more are you looking to indigenize? What's the capex plan for, manufacturing in India, and how does that turn your return ratios?
Overall, I think for most categories, including frames particularly, we are dependent on international markets for import. We have not had a supply chain ecosystem for manufacturing of frames particularly in India. I think we are, as one of the key players in the market, we are making a lot of investment into bringing that supply chain ecosystem. It requires all aspects on the supply chain, from molding, from plating, from tools to come into the picture. We have initiated on that journey. Over the years, you would see us moving more and more manufacturing into India.
Could you give us a target?
No. Not that now.
No, because the new plant which is coming in, right? If you could give us a sense.
So we are making the investments, right? We are coming up in Hyderabad.
Exactly.
And we are making investments in terms of setting expectation of what percentage would move by then. We would refrain from that right now. But our steps are in that endeavor that we move more and more manufacturing to India.
All right. Let's talk a little more about the international business as well. You guys have, because of some of the acquisitions that you've made, one of a brand in Spain recently, and the Japanese companies, etc. You've now gotten about 40% of your revenues coming in from international business. But more importantly, that business has a little over 500 basis points margin advantage over what you're doing in India as well. How is that mix likely to evolve over the next few years?
See, overall, if you look at the journey of LensKart, it depends on where are you standing and looking at. If you feel LensKart as a company is just about there and now there is little room, I think as far as we are concerned in this category, the market is just beginning to open up. I mean, the amount of digital penetration we have in all markets, including India, the amount of the rate at which myopia is growing, one has to assume that you haven't done much right now. So keeping that in mind, there is a long journey for us. As part of that journey, there are two aspects that are very important for us. One is, how do we bring selection to our customers?
Yeah.
At LensKart, we operate like a house of brands. We don't operate under one particular product brand name. LensKart, we see it as a platform brand. I honestly feel that unlike apparel and shoes, eyewear has that mid-layer of D2C brands missing.
Yes.
Which will be the brands of the future. So, I mean, you have a Zara, you have an H&M, you have a Uniqlo in apparel, but in eyewear, you either have the luxury brands or you have non-brand. So we are trying to create these brands of the future. And in that same strategy, we acquired Mela, which is a Spanish-based eyewear brand. We think it's a very cool brand. You should try it out. They've really created a huge sensation amongst a certain section of the population, and we are launching that brand in India as we speak right now in a few stores and going to more stores. Yeah, and similarly, if you see Owndays, which was earlier the brand that we acquired, which is a Japanese brand, that is more around precision eyewear. And that brand is now a big part of the LensKart story in India, as well as what we want to do in international.
While I don't wear prescription glasses, I have to tell you that I am a customer of LensKart purely from a fashion standpoint. I don't know why, but I do have a feeling that maybe eyeglasses are the sneakers of the future, where earlier you had one shoe and now you have more. Speaking about that itself, what is the opportunity on non-prescription eyewear for you? Fashion glares, have you seen thought of that as an opportunity?
See, overall, yes, there is opportunity there. And Miller, the brand which we acquired, is predominantly a sunglasses first brand right now. So even in these sunglasses, a lot of work that we are doing is towards prescription sunglasses, right? And you mentioned like on the fashion side, actually, I think eyewear is going to be more fashion than anything else. I mean, this is the product that we wear on our face throughout the day. So I know the market feels that sunglasses is fashion and this is utility. Actually, we see the two converge, and already, I mean, the number of pairs that people buy at LensKart is already about 3.6 pairs every 2 years, which used to be much lesser earlier.
What's your revenue mix right now? How much comes in from prescription? How much comes in from sunglasses? How much comes in from non-prescription? And how much comes in from your app? How much comes in from offline? If you could give us that sense.
See, majority of our business is prescription, right? And on the channel side, we're a truly omni-channel player. It is a combination of online, offline, store. Even the people who are punching the orders at the stores, 45% of them engaged with us online, tried the virtual try-ons, checked out the reviews, and then they wanted an eye test, and that's why they went to the store and punched there. So it's a good mix of omni-channel.
And what about the ROCE accretion that happens to the fees that people pay for being premium members, for being gold members, etc.? You know, the last number was over 100 crores that you got annually from these fees. Do you have any target on how you expect that to contribute to your overall?
We don't have a target, but overall we feel that we need to allow people to own multiple fares. I mean, that's the whole genesis of the LensKart membership, to get people to enjoy owning multiple pairs. Ironically, people would think that if I make you buy multiple pairs, you would use them in a sequence. But what we see is people actually use them together, and then they have this subconscious desire to buy more, right? So I think we would see that habit is only going to grow more and more.
How's competition in the international market? Because in India, obviously, you are 2.5 times bigger than the next biggest, person in this business, the organized player, that's Titan Eye. How is competition in the international business, and have you faced any, difference in the competition there versus here?
See, all the markets that we are present in, they are highly fragmented and unorganized, and the traditional optical stores continue to be the, a large part of the market. So the value proposition that we bring to our customers in India, whether it is quality, whether it is value for money, whether it is the design element.
9%. And then there's booking. Glenn Fogel was on Squawk on the Street or Squawk Box this morning. Slightly lower ADRs, shorter length of stay, Jim, than last year.
Like yesterday, when we had Royal Caribbean, and it's like people buying at the end.
Well, the much-awaited LensKart IPO opens for subscription later this week. Remember, the company is seeking a post-money valuation of almost $8 billion and 7,300 crores worth an IPO size as well. We have with us the CEO or the founder, Piyush Bansal, and the CFO of the company joining in as well. Gentlemen, thank you so much. It is a fairly momentous occasion in the journey of the company. And to be very honest, it's a brand that needs no introduction. Everyone in India, the nooks and crannies, do know about LensKart. And at the same time, if I look at your revenues, 18% comes in from sub 2,000 rupees a pair and 18% above 10,000 rupees a pair. That tells you that it's been accepted as widely across the price range. And the only other brand that comes to one's mind is Decathlon, which has cut across this price value positioning equation. So congratulations on creating that business. more importantly, let's talk about the growth from here on, because what has happened so far is great. Now you're entering the world of capital markets. Now every quarter people will be asking you tougher questions. So the growth that you guys have been, reporting over the last 3 years on a compounded basis, do you think that sustains, or can you grow faster than that?
See, I think overall, if we look at eyewear as a problem or eyewear as a market, today almost 7 out of 10 adults need glasses.
Yeah.
And this number has been growing from 5 or 6 to about 7. Even if you look at children, about 20% kids used to have myopia. Now that number, as of FY25, has become 40%, and we are seeing that number is growing. If we keep that in mind, our view is that the market will continue to grow. Market will continue to grow. And at LensKart, as long as I think we can do more and more eye tests, which we have been compounding more than 50%. FY23, we did about 6 million eye tests. And FY25, we did 16 million eye tests. And India needs light. We have almost very soon going to have over 500 million people who need glasses. Without glasses. So I think as long as we can continue to do that, there's a lot of opportunity.
The organized market obviously likely to grow nearly 1.6 times the unorganized market. Let me ask you the numbers specifically. What rate is the market projected to grow at? In the past, what have you been growing versus the market? And is that sustainable in the future as well?
So Indian market in eyewear category has been growing at about 13%, caused by both the increasing myopia rates, increasing adoption, and people buying more eyewear per head. We have been outperforming the market, and we think we will continue to do that in the foreseeable future.
By a factor of how much?
Similar to what we have done in the past.
What has been that number in the past?
We did about 24-25% growth, and we've been adding to our share.
So 2x of the market is a number that is sustainable. Let's talk about the margins as well. Your operating leverage has begun to kick in. The international operations, which have a lot more margins as well, all of that has meant that your margins are just sub 18% at the end of the previous quarter, the numbers that you've reported so far. What are the levers for the margins to go further from here, and what's the headroom here?
Yeah, if you see our last 3 years, we have increased our EBITDA margins by almost 8 to 9%. And that has come as a combination of product margin expansion, operating leverage, and marketing efficiencies. So all these 3 levers continue to be relevant. And as we look at future, they will keep adding to the margin profile. There is a natural operating leverage in our business. And given that this is a high product margin business, the flow through helps in overall, EBITDA expansion.
Gross margins of almost 68%, employee costs at 25%, your EBITDA margins are close to 18%. So realistically speaking, if all things work, your margins have a headroom to go all the way up to 25 to 30%. Is that directionally an aspirational number?
I would not get into direction of margin right now. I think as a business, I would still say that we are very early in the journey. Like I said, right now, of course, the business has hit a certain scale, and we like to believe that we are creating a lot of value for the customer, and we want to do that even further. It is too early, I think, in the journey for us to really set expectations for the numbers that you're talking about right now. I think our goal right now is how do we take our 16 million eye tests to 100 million eye tests a year. As long as we can do that, I think we would like to be focused towards that. Margins is a outcome. They have been, we have been fortunate that they are coming along, and let's see where they go. I'm sure we continue to surprise everybody.
Well, you have to. You better be surprising people. The reason why I say that is because, you're saying you don't want to set expectations for people so early in your journey and speak about adding value to customers and all of that and stuff. In the secondary market is the valuation that matters the most. And I'm looking at your numbers. You're seeking a post-money valuation for almost 70,000 crores in terms of market cap. Just basis trailing numbers, you are, offered at a little over 230 times price to earnings, nearly 10.5 times sales. Even if you triple your profits from current levels over the next few years, you would be at around 70 times, right? So what I'm trying to understand is how much value do you think personally you've left on the table for people who are entering right now?
I would say that firstly, as a company and as an entrepreneur, our job is to create value for the customer.
Yeah.
Right?
And now increasingly shareholder as well.
Yes. And the shareholder, as far as valuation is concerned, it is what the market decides. even if we look at the valuation, there are investors who are selling shares, there are investors who are coming in, and they have done a lot of working to arrive at these numbers. All I can say is they'll be very close to comparables. They won't be off. Sometimes when you look at things without looking at the full perspective, they look different. But yeah, be rest assured that everything will be in line with what they should be. I don't expect anything abnormal.
Can you give us the full perspective then? Because what people have right now from the RHP are the numbers that I just spoke about, trailing PE of over 234 times. How do you justify that? Especially because, coming from a person who's been speaking on national TV to startups and asking them about valuation. So if you could give us a sense.
See, we have had very detailed feedback from all the investors of the world, including domestic mutual funds, foreign long-only investors, including our advisors, and based on that, the investors and the sellers have kind of decided the price. From a business standpoint, what I can say is that as a tech company, when the operating leverage starts kicking in, the bottom line grows much faster than the revenue growth.
The EBITDA growth CAGR over the last 3 years has been over 90%. Obviously, there has been operating leverage which has kicked in. How much more is left ahead versus what has happened already? Can you tell us a sense?
As our revenues grow, we will continue to compound and continue to add margin.
All right. Let's talk a little more about the objects of the issue. A large part of the money that you're raising, the fresh issue that you're raising, will be deployed towards company-owned stores. Can you explain to us the strategy of having company-owned stores at a time when a lot of the retailers are looking at franchise-owned stores? How does that...
LensKart, our model is not like a traditional retail.
Yes.
Our model is, we are almost like we are a centralized supply chain model.
Yeah.
So what you're doing really in the retail stores is booking an order. We don't actually keep inventory in the retail store.
Got it.
Plus, as a company, we believe that we do not want to open a franchise store to pass any risk. Even, we have a few franchisees, and in that franchisees, we still continue to carry all the inventory risk ourselves. So in our model, we believe that, the company-owned store or a franchisee store doesn't make a lot of difference. As of now, the stores have been paying back quite well. I think we are also an evolving model. We continue to reinvest in the store experience because we want people to have a surprising experience all the time. So keeping all those factors in mind, we continue to still open a mix of both, but largely, yes, we have more company stores than franchise.
So roughly 2150 stores as of now in India, around 600, 700 stores abroad. How is that number likely to evolve over the next 3 to 4 years?
India is a very large market. If you see the optical density in India, it is about 60 stores for 1 million people.
Yes.
If you think about that, it is 1/8 the size of pharmacy and 1/20th the size of jewelry stores. For a modern day epidemic, which is affecting at least half of the population, and with only 1/3 penetration levels, the number of stores are bound to grow, right? So it is a very large market. It is growing very fast, and and we will continue to try and address it.
Let's talk about one of the other risks as well, which was the kind of supply that you got from China. That was about 55% a few years ago. That number's come down to around 45%. How much more are you looking to indigenize? What's the capex plan for, manufacturing in India, and how does that turn your return ratios?
Overall, I think for most categories, including frames particularly, we are dependent on international markets for import. We have not had a supply chain ecosystem for manufacturing of frames, particularly in India. I think we are, as one of the key players in the market, we are making a lot of investment into bringing that supply chain ecosystem. It requires all aspects of the supply chain, from molding, from plating, from tools to come into the picture. We have initiated on that journey. Over the years, you would see us moving more and more manufacturing into India.
Could you give us a target?
No. Not that now.
No, because the new plant which is coming in, right? If you could give us a sense.
So we are making the investments, right? We are coming up in Hyderabad.
Exactly.
And we are making investments. In terms of setting expectation of what percentage would move by then, we would refrain from that right now. But our steps are in that endeavor that we move more and more manufacturing to India.
All right. Let's talk a little more about the international business as well. You guys have, because of some of the acquisitions that you've made, one of a brand in Spain recently, and the Japanese companies, etc. You've now gotten about 40% of your revenues coming in from international business. But more importantly, that business has a little over 500 basis points margin advantage over what you're doing in India as well. How is that mix likely to evolve over the next few years?
See, overall, if you look at the journey of LensKart, it depends on where are you standing and looking at. If you feel LensKart as a company is just about there and now there is little room, I think as far as we are concerned in this category, the market is just beginning to open up. I mean, the amount of digital penetration we have in all markets, including India,